Friends, very good morning, good afternoon, good evening based on what time you're watching this video. So now let us walk through all your amendments which are there for your May 2024 exams on indirect taxation. And the amendments which are basically there, they are all the amendments in the Act section, that is the section of the Act or rules or notifications from your 1st of May 2023 till your 31st of October 2023. So we are trying to analyze all of them. Now starting with the amendments where you're talking about your levy of GST. Basically when you see your levy of GST, you will find certain amendments even in the section when you talk about Schedule 3 which discusses about your actionable claims, but that is taken as a separate topic per se. We have taken that online gaming, including online money gaming, as a separate topic, so we'll be discussing that. Now talking about the amendments basically in your levy of GST, basically there are certain circulars which are there, basic circulars which are there, clarifications which are there. The first clarification which is there is with respect to director, very basic and simple clarification. Now this clarification basically talks about what if a director in his personal capacity is giving services to his company. When director is giving services to, supplying something to the company, that is giving his services to the company, that is subject to RCM. But in case where director is giving something to the company or the body corporate in his private or personal capacity, please do understand he is now not acting like a director anymore because he is giving that services in personal capacity. For example, a director is giving his property on rent to the company or any other services. That is not taxable under RCM, it is taxable under FCM. Please do understand that when you talk about directors, we are not talking about managing director, whole-time directors, because their services is outside the ambit of GST. It is covered under Schedule 3, services by employee to employer in course or in relation to employment. So when you are talking about directors, directorial services to the company or body corporate is clearly covered under RCM. So when you talk about director and he is giving services to the company or body corporate in capacity as a director or in his personal capacity. So when it is in capacity of a director to the company or the body corporate, or it is in personal capacity to the company or body corporate, it makes a lot of difference. So basically this amendment is trying to clarify that we need to differentiate services of a director to company or body corporate in capacity as a director, which is clearly subject to RCM, which means the company or the body corporate will pay tax under RCM. And when the same is given in personal capacity, any such services, say for example renting of immovable property is just an example, that would be covered under your FCM. Again, I repeat, we are not talking about managing directors and whole-time directors because their services per se is not even attracting GST. It's not even levy. There is no levy at all because it is covered under Schedule 3. Now, that's the first clarification with respect to director services. Moreover, that is a clarification with respect to whether it is covered under RCM or not. Now, the second clarification again given by the circular is on restaurant services. Basically, they are talking about a scenario where you do have a cinema operator who's also running refreshment or eating stalls or kiosk or counters, etc. Which means there is exhibition of cinema, also there is a food provided by the same cinema operator. And that particular cinema operator may even have installed a vending machine or some other recreational activities through coin operated machines, which the customer may or may not avail. Please do understand that whenever cinema operator is there another important chain of revenue is food. Now it is clearly clarified that cinema is a separate service, exhibition of cinema is a separate service, and food is a separate service. So when you talk about food given there in cinema hall, it is basically restaurant service. The only criteria is it should be independent of cinema exhibition service. the food which is given by the cinema operator is clearly restaurant service. The only criteria that food and beverages are given, offer as a service, and importantly, they are independent of your cinema exhibition service. Now you may ask, what if I book my tickets on Book My Show or some other apps, and while booking my tickets, I do even select the food that I want. If at all, when booking, if booking of tickets is separate and having food is separate, one service is cinema exhibition service, other service is restaurant service. But in case where both are supplied together, where the cinema ticket and supply of food and beverages are clubbed, which is possible. So when I'm booking my ticket, I do tell that I will have these snacks, and the snacks will automatically come at my seat number and I will enjoy it. So when I'm paying, I pay for the ticket as also the food. In such a case, it is a composite supply, and here the principal supply is that of your exhibition of cinema. So then there's no concept of restaurant. So what is the understanding here? It actually clarifies whether it is composite or not. When cinema exhibition is given separately, food is given separately, both are independently given. The first service is cinema exhibition service and the second service is restaurant service. But when they both are clubbed, then it is clearly a composite supply where the principal supply is that of exhibition of cinema. That is the second circular. And the next circular, friends, is all about, again, a very basic circular. Just because there is an entry in service accounting code which talks about a scenario that you are talking about SAC entry 997171, where services that of provided by a holding company to the service company, the service provided by holding company and enterprise for the purpose of owning the interest. So there is an entry which tells that if holding company is having some shares in subsidiary company, then it is a service and the service accounting code is 997171. But the basic question that you need to ask, just because, merely because holding company is having some shares in subsidiary company, whether per se it will become supply of service. Now the issue came up because there was a service accounting code 997171 which talks about service provided by a holding company, that is holding of securities of companies and enterprise for the purpose of owning a controlling interest. Just because there happens to be a service accounting code, whether per se it will become supply of service. And rightfully CBIC, all these clarifications are given by Central Board of Indirect Taxes and Customs. They rightfully have said that it is not at all a supply. Forget about the fact that it is a supply of service. Because when you talk about holding the shares, shares is nothing but your securities. So when you talk about securities, securities is neither goods nor services. So when you're talking about holding shares, shares is covered within the term securities, and securities are neither goods nor services. Therefore, just the activity of holding of shares by the holding company in the subsidiary company cannot be treated as supply of services merely because there is a service accounting code and service accounting code entry for the same. No. A very simple circular which tells that, see, if I am holding shares, let it be holding company in subsidiary company or any person in any company. That holding of shares is nothing but securities, and securities is neither goods nor services in terms of definition of goods section 2 clause 52 section 2 clause 1 not 2. So it is neither goods nor services. When it is neither goods nor services, it cannot be supply. When it cannot be supply, the question that it is supply of services will not at all come. So that is all about your clarification in your shares clarification, where holding company is holding some shares in your subsidiary company. So now let's discuss about the amendments in your valuation chapter. The most important amendment that has come in your valuation chapter is in your rule 28, which talks about supply between distinct person or related person. Now please do understand, one of the related person would be, one of the case where 28 covers is also related person. Now here they have added a scenario where they tell that if at all, see, rule 28 basically has got particular steps. So it has got regular valuation as well as optional valuation. Now there is a non-obstanding class, notwithstanding class, which tells that notwithstanding anything contained in Rule 28.1, the value of supply of services where you're talking about related person and providing corporate guarantee on behalf of someone else to the banking company or the financial institution on behalf of the related person. So one person is providing corporate guarantee to the bank or financial institution on behalf of its related person. In that case, the value shall be deemed to be 1% of the corporate guarantee amount or the actual consideration whichever is higher. Now, please do understand the impact of this rule. So first it is telling that forget about whatever is discussed in Rule 28. For what category? For a scenario where you're talking about corporate guarantee services. Now, what is basically corporate guarantee services? Supposing you're talking about a holding company and a subsidiary company which happens to be related person. Related person definition is very wide, but we are taking the example of holding company and subsidiary company. Now, assume that subsidiary company is taking a loan from banks or financial institution, banking company or financial institution. And for that loan, for the loan which is taken by the subsidiary company, holding company is acting as a guarantor. The guarantor is the holding company. Loan is taken by the subsidiary company, but guarantor is the holding company. Now, please do understand there is supply of services which is in relation to corporate guarantee service by the holding company to the subsidiary company, which means holding company is the supplier and the subsidiary company is the recipient for what? For this corporate guarantee services. Holding company is the supplier, subsidiary company is the recipient for this corporate guarantee services. Now here they are trying to tell that this is a transaction between related person. This is a transaction between your related person. So here the transaction between related person means you are going to come to your Rule 28. When you are going to come to your Rule 28, Rule 28 offers you regular valuation as well as optional valuation. But here they tell that forget about this fact. If at all it is a corporate guarantee services, the conditions are very clear. If at all it is a corporate guarantee services and that too it is between related person. If it is not between related person, you are not even entering Rule 28. If it is between related person, in that scenario, what would be the valuation? Valuation will be 1% of the corporate guarantee amount, whatever the loan amount is being taken and whatever guarantee is being offered for that, or the actual consideration, whatever actually it is charged, whatever holding company is actually charging for that. Actual charge, whichever is higher. Now please understand, it doesn't make any sense when you're talking about such kind of services between distinct person, because distinct person means branch office of the same company or the same person, and in that scenario this will not work. It will work only in a scenario where you're talking about corporate guarantee services offered by one related person to another related person, where the valuation would be 1% of the guarantee amount or the actual consideration, whichever is higher. Now, the moment this amendment came out in your Rule 28, there was an immediate need of a clarification. Basically, this clarification finally said that when you talk about corporate guarantee services, valuation will be in terms of, the moment you're talking about corporate guarantee services, valuation clearly will be in terms of Rule 28 too. So, corporate guarantee by a person to another related person who has taken loans from banks and financial institution. Obviously, whether it is with consideration, without consideration, don't worry. Even if it is without consideration, it will be 1% of the guarantee amount. If it is with consideration, 1% of the guarantee amount or the actual consideration, whichever is higher. But then there came a question. What if a director is giving guarantee for the loans taken by the company? Director is giving, director is giving guarantee for the loans taken by its company. So director is giving the guarantee to the banks or financial institutions for the loan which is taken by the company. In such a case, again there's a problem, because when you talk about director, basically you'll understand that they are nothing but employees, at least managing director, whole-time director. If not all the directors, at least your managing director and whole-time directors will be covered under the category of employees. Now the problem is, if you're calling director as the supplier and the company as the recipient for this corporate guarantee services, supply of services, the problem is, again your rule 28 will hit. So again it is corporate guarantee services between whom? Between the director, if at all it is managing director, whole-time director, it is employee, and the company recipient. And please do understand, you're talking about transactions between related persons. Employer, employee are related persons. So again, it is a scenario where you're talking about corporate guarantee services between related persons. Now, generally, when a director is giving guarantee to the banks or financial institutions for the loan taken by its company, please do realize the fact that they are acting like related person, and highly possible that again you are hit by your rule 28.2. So here the focus is on your rule 28.2. Now normally application of rule 28.2 is not a problem, but the circular has beautifully analyzed the fact, and it has said that director giving guarantee to the banks or financial institution on behalf of the company is mandated in terms of your RBI. So RBI is rather not giving any option, and director has to give such guarantee. Right, so please do understand, this personal guarantee which is given by the director, first of all, it will be free of cost. Why? It is not by choice. It is not at all by choice. This personal guarantee by the director to banks or financial institutions for the loans taken by the company is not by choice, is forced in terms of your RBI circular. And if it is in terms of RBI circular, when director is giving such guarantee, so RBI is not mandating that director should give guarantee, but RBI circular is clearly telling that if at all director is giving any guarantee to the company, it cannot have any charges. So please do understand the difference. So RBI does not tell that director you have to give guarantee to the banks or financial institutions for the loan taken by the company. That is not required. But if you are giving such guarantee, you cannot have any income. When you cannot have any income, there is no question of any option of getting income. So no one is going to do, if at all an option is given to them. Right, when director is giving that guarantee, first of all it sees the condition of the company and it is finding no other guarantor, therefore it is giving. And the moment it is giving, RBI circular clearly tells that you cannot charge anything, you cannot have it as your income, there cannot be no consideration being charged, which means there is no such open market value. When there is no such open market value, no tax shall be payable. No tax shall be payable. So rule 28.2 shall not apply for personal guarantees given by the directors to the banks and financial institutions for the credit facilities taken by the companies. So finally the circular ends up in a very proper manner that rule 28.2 is not applicable. Obviously when you read the RBI circular, in exceptional situation it is telling that director can charge something from the company where the companies are not doing well and the existing guarantors are no longer with the management, which means you are director, now you are no longer in part of management, but the guarantees are continuing because the new management guarantee is not available or it is not inadequate, which means I was a director. Now I am not a director. I've gone outside. So now technically I was the director who gave guarantee when I was the director, but now I have gone outside. The new management is not in a position to give guarantee. So my guarantee still continues. Then I can charge something because technically I am not the director. When technically I am not the director, please understand that there is no transaction between related person. When there is no transaction between related person, there is no question of Rule 28. In such cases, GST will be charged and assessable value will be, you need not even come to rules. Assessable value will be equal to actual consideration. Why? Technically, you are not the director. So here we are not talking about a person who's not the director. If at all you are giving a guarantee for some unrelated person, it is nothing but actual consideration. But if you're giving guarantee on behalf of a related person, then this issue comes up that it is 1% of the guarantee amount or the actual consideration, whichever is higher. Whichever is higher. In this situation, in this scenario, please do understand the fact that technically you're not the director. You were the director. Now you're no longer the director. You can charge an amount. When you're charging the amount, the transaction is between unrelated person. You're not even coming to the rules. Assessable value will be equal to the actual consideration. But forget about that exception. Generally understand the fact that if at all by any chance director has given a guarantee for the loan or the credit facilities taken by the company, RBI circular does not permit that director to charge any amount. It does not tell that you have to give guarantee, but if you have given guarantee as a director to the banks or financial institution on behalf of the company, you cannot charge anything. There's no scope of any income. When there's no scope of any income, there's no question of any open market value, and rightfully it has said that no, we will forget this transaction and we will not apply Rule 28.2. When we are not going to apply Rule 28.2, they are in simple terms telling that assessable value will be equal to 0. Assessable value will be equal to 0. That's their understanding, and rightfully that circular has analyzed the situation and given the answer. So first we have understood what is the amendment in Rule 28 in terms of Rule 28.2. This is a general scenario. So guarantee given to banks or financial institution on behalf of another related person, then this Rule 28.2 comes in where it tells that forget about the normal principle of Rule 28, we'll go with the special principle. Then we have seen the circular where it gives a relaxation for the director giving guarantee to the banks or financial institutions for the credit facilities or the loan availed or loan taken by the companies. So that is the basic understanding of your Rule 28 sub Rule 2 right along with that circular. Now talking about your concept of your ISD. So there's a concept called as input service distributor. Now when you talk about your input service distributor, we are going to discuss this in two parts. Input service distributor is a concept where certain common services are taken by a particular registration called as ISD registration. Then that ISD registration will distribute to all the branch offices. Now this circular has changed the entire situation of the scenario what we have understood of input service distributor. Rather it is divided into three parts. Only the first area deals with your input service distributor where you are talking about third party services. Second area is talking about internally generated services where ITC is available, and internally generated services where ITC is not available. Now let us understand all these three scenarios. Basically, you're talking about transaction between distinct person. Again, we are focusing on Rule 28 only. Transaction between distinct persons. Now, if at all there is a third party service provider, and if there is a company, let us call it as Reliance Limited, it is getting its services. It is getting common services. When it is getting common services, which is common input services, which is related to multiple branch offices. Now, this circular opens this scenario telling that you can take this common input services in your registration as ISD Then ISD will take the credit, then distribute to the branch office 1, branch office 2, branch office 3, etc. So ISD will take that service, take the ITC, book or avail the ITC, then it will distribute the ITC. That's the first option. And if you see section 24, section 24 tells that ISD registration is mandatory registration, which in a way means that whenever you receive any common input services, ISD registration is a mandatory registration. But they gave a second option. So this circular has actually changed or diluted the concept of mandatory registration for ISD. The option number 2 which is given, this is option number 1. They give option number 2. Now option number 2, it tells that one of the branch office can take that service, take that input credit and cross charge to branch office 2 and branch office 3. So first it will book or avail the ITC, entire ITC, then it will pay output tax to the portion of the credit that belongs to your branch office 2 and branch office 3. It will pay proportionate output tax, and branch office 2 thereafter or branch office 3 thereafter will book or avail the ITC. Look at the difference here. So initially you should have taken, the understanding before the circular is whenever there are common input services which pertains to multiple branch offices, the only way out was taking ISD registration, which is a mandatory registration. What ISD will do? It will book or avail the ITC, then distribute the ITC so that all the branches can book or avail the ITC. ISD will take the ITC and pass on the ITC so that all the branches will avail the ITC. Now, what has come up is, for all these common input sources, one branch can come forward and take the invoice. It can ask the service provider to give the invoice under its name. That branch office will book or avail the ITC. Who is going to pay output tax? Output tax is going to be paid by the service provider, third party service provider. It is going to be paid by the third party service provider. Now that particular branch can avail the entire ITC, then give the ITC to its other branch offices. Now it is not going to distribute the credit. In the earlier case it was going to distribute the credit. Now it is not going to distribute the credit. This branch office will raise tax invoice and pay proportionate output tax, and then give it to the branch office 2 and branch office 3. So the difference is, here it is all about distribution of credit. Here it is all about paying output tax, then allowing the branch offices to take the credit. In both the cases, it will be passed through tax invoice only. That's a special tax invoice called as ISD tax invoice in the first case, and the second case normal tax invoice. Now the second case, technically it is called as cross charge. One branch is charging the other branch in terms of cross charge, and the first case is technically called as the concept of ISD. Now what has happened after the circular? ISD registration in a way is diluted. ISD registration, which was called as mandatory registration, now it seems that it is not mandatory. Though section 24 is not amended, but it seems that circular is given an option. It is telling that for common input services, do not worry, no need to go through ISD, where ISD would have taken the credit and distributed the credit, and branch offices would have taken the proportionate credit accordingly. Now they can ignore the concept of ISD, though it is mandatory. Now it is no more mandatory. They can go with cross charge. What is cross charge? One of the branch office will come forward and take that invoice from the third party service provider. It will book entire credit. Then proportionately it will pay the output tax related to branch office 2, give a separate tax invoice to branch office 2, branch office 3, give a separate tax invoice to branch office 3, and distribute the credit. But one thing is same, they are telling that though the method has changed, the numbers, final numbers should be the same. Whatever numbers branch office 1, 2 and 3 should have got in terms of ISE should be the same number that finally should be available with branch office 1, 2 and 3. Because when it is taking the credit and paying the output tax, it will have only balance ITC. So this amount should match with this amount. So in either ways, numbers should remain the same. So that is first clarified by the circular, first part of the circular. This is for your third party service providers. Third party service providers. Now, there is another part where it talks about a scenario where you're going to talk about internally generated services. Internally generated services, which means there's no third party service provider. There is only internally generated services. Branch office 1 is helping out branch office 2 in doing some work. Branch office 1 is helping out branch office 2 in doing some work. So internally generated services. So when you're talking about internally generated services, the concept is very different. One branch office is helping out the other branch office in doing the work, which means, say for example, you're talking about supposing there's a CA sector, chart accountant has got an assignment in Delhi where there's a branch in Delhi, and from Bangalore, few employees from Bangalore, that CA office is also having employees at Bangalore, few employees at Bangalore are helping the Delhi branch to deliver the services. So simple language, one branch is helping the other branch in giving the services. It is internally generated services. Obviously, the service in both the cases is finally given by the branch office 2 to the client, but branch office 1 was actually helping branch office 2. So if you want to understand in a very clear way, branch office 2 in turn was providing services to the client or the customer, but branch office 1 was helping. Now our focus is only on branch office 1 and branch office 2. So branch office 1 is helping out branch office 2 in finally delivering the goods or services to the final customer or the client. Now again there are two scenarios which comes up, option 1, option 2. Option 1 will apply when branch office 2 is entitled for full ITC. Option 2 is there when branch office 2 is not entitled for full input tax credit. If branch office 2 is eligible for full ITC, then please do first understand that the rules which will be applicable in both these scenarios, whenever transaction is between distinct person, it will not be covered by section 15, it will come to rules, and rule 28 will cover, and we will be talking about rule 28, transaction between distinct persons. And in rule 28, there's a concept called as open market value, deemed open market value rather. There's a concept called as deemed open market value which is not available in other rules, be it 27 or 29. So here we have the concept of deemed open market value. When your branch office 2, the recipient, is eligible for full ITC, you can go with deemed open market value. You need not go with normal open market value, deemed open market value. And this circular has said that deemed open market value you can take any number. Till now the understanding was you can take any number. If the open market value say 1 lakh, you can take 10,000, 1,000, anything. But this circular has gone a step ahead and said that as the branch office 2 is eligible for full ITC, you can take any deemed open market value, which can also be 0, which means you need not do anything. And where I tell that branch office 2, the recipient is not eligible for, supplier is branch office 1, recipient is branch office 2. Let us forget about the second part of the transaction where branch office 2 is giving to the customer, the client. So supplier is branch office 1, recipient is branch office 2. Now, when the recipient is not eligible for full ITC, then you cannot go with the concept of deemed open market value. You have to go with actual open market value. And there are methods. The first method is you have to go with actual open market value. Then if not available, you have to go with like, kind and quality goods. Or finally, as per your rule 3031. And you have an option to ignore this OMV LKQ, that is open market value, like, kind and quality, goods, services, and go as per rule 3031. And you can go with optional valuation, where you can take the 90% of the price charged by the branch office to the client. So these are all there. So here you don't have open market value. You have to apply the normal sequence. You have to apply the normal sequence. Where are you have two options? Either open market value or like, kind and quality, or go as per rule 3031 and it has to be applied in sequence, or go with 90% of the price charged by branch office to the client. You have two options. Now, what is clarified here? It is very clear. When the recipient is not eligible for full ITC, your concept of deemed open market value will not help out. And here you do have two options. Option 1, option 2. Either go in sequence. What is the sequence that you have to follow? OMV, that is open market value, not the deemed, normal open market value, like, kind and quality, or rule 3031, or go with 90% of the price charged by the related person, which is branch office 2 in this scenario. Branch office 2 to the client, take 90% of that. Now, understand that this circular has said that when you are going with this calculation, please do understand that there is no need of including the cost of salaries of employees. You need not take them into account. You go as per the rules. So this circular finally has said that you need not worry about your cost of salary of the employees, which branch office 1 was used, not mandatorily to be included. So that may be included, may not be included, forget about the fact. So here it is clarified that forget about the cost of the salaries. It may be included, may not be included. When you're following both these steps, it may be there, it may not be there. So go with the sequence. Don't think that, okay, branch office 1, these many employees worked for branch office 2 in helping the branch office 2 to execute the work for the client. No. Don't take the cost of those salaries. Just go with this particular sequence. Either option 1, sequence is open market value, or next option, like, kind and quality, or the last sequence, go as per rule 3031. If you are not interested, ignore this, or you can go with 90% of the price charged by the related person, in this example, branch office 2 to the client. So cost of the salaries is not there. So this is given in this circular. So you've done this entire circular, understanding what is that. We have understood more about the concept of input service distributor. We have also understood more about how rule 28 actually works. So here we have understood first, in the first part of the circular, it was ISD versus cross charge. In the second part of the circular is what's internally generated services, where you can go with deemed open market value versus no deemed open market value. So that was the differentiating factor. Now, when you see your valuation rules, this entire discussion, the main amendment and the circular discussion was all focused on rule 28. Now this is basically focused on your rule 33, pure agent concept. Pure agent concept. Now what is the question asked here is, if at all, whether reimbursement of electricity charges received by the real estate companies, malls, airport operators will be included in value. Now what is clarified is, if at all the electricity charges which is charged by the real estate owners, resident welfare association, real estate developer, etc., is a pure agent, which means they are charging rent plus electricity and they are giving the proof of actual EB bill and they are collecting without any profit margin. If at all they are satisfying the condition of rule 33 and acting as pure agent, it will not form part of the value and there's no question of any GST on the same. So they'll pay GST only on the basic rental amount and not on the electricity amount. But in case, in normal scenario, what happens is, this rental amount will be there along with your annual maintenance charges, AMC. And this AMC will include your otherwise called as common area maintenance charges. In renting sector, it is technically called as CAM charges, common area maintenance charges. In common area maintenance charges, even electricity will be part of it. And when they are not collecting on cost to cost basis, when they are not giving the proof of actual amount charged by the electricity boards or the distribution companies, in that scenario, see, when you are acting as pure agent, you have to give the proof of the actual amount charged by the state electricity boards or the distribution companies, which means I'll be charging 1 lakh plus say 25,000 electricity charges, and for this 25,000 there'll be actually the supporting proof of amount charged by the state electricity board or the distribution companies, and that will be the exact same amount, pure agent. In normal scenario, when I'm charging 1 lakh plus 25,000 common area maintenance charges mainly containing electricity, please understand that I will not give that proof. If I am not acting as pure agent, here I was acting as pure agent, rule 33 conditions was satisfied. If at all I am not acting as pure agent, rule 33 condition is not being satisfied. In that scenario, it is quite simple. I have to pay GST on rental amount plus common area maintenance charges including electricity. And if that is the scenario, it will be nothing but composite supply, where the principal supply is renting of immovable property and common area maintenance charges including electricity is nothing but ancillary. So here the entire amount will be subject to GST. Entire amount. So in this example where I am charging 1 lakh plus 25,000 common area maintenance charges including GST, GST will be on entire 1,25,000. In the next example where I am satisfying the concept of pure agent, I am charging rental amount 1 lakh plus electricity charges 25,000. Where I am acting as pure agent for this electricity, I am giving the supporting proof of EB charges charged by the state electricity board or the distribution companies. Then I will pay GST only on this 1 lakh. I will not pay GST on this 25,000. So this entire circular is based on the concept of your pure agent discussed in your rule 33. Yes, now let us see the amendments which have come in your exhibition notification 12 bar 2017 CT rate read along with 9 bar 2017 IT rate. Very basic amendment have come, rather only two amendment in nutshell have come. The first amendment is there was an exemption given when we are talking about satellite launch services, but the exemption was limited to only ISRO, Indian Space Research Organization, and Antrix Corporation Limited, also New Space India Limited. So it was limited only to three entities: ISRO, Antrix Corporation Limited, and New Space India Limited. Now, what have they done? They have wonderfully made this amendment and said that this service per se is exempted. So satellite launch services by anyone is now exempt. So let it be anyone. It may not be only these three entities, it can be anyone. If anyone is launching the satellite, it is exempt. That's the first amendment. In a way, it has expanded the scope of the amendment. Now, the next amendment is there in your government related services. The amendment is when you're talking about services to governmental authority. It is not government or local authority. It is services to governmental authority where the major control is of government, not 50%, it is 90% controlled by government, either set up by an act of parliament or state legislature or established by your government, either or, but 90% control is with government. When we are talking about what? In a scenario where we are talking about water supply, public health, sanitation conservancy, solid waste management system, and slum improvement and upgradation. So when you're talking about services to governmental authority, you're talking about first control is of government and not normal control, 90% control, and they're doing the works in relation to Article 243G, Panchayat related functions, and Article 243W, municipality related functions. What you need to understand is here supplier is anyone. The recipient is governmental authority, and supplier can be anyone, recipient is governmental authority, and the service is that of water supply, public health, sanitation conservancy, solid waste management system, and slum improvement and upgradation. I would look at it as more of clarification, but nevertheless, this exemption is welcome because if it is by governmental authority, anyways, it is exempted. If it is to governmental authority and it is in relation to all these 5 activities, be it water supply, public health, sanitation, conservancy, solid waste management system, slum improvement and upgradation, even technically if it is not covered by article 243G and 243W, by the way, it is covered. Even if at all it is being challenged, no need to worry, there is a separate exemption for all these 5 activities when it is supplied by anyone, but it is to governmental authority. That is the first amendment. And the second amendment is when you talk about government, there are certain activities of government which will not be covered under your RCM. They will be covered under FCM, and also their exemptions generally will not be applicable. So when you talk about services by Department of Post was always taxable except in a very rare scenario where you're talking about postcard, inland letter, book post, ordinary post, and it is less than 10 grams only. In that scenario, otherwise it is always taxable. Now they have said that any service by Ministry of Railways, Indian Railways, is always taxable. So what have they said is, this exemption has come in various entries, entry number 6, 7, 8, 9. So in all these entries, they have amended this. Please do understand the impact. Any service which is provided by Ministry of Railways is not exempt. Now it is taxable. Obviously, there's an exemption when you talk about tickets. If at all you're talking about railway tickets, no AC and not a first class, that is exempt. But other services, there are a lot of other services provided by Ministry of Railways. So any such other service by Ministry of Railways is now taxable, and we'll be seeing that it is always under FCM. So it is taxable, and later on we'll see that it is always under FCM. So this is another exemption which has come. So earlier, Department of Post, except in rare scenario, it is always taxable. Likewise, Ministry of Railways, except in rare scenarios, it is always taxable. So when you talk about postal services, railway services, except in rare scenarios, postal services, very rare scenario, exempt, and railway services for a ticket which is not in AC and not in first class, all the other services is always taxable. So by these two authorities, it is always taxable. Another important point, you will find that whenever they provide the services, it is always under FCM, always under your forward charge mechanism. So here there is a related amendment where you will find that the related amendment tells that any service by Department of Post and Ministry of Railways, whenever taxable, RCM will not apply. When I tell whenever taxable, RCM will not apply, it in a way clearly indicates that it would be covered by FCM. So Department of Post or Ministry of Railways, that is Indian Railways, except in few cases, rather only in one case, it is always taxable, and it is taxable always under FCM. So this amendment is by virtue of your section 9(3) of CGST Act, read along with notification number 13/2017 CT rate. Right. Now, talking about the exemption amendment, they are very limited this time, but there are few clarifications, very basic and simple clarification. The first clarification is, if at all anyone is providing work to Central Public Works Department, CPWD, whether it is exempted under 12/2017 CT rate. So when you're talking about Central Public Works Department, right, so you're talking about your public parks in government residential colonies or government offices or other public areas are all maintained by Central Public Works Department. And what is the nature of service there? Maintenance of community assets, urban forestry, protection of environment, promotion of ecological aspects are basically the work done by them, and it is all covered under Article 243G, Panchayat related functions, and Article 243W, municipality related functions, read along with the 11th schedule and 12th schedule of your constitution. So basically, understand this scenario. What is the work done by your Central Public Works Department? They do work of maintaining government areas, be it park in government residential colonies or government offices or public areas which are maintained by CPWD. What is the main objective? Maintaining those assets, urban forestry, environment aspect, ecological aspects. And basically, when you see the type of work done by them, you'll find that they are covered in Article 243G, read along with 11th schedule, Article 243W, read along with 12th schedule of the Constitution. Now, understand that whenever you are giving services, whether it is pure services or composite supplies, up to 25%, goods is only constituting up to 25%. Basically, two exemptions are given. Whether it is pure services or it is goods plus service, but goods should not be more than 25%, even if it is in relation to horticulture or horticulture works. So this question was basically in relation to horticulture and horticulture work. Right, horticulture and horticulture work. Let it be. Right, flower work. So whether it is horticulture or horticulture work, let it be. Whenever you're talking about, this is the micro aspect. Macro aspect, it covers everything. What are the main things? Here you're talking about taking care of the environment and ecological aspect. So that will easily cover your horticulture and horticulture works. So whenever these horticulture and horticulture works are provided to CPWD, that is Central Public Works Department, they are basically exempted. So pure services or services with goods where goods is not more than 25% of the total value, it is exempt when it is being provided to government. And the question was, when horticulture and horticulture related works are provided to Central Public Works Department, is it exempt? First understand that whether these works are in relation to your Article 243G and Article 243W. Yes. Whatever work CPWD undertakes, it relates to panchayat or municipality related works. Therefore, horticulture and horticulture forestry or horticulture and horticulture works is also covered that. And we have understood how it is covered that. What is the exemption? Who's the supplier? Supplier is anyone. But who's the recipient? Recipient is basically government. Whether CPWD is government. CPWD, Central Public Works Department, is government. Whether the work is, first condition is CPWD is government. Whether the work of horticulture and horticulture works, which is carried on by CPWD and someone else is helping CPWD to provide that service, which means supplier is anyone, recipient is your CPWD. Whether that work is covered by Article 243G and 243W. Yes, both the conditions are satisfied. Recipient happens to be government here. So your recipient is government, CPWD, and the work happens to be, horticulture related work happens to be a work which is covered by Article 243G and Article 243W. Therefore, it is exempt. Now, the next clarification again, when you talk about a lot of government related exemptions, first you have to understand who are they. Now, the next clarification basically is whether District Mineral Foundations Trust, which is set up by state government or as governmental authorities. So, first question is whether they are governmental authorities, and if so, whether they are eligible for exemption. So here the question is, basically the first question is whether your District Mineral Foundation Trust, now it is not about government, whether they are governmental authorities. What do you mean by governmental authorities? Governmental authorities, as discussed, control should be of government more than 90% and they should be doing the work in relation to Article 243G or 243W. So when you see District Mineral Foundation Trust, they are in fact governmental authorities. Why? What is the work undertaken by them? The work undertaken by them is drinking, water supply, environment protection, healthcare facilities, education, welfare of women and children, medical equipments in that mining affected areas. So they are going to take care of all these things. See, whenever mining is done, the area will be having an impact. So what this District Mineral Foundation Trust will do, they will take care that the public who are affected, that they will be provided proper water supply, environment protection to an extent so that it is not damaged to a greater extent, healthcare facilities, education of women and children in that affected area, including giving medical equipments if at all required. So basically, all these works which this district mineral foundation trust does is in fact very much covered in your 11th schedule and 12th schedule, which means they are either panchayat related functions, article 243G, or municipality related functions. If it is covered in 11th schedule, it is nothing but article 243G, panchayat related functions. If it is covered in 12th schedule, it is nothing but municipality related functions, nothing but article 243W. Right. So the ultimate users are those individuals and families, women, children, or those farmers who are affected in that particular area. And basically, the service provided to them by them is basically free of charge and no consideration is generally charged. Now understand that when these people are providing services, it is very clearly exempt. And not only services by them is exempt, services to them is also exempt. It's just like the previous point. By governmental authority is exempt. You need to understand the difference. Service by government or governmental or local authority, services by governmental authority, services to government, local authority, governmental authority. Whenever you talk about not any service, you're talking about panchayat related functions, article 243G, and municipality related functions, article 243W. Whenever they are provided by government or local authority, it is not at all supply. No supply. Whenever they are provided by governmental authority, it is supply but exempt. Whenever it is provided to them, here supplier is third party. Whenever it is provided to them, that is also exempt. You need to understand that in this case, your district mineral foundation trust are governmental authority, and the work done by them, it is either panchayat related functions or municipality related functions. Therefore, obviously, when both these criteria are satisfied, that the authority is governmental authority and the work is that of panchayat related functions or municipality related function, then it is basically exempt. So again, a clarification here. So that is all about your amendment and exemption, which are basically under two categories, satellites and government category. Hardly basic amendments, 2 or 3 amendments, then the circulars here. Now moving on to your amendments in taxable person, including RCM. The first amendment already you understood when we have discussed the amendment in exemption with respect to government sector. Understand that service by departmental of post, except in one case, is always taxable, and whenever it is taxable, it is always taxable under FCM. Likewise, service by Ministry of Railways now, except in one case, it is always taxable, and whenever it is taxable under FCM. So that you need to understand. So that is the first amendment that we have understood. Now the second amendment is there only in IGST Act, section 5.3 of IGST Act, read along with notification 10/2017 IT rate. It's not CT rate. 10/2017 IT rate. What have they done is, after the judgment of Supreme Court in Mohit mineral case, they have removed an special RCM entry which was talking about transportation of goods by vessel from a place outside India to India by any person in non-taxable territory to an importer, where importer was liable to pay RCM again on the freight element, foreign shipping line. Import of goods by foreign shipping line, importer was required to pay RCM on the freight portion. The same importer will be already paying customs duty. When he is paying customs duty on that import of goods, he will be paying on cost plus insurance and also freight. So in a way, he was paying customs duty on cost, insurance and freight. Now he was also paying IGST under RCM on freight. Now they have removed this RCM entry, which was right from the beginning, which was under litigation. So they have removed this particular entry. They've totally removed this particular entry. Right? It was why it was tricky or challenging. Please understand that when I'm importing the goods, what was happening? Import of goods already attracts customs duty, and customs duty already includes IGST. So customs duty breakup is BCD plus SWS plus IGST. So importer was already paying. This importer was already paying customs duty, which is BCD plus SWS plus IGST, and importer was paying this customs duty on what? On cost plus insurance plus freight. That was the value. In addition to it, importer was also required to pay IGST under RCM only on freight portion. What have they done? They have removed this RCM entry now, and fairly now importer will pay only the customs duty, because they are now focusing only on your import of goods portion, where he'll pay customs duty on all elements, cost, insurance and freight, and the breakup of customs duty will be BCD plus SWS plus IGST. And on this import of freight services, where it is by foreign shipping line, it was only covering vessel. That RCM portion, special RCM, now it is removed. A very valid move, because it was under litigation. Even the judgment was in favor of SSC in High Court followed by Supreme Court. Therefore, they have removed this RCM entry. Now, the next amendment is there in your ECO, not in your RCM. We have discussed the amendment in your RCM, section 9.3 of CGST Act, read along with section 5.3 of IGST Act. Here, now we are talking about section 9.5 of CGST Act, read along with 5.5 of IGST Act, and the notification here is 17/2017 CT rate. So we are focusing, the same amendment is there in your IGST Act. So 9.5 of CGST Act, read along with 17/2017 CT rate. Which means neither the supplier, 9.5 is a category where ECO will pay tax, neither the supplier pays the tax nor the recipient pays the tax. Basically under ECO there are 4 notified services: passenger transportation service, was there accommodation service, was there housekeeping service, was there, and also your food services, restaurant services was additionally added. Now they have amended your passenger transportation service, where they have said that in case of passenger transportation service which you are booking through ECO, so supplies through ECO, say for example Ola, you are booking the cab through Ola. So neither the supplier, the cab owner will pay the tax, nor the recipient, you will pay the tax. It is Ola who will pay the tax, not only on its commission portion, but Ola will pay tax on the entire ride charges. So that is actually basically understanding of 9.5. What have they done? They have said that this passenger transportation service, when it is through ECO, when it is of radio taxi, motor cab, maxi cab, motor cycle, which means they have covered actually basically anything or any other motor vehicle. So any motor vehicle, actually you can understand that it is through any motor vehicle. You need not remember what is radio taxi, motor cab, maxi cab, motorcycle, even two wheelers are covered, motorcycle or any motor vehicle. But they have changed for omnibus, bus category. They have said that omnibus will be covered here only when omnibus is not a company. So omnibus, if at all person supplying omnibus, person who's booking the omnibus through ECO, and that omnibus happens to be a company, when the omnibus owner happens to be a company, then it is not going to be under ECO, it will be under FCM. Now let us understand the difference. Supposing we are not talking about omnibus, we are talking about normal motor vehicle and omnibus. Let us understand the difference by the way of this amendment. Any motor vehicle, whether it is radio, taxi, maxi cab, motorcycle or any other motor vehicle. So I am not focusing on all these aspects, motor vehicle. other than omnibus. Motor vehicle other than omnibus. Now let us take two scenarios. Supply is through eco. Supply is through eco. Here, understand that supply of passenger transportation services of motor vehicle is through Ola. Here, let us take the example of, say, you're booking bus seat through Redbus app. Now, whenever you're talking about this particular motor vehicle concept, when you have to understand this, let us understand that supplier is a company, supplier is not a company. If the supplier is a company or supplier is not a company, does not make any difference when it is any motor vehicle. Here, when the supplier is a company, supplier is not a company, here it will make a difference. So here you are going to classify them as supplier not being a company, supplier is a company. I'm not talking about Ola and Redbus, I'm talking about a supplier who's actually supplying. Supplier is not a company and supplier is a company. If at all supplier is not a company or a company, it really does not make any difference. Here, Ola will pay GST on entire ride charges. Not only on its commission, entire ride charges, which is nothing but your section 9(5) category. Supplier will not pay any tax. Ola will pay tax on entire ride charges. When it is paying GST on entire ride charges, it includes its commission as well. When you're talking about supply through eco, supply of passenger transportation services through eco, which means that you're booking a seat of a particular omnibus through Redbus. If supplier is not a company, then in this case, eco, Redbus is the eco. Redbus will pay GST on entire ride charges. Again, section 9(5) category. But if I tell where supply of passenger transportation services is through eco and it is a category of omnibus and the supplier happens to be a company, then your 9(5) will not apply. When I tell 9(5) will not apply, what is the understanding now? Now the understanding is very different. Supplier will pay GST on this entire ride charges and your Redbus, which is the eco, will pay GST only on its commission, and both are covered under FCM. So here your section 9(5) is not going to be applicable. Your section 9(5) is not going to be applicable. So what is happening here? Supplier, which is a company now, supplier of passenger transportation service through an omnibus, which happens to be a company through eco. I repeat, supply of passenger transportation services through omnibus. The supplier happens to be a company and the supply is through an app, a platform, that is electronic commerce operator. In our example, eco, here is Redbus. In that case, 9(5) will not apply, which means supplier will pay, normally pays, what is the supply for the supplier? Ride charges, FCM. And Redbus will pay, Redbus will get only its commission, will pay GST only on its commission, FCM. So Redbus will pay GST on its commission. It will be inward supply for supplier, it will take the credit, and supplier will pay GST on entire ride charges, and if recipient is eligible for credit, that will take the credit. So this is the understanding of this particular amendment. This is the area where we are talking about this amendment, which is having an impact. The amendment having an impact. Now, the next area basically where we are talking about section 9(3) RCM is not basically amendment, but from May 2024 onwards, ICF said that section 9(3) RCM, which is there for notified goods and notified services, now they have also given notified goods under your syllabus. So section 9(3) covers notified goods, notified services under RCM. Now they have said that we will, for your exams, see, understand that section 9(3) RCM right from the beginning was for notified goods and notified services, but in your syllabus it was only covering notified services. Now section 9(3) RCM for notified goods is applicable from May 2024 exams. So whatever we are discussing, please do understand it is not amendment. Normally when you see the amendment portion is highlighted in red color. What is omitted and what is added is always highlighted. This area will not find anything written in red color because it was already there. So there are list of amendments where a list of items where RCM will apply. Basically, it is not an amendment. Section 9(3) RCM for notified goods is going to be there in your exams from May 2024 onwards. So till now it was not there in the syllabus. Now they have added that in the syllabus. That's the difference. But practically it was there right from the time when GST was there. Now what are the categories? What are the notified goods? Cashew nuts, not shelled or peeled. So cashew nuts which are neither shelled nor peeled. If the supplier is agriculturalist, agriculture means it can be only individual or HUF, and the recipient is a registered person in GST, then RCM. Basic entries are there. So cashew nuts is the first category, supplier is agriculture, recipient is registered person, then it is covered under RCM. BD wrappers, leaves, which are otherwise called as tendu. The supplier is agriculturalist and the recipient is registered person. Again, it is under RCM, the recipient will pay GST. Tobacco leaves. The supplier is agriculturalist and the recipient is registered person. Again, it is under RCM. So we have cashew nuts, not shelled, not peeled. We have your BD wrapper leaves, which is tendu. We have your tobacco leaves. We do have your raw cotton supplied by agriculturalist, and recipient is any registered person, RCM. Any registered person, RCM. So in all such cases, see, agriculturist, basically when you're talking about an agriculturist, when he's supplying something out of cultivation of land, anyways he is not required to pay tax as per section 23. Now they're trying to shift the burden to the recipient in certain cases, be it your cashew nuts, or be it your BD wrapper leaves, tendu, or be it your tobacco leaves, or be it your raw cotton. In all these four cases, what is common? In all these four cases, the common aspect is supplier should be an agriculturalist, which is individual or HUF. Recipient should be a registered person under GST. It is taxable under RCM. Recipient will pay and take the credit if eligible. So in all these four items. Now, before taking other items, first we'll take the second set here, which basically focuses on government. Supply of lottery. Supply of lottery can be done only by state government, by the way. Supplier is state government, union territory, or the local authority. So only state. Central will not be that. State government, union territory, or local authority. And recipient is a lottery distributor. Recipient is a lottery distributor. So it tells that government, state government tells that we will not pay GST. Recipient, you pay GST under RCM, lottery distributor. So this is government sector. Here we can call it as government sector. Here it was all a agricultural sector. Right, in government sector, that's one more category. Government will lot of times confiscate the goods belonging to different person, be it the vehicles or seized or confiscated goods or old and used goods or waste and scrap. So government will have used vehicles, seized and confiscated goods. It may have taken the goods from someone else. See, understand what government will do with those goods. Finally, it will sell them. So whether it is vehicles, used vehicles, or seized or confiscated goods, or old and used items, again second-hand items, or waste and scrap. So four categories. First is used vehicles of government themselves. Second is seized and confiscated goods which belong to someone else. Now it belongs to government. Third is old and used items. Again, it is of government, but it's old items. Any items. Yes, third point is very wide, very wide. First point is limited, used vehicles. Second point is limited, seized and confiscated goods. Third point is very wide, old and used goods. It can be any goods. Fourth point is again restricted to waste and scrap. Whenever it is supplied by government, now it is any government, central government, state government, union territory, or local authority, to any registered person, it is under RCM. So first four categories were of agriculturists. Supplier is agriculturist, recipient is registered person, RCM, but for what? Cashew nuts, not shelled, not peeled. Your tendu, your tobacco leaves. Tendu is nothing but your BD wrapper leaves, 10 tobacco leaves and raw cotton. And second here is lottery. A supplier is state government, recipient is lottery distributor. And in government there is one more category, various category of goods. Be it your used vehicles, or seized confiscated goods, or used and old goods, or waste and scrap. So third point, used and old goods is very wide. Supplier is government and recipient is registered person. It is under RCM. It is under RCM. Now other categories. What are the other categories? Other categories focuses on silk yarn. When it is, now this time supplier is not agriculturist. It is supplied by a person who manufactures silk yarn. Who's manufacturing silk yarn from raw silk or silkworm cocoons for supply of silk yarn, which means he is a manufacturer of silk yarn. Supplier is manufacturer of silk yarn, be it from raw silk or silkworm cocoons. Recipient is registered person. So here, this time, supplier is not basically agriculturist. You're not talking about agriculture. Supplier is, you're talking about manufacturer, which means, because you cannot be calling the person who's doing processing on the work on the agriculture products, he cannot be called as an agriculture, he is manufacturer. Manufacturer of silk yarn, either from raw silk or your silkworm cocoons. Now, he's manufacturing, then supplying. Recipient is, if the recipient is registered person, RCM. Then, supplies of essential oils other than those of citrus fruit. So they are giving the list of essential oils of peppermint, which is technically, chemically called as mentha piperita, or of other mints, where spearmint oil, technically called as ex mentha spicata, or water mint oil, ex mentha aquatic, or horse mint oil, ex mentha sylvestris, or bergamot oil. These are all chemical terms. Ex mentha citrate or mentha arvensis. So basically you are talking about essential oils. Just remember the very simple term. You are talking about essential oils other than containing citrus fruit. Obviously go through these names, but need not buy at them. Let's focus on the term essential oils. It may be of peppermint. There are chemical name given for all things. It may be of other mints. It may be of peppermint, other mints. In other mints, they have specified it can be of spearmint oil, or water mint oil, or horse mint oil, or bergamot oil, or mentha arvensis. So they have listed out the items. In such cases, for the first time, you will be finding that supplier should be unregistered person. See, everywhere condition is different. Supplier here should be unregistered person, and recipient should be registered person. Supplier should be unregistered person, recipient should be registered person. Then it is covered under your RCM. See, in both the cases it is different. When you're talking about silk yarn, supplier should be manufacturer, recipient should be registered person. Here, supplier, as when you're talking about essential oils other than containing citrus fruit, supplier should be unregistered. If he is registered, no RCM. Supplier should be unregistered person, recipient should be registered person for it to be covered under RCM. So this is covered under others category. Agriculturalist 4, government 2, and others will have 3. So one more is covered under others categories. What is that? When you're talking about priority sector lending certificate. And very, very interestingly, you'll find that supplier is also registered, recipient is also registered. Very special point. See, when you talk about priority sector lending certificate, it can be only transferred from one bank to another bank. So supplier is one bank, recipient is another bank. All the banks will be surely registered. So they are very clearly telling that supplier is a registered person, recipient is also a registered person, but even then it will be covered under RCM. Even then it will be covered under RCM. Right. You have to be very careful with the name of the products, also who's the supplier, who's the recipient. In the first four categories, agriculturist categories, it is very simple. 4 products, supplier is agriculturist, recipient is registered person, RCM. When you talk about government category, that is also simple. 2 categories of government, supplier is government, recipient in one case of lottery is lottery distributor, in other cases registered person, then RCM. Other categories, it is very interesting. For silk yarn, supplier, manufacturer of silk yarn. He is not trader, manufacturer of silk yarn, recipient is, if a trader of silk yarn is there, it is normal FCM. Manufacturer of silk yarn and recipient is registered person. And the next category is very interesting, essential oils. Supplier is unregistered. If supplier is registered, no RCM, FCM. Supplier is unregistered and recipient is registered. And in the last category of others, priority sector lending certificate is more interesting. Supplier is also registered, recipient is also registered, but recipient will pay. Why? Priority sector lending certificate is transferred only from one bank to another bank. So bank 1 is giving priority sector lending certificate to bank 2. So it is only between banks. It is only between banks, bank 1 and bank 2, and obviously understand that banks will always be registered. So the recipient bank will pay under RCM. So these are the notified goods. How you can remember the list of notified goods? Section 9.3 RCM. When you talk about notified goods, understand them in 3 parts. How to understand them in 3 parts? First, it is nothing but your agriculturist 4 categories. It is your agriculturalist 4 categories. Then government, you have 2 categories. Then others, you have 3 categories. So totally we have discussed your 9 cases under section 9.3 RCM for notified goods. So totally you have 9 cases. Agriculturalist 4 items with conditions. Government 2 categories, 2 items, and others you do have 3 items. That's all about your section 9.3 RCM notified goods. I again repeat, this area is not an amendment as it has come for the very first time from your May 2024 exams. We are discussing that in your amendment. Now let us discuss about the amendments which are there in your small dealers topic. Very small amendment is there. When you talk about your composition scheme, be it your normal composition scheme given in section 10.1 and 10.2, and be it your special composition scheme which is discussed in section 10.2a, there's an amendment which is brought which tells that if at all you're supplying goods to electronic commerce operator where TCS under section 52 is applicable, it is allowed now. Previously, what used to happen is if at all you're supplying goods or services through electronic commerce operator where TCS under section 52 is applicable, you cannot be under composition scheme. This is not allowed in composition scheme. Now, what is the amendment that they have brought? They have deleted the term goods there. What is the impact of that? The impact is, even today, if you're supplying services through ECO where TCS is applicable, you cannot be under composition scheme. It is not allowed under composition scheme. But now, if you're supplying goods through electronic commerce operator, even if there is TCS applicability under section 52, it is allowed. This benefit is only and only for goods. For service sector, if you're supplying services through electronic commerce operator where TCS is applicable, you cannot be there. So this benefit is only and only for goods sector. Normally benefits are for service sector, but this time the benefit is for goods sector. You continue supplying goods to electronic commerce operator where section 52 TCS is applicable. You can still enjoy your composition scheme. You can still remain under composition scheme. But an important thing is this supply of goods through ECO where TCS is applicable can be there, but the supply cannot be an interstate supply. So there's one more condition for composition scheme, that you cannot make interstate supply. So that is true for goods as well as services. Yes, you can supply through online platforms, electronic commerce operators where TCS is applicable, but it should be within the state. It should not be interstate supply. If it is interstate supply, finished. And to make sure that this is taken care, they put a penalty on electronic commerce operator as well. If such composition scheme dealer who's dealing with goods, who's supplying through ECO, but still working under composition scheme, one thing he has to take care is he can supply goods through electronic commerce operator where TCS under section 52 is applicable, but it cannot be interstate supply. If at all it is having interstate supply, unknowingly a composition scheme dealer who's supplying through electronic commerce operator where TCS is applicable, if he is making an interstate supply, there will be action against him. Technically, he is going outside composition scheme. He cannot be inside composition scheme. But not only that, even electronic commerce operator will be penalized for composition scheme dealer doing a mistake. That penalization is discussed in section 122, subsection 1b. So what is the summary? If you are under composition scheme and if you are supplying goods through ECO, supplying services through ECO. If you're supplying goods through ECO, under any situation, now after the amendment, supply of goods through ECO, whether TCS is there or TCS is not there, don't worry. So again, here there are two possibilities. Supplying goods through ECO, supplying services through ECO, TCS under section 52 is there, TCS under section 52 is not there. TCS under section 52 is there, TCS under section 52 is not there. Now, whether TCS under section 52 is there or not there, things is very clear that you can still remain under composition scheme. For goods sector, you can still work under composition scheme, whether TCS is there or not. The amendment is in this area, that you are supplying goods through ECO, where TCS is there, but still you can be under composition scheme. If you're supplying services through ECO, where TCS is not there, see, where TCS is not there, there's no change. In this area, there's no change. So, if at all TCS is not applicable, very clearly you can still be under composition scheme. No change at all. So, what is the change? If you're supplying services through ECO, where TCS under section 52 is applicable, you cannot work under composition scheme. So the change is in this part. Earlier, both for goods sector and service sector, you cannot be in composition scheme. Now for service sector, you cannot be in composition scheme. Goods sector, you can be under composition scheme. Now when you can be under composition scheme, there is a catch, that you can be under composition scheme, but it cannot be interstate supply. Wherever you are under composition scheme, you have to take care that it cannot be interstate supply. Interstate supply is not allowed. It should not be a interstate supply. It should be only an intrastate supply. If at all it is interstate supply, by default, if you're supplying to other state or outside India, that is export, or to SEZ, it is an interstate supply. You're outside composition scheme. So when you're inside composition scheme, you have to take due care that you cannot have interstate supply. Even if it is supply of goods through electronic commerce operator, that is online platforms where TCS is applicable, where now you're allowed to be under composition scheme. In fact, this is the amendment. The yellow color highlighting is the amendment. Even if you have that, you can be under composition scheme but not make interstate supply. If at all you make an interstate supply, as a person making interstate supply, you will be outside composition scheme. But in this case, they are telling this electronic commerce operator also that you will also be penalized, because you had to take care that this person is not supplying to other state or outside India or to SEZ. So that is the summary of it. So this is the amendment which is there in your composition scheme. Now talking about the amendments in your input tax credit, friends, First amendment is only a correction amendment, not so relevant for your exams. Surely it will not be tested in your exams, but nevertheless, we'll see. When you're talking about your input tax credit, they have amended section 16(2) of your CGST Act. What is the amendment? It's only certain corrections. First amendment, what they have done is they have corrected the language that if at all payment is not made to the supplier within 180 days, then there will be reversal of ITC. So initially they added in section addition to output tax liability along with interest. Now they are telling that whatever is the ITC that has to be paid. So they have removed that addition to output tax liability because it is reversal of ITC technically. So when you take an ITC, but if you're not doing something, that is reversal of ITC. But they had used the term addition to output tax liability. In rules, it was reversal of ITC or an amount. So now in Act and rules, in section 16 and rule 37, now it is in link that if at all the payment is not made within a period of 180 days to the supplier, then the ITC availed shall be paid back along with interest. So the first amendment is correction of the words. Correction of the words in the Act to match with rules. So section 16 of the Act and rule 37 of the rules now tells that if the payment to the supplier is not made within 180 days, then the ITC has to be reversed or you have to pay that amount of ITC. So again they talk about paying that amount of ITC or reversal of ITC along with that interest. So that is one correction. Second, again more of clarification. They have said that as and when recipient is making the payment to the supplier, proportionate credit will be reavailment part. Right, reavailment. Now what they have done is provided also that the recipient shall be entitled to avail a credit of input tax credit on payment made by him. This payment made by him is to whom? Obviously it is to the supplier. So now in this third proviso, they have added the term to supplier, payment made by the recipient to whom? Obviously this entire context of section 16(2), proviso to section 16(2) and third proviso to section 16(2) is all about payment to the supplier. I read along with rule 37. So they have just added the word this payment. When we are talking about this payment is the supplier. So that is the amendment which is brought out. Again, very clearly, this would never be tested in your exams. It's only certain correction in the language which they have done. Now, talking about certain areas of proportionate credit where they are talking about section 17 of CGST Act read along with rule 42, rule 43 of CGST rules. We've discussed that in supply. Now what have they done is they have changed something with your actionable claims specifically. This though it's not dealing with actionable claim, they have changed something here. What have they changed here? For there is an explanation to section 17(3), which tells that for the purpose of this subsection, value of exempt supply shall not include value of activities given in schedule 3, which means basically tells that anything which is mentioned in schedule 3, which is not at all supply, value of exempt supply will not include. The value of exempt supply will not include schedule 3 transactions, except there are exceptions. The first exception remains the same. The first exception is all about value of land and building, para 5. So first exception remains the same, except value of activities or transactions which is given in para 5 of the said schedule, which was there before also. Before the amendment also it was there. Now there was only one exception, now they have made two exceptions. So the first exception, they have removed it from here, except those specified in para 5. Now the same thing is again repeated, no change. So value of exempt supply will not include schedule 3 activities except your para 5, which talks about sale of land and sale of building. So that will be included in value of exempt supply. Now what is the main amendment which is brought out is, now value of exempt supply will not include schedule 3 except para 5, that is sale of land and building. Also value of such activities or transaction as may be prescribed in para 8A of your schedule 3. Para 8A is nothing but sale of warehouse goods. Sale of warehoused goods. Now what has happened is, this entire amendment can be explained in this way. Value of exempt supply by default in general value of exempt supply in general does not include schedule 3 transaction. In general, it does not include schedule 3 transactions. It will not include it. Value of exempt supply generally does not include schedule 3 transactions or schedule 3 activities. But out of schedule 3, all the activities, they tell that it will include something. Special schedule 3 transactions. Right. So there are two special schedule 3 transactions. One is your para 5. Now what is the recent addition is para 8a. So in normal, value of exempt supply does not include any activities given in schedule 3. But it includes special activities, para 5 activities and para 8a activities that will be part of value of exempt supply. What is your para 5 activity of schedule 3? It is nothing but sale of land and sale of building. And what is para 8a of schedule 3? It is nothing but sale of warehouse goods. Sale of warehouse goods. So all other schedule 3 activities other than para 5, which was already there in the exception, and para 8a, which is a new addition. Other than these two activities, value of exempt supply will not include any other activity of schedule 3. Now what is the amendment brought in here? Now they have said that your para 8a activity, which is sale of warehouse goods, not high C sales, sale of warehouse goods will be included in value of exempt supply. This part will be included in value of exempt supply. And this does not stop here. This amendment in section 17.3 is given as an explanation 3 to rule 43. So the continuation of that is explanation 3 to 43. What it tells, what will be the value of, see now it is very clear that value of exempt supply will include sale of land and sale of building. It will also include sale of warehouse goods. Now for the purpose of reversal of credit, rule 42, rule 43, what would be the value of sale of warehouse goods? It would be the value of goods which is there at duty-free shops, at arrival terminal in international airports to the incoming passengers. So passengers who are coming from outside India, when they come, there are duty-free shops at arrival terminal in international airports. We are talking about international airports where we are talking of persons from outside India coming to India. There they are going at arrival airports and there will be certain duty-free shops. Once such items are sold, that value will be taken as sale of warehouse goods. Because finally the intention is to find out the value of exempt supply. Say for example, when you talk about sale of land and sale of building, the value of exempt supply for sale of land and sale of building will be the stamp duty value. Will be the stamp duty value, and sale of warehouse goods in terms of explanation to rule 43. Now they have said that as sale of warehouse goods will also be part of value of exempt supply, they have to tell what would be the value. Conceptually it will be included in value of exempt supply, but what would be the value? The value which is there at duty free shops, when you're talking about arrival terminal of international airport for the incoming passengers. So when you talk about duty free shops, value which is at duty free shops at arrival terminal of international airports, which is for the incoming passengers, that value will be taken as value of warehouse goods, that particular value, valuation part, because it is without any taxes or duties. So that is the reason that you're talking about them. Now this why actually finding out that? Now what will happen is, for the purpose of rule 42 and 43, for the purposes of rule 42 and rule 43, sale of warehouse goods will be treated as will be included in the value of exempt supply, and that value would be the duty free shop value. In simple, duty free shop value, which is there at arrival terminal of international airport for the incoming passengers. If you have any such sale of warehouse goods, there will be proportionate credit reversal. Supposing I am selling, normally I am importing and selling in India, I am purchasing from within India and selling it, that is GST. I am selling warehouse goods, there is no GST. Now there will be some common credit which I have to reverse in terms of your rule 42 and 43. So that is the entire understanding of this. Now there's one more amendment which is there to explanation 1. This was all section 17 subsection 3 read along with explanation 3 to rule 43. Now, explanation 1 to rule 43 is only a clarification. Again, it deals with value of exempt supply. So explanation 1 to rule 43, it tells that for the purpose of rule 42-43, your aggregate value of exempt supply shall exclude. That is an exclusion part. It will not include all. That was what we have discussed was an inclusion part. Here it is an exclusion part. It will not include. There was an item listed that. What was the item? Value of supply of services by way of transportation of goods by vessel from custom station of clearance in India to a place outside India. In simple language, transportation services by sea. Transportation services by sea, that is through vessel. Transportation services by sea when the goods are going from India to outside India. So transportation services by sea when the goods are going from India to outside India at the time of export of goods. If I want to write in a very, very simple understanding, transportation services by vessel. When you're talking about transportation services in sea, it is always by vessel. At the time of export of goods, when the goods are going from India to outside India, there will be transportation required. So that service was not to be considered as value of exempt supply, which means no need of any such reversal. It excluded it. Now understand that earlier transportation services through vessel, when the goods are being exported, earlier it was exempted, and when it was exempted, it was said that we will not include it in the value of exempt supply because we don't want any reversal. So when it was exempted, so earlier it was exempted. Earlier it was exempt supply. Therefore, reversal would have been there, but they don't want a reversal. Therefore, they clarified that it will not be included in aggregate value of exempt supply. Though technically it was exempt supply, it was not included in aggregate value of exempt supply. But now, it is a fact that this is no more exempt. It has become a taxable supply. When it has become a taxable supply, by automatically it will not be included in aggregate value of exempt supply. There is no need. So earlier, technically, transportation service by vessel at the time of export of goods was exempt supply. But they did not want any reversal. So when you don't want any reversal, it should not be included in value of exempt supply. So no reversal. But now, technically itself it is taxable supply. When technically itself it is taxable supply, obviously the question of it being included in aggregate value of exempt supply is not at all there. So the crux is, the final understanding is the same. You will get full ITC. The difference is, earlier when you are providing this particular services, transportation services by vessel at the time of export of goods, it was exempt supply, but you got full credit because it was not included in aggregate value of exempt supply. Now, when you're talking about the same service being provided, that is transportation services through vessel when the goods are being exported, this is now a taxable supply. Obviously, when it is a taxable supply, it doesn't make any sense talking about exclusion. When the supply itself is taxable supply, you should not write that value of exempt supply shall not include. Obviously, it will not include it because now it has become taxable supply. So, obviously, it will not be included in aggregate value of exempt supply. Obviously, now also credit will be available. See, the net effect is, you are getting the credit when you are supplying it earlier. You are going to get the credit when you are supplying it now. The difference is, earlier it was an exempt supply, but for ITC reversal purposes, it was not included in the value of exempt supply. Therefore, no need of ITC reversal. Now, technically it has become taxable supply. Obviously, it will never be included in the aggregate value of exempt supply. It will be part of taxable supply only. Therefore, ITC will be fully available. No need of this particular exclusion from aggregate value of exempt supplies. So that was the amendment there. And if you see all the amendments, there are effective dates given for exam purposes, need not remember, but everywhere below the provision, you have been given what is the effective date of the amendment. No need to strictly buy at it, but for understanding purposes, you should understand when this provision has become effective. So below every provision, you will find an effective date. Now, there's a very important amendment, very, very important amendment in ITC. Rather, if at all, I'm going to tell that in ITC chapter, there's an amendment which has come This time there's only one important amendment which has come, which is this one, section 17.5 block credit. So in your block credit, section 17.5 block credit, what has happened is they have added an entry which is there in the block credit. They have added one more expenses item in block credit. Any goods or services, section 17.5 FA, or both, which is received by a taxable person, which are used or intended to be used for activities relating to obligation under corporate social responsibility, which is given in section 135 of Companies Act 2013. In simple language, any CSR related expenses. Any CSR related expenses. If at all you are doing any expenses, whether dealing with purchasing goods or giving any services related to your CSR activities, corporate social responsibility activities, which is given under section 135 of Companies Act, it will be very, very clear that CSR related expenses, you cannot take any credit. You cannot take any credit. Earlier there were doubts. Can I take the credit of any expenses related to corporate social responsibility? The answer was both yes and no. That is what confusion. Now it has been made very, very clear by the government that any CSR related expenses, you cannot take any credit. Credit will not be allowed. Credit will not be allowed. Now, when you talk about ITC, this is a very important amendment which has come. Other amendments, first was all a clarification. The second part of the amendments was all related to value of exempt supply. This main amendment is block credit. When talking about the next part of this ITC, which is say the circular. Now this circular talks about warranty, ITC on warranty replacements of parts and repair services during warranty period. Right, so it is talking about warranty replacement of parts and repair services which is happening during warranty period. Very simple and basic points. What will be the impact, and we'll understand in a very basic way. Supposing there's a warranty period and I'm getting the part being replaced during the warranty period. What will happen? What will be the impact of GST on such replacement of parts and supply of repair services which is without any consideration as a part of warranty? Supposing I am given a warranty and the manufacturer is fulfilling the warranty, the parts are replaced and the services given during that warranty period, free of cost, whether it is any supply. So please understand that one thing that they are clarifying. Say there is a manufacturer and there is a customer. There's a supply happening. There's a supply of goods happening. GST was already paid. So on that particular supply of goods, GST was paid. Now after some time, there is parts replacement, warranty, replacement of parts, or during that warranty period, there is free service. So in that particular warranty period, there is replacements of parts or free repair services. If at all it is free, please understand that as there is no consideration, nothing, it's neither actual supply nor deemed supply. It is neither actual supply nor deemed supply. Also, please understand this is related to the first transaction. First transaction, certain goods were purchased. There was ITC being availed on those raw materials or inputs. Here also inputs are being used. Rather than writing raw materials, I'll use the term inputs. Certain inputs are there which are used for supply of goods. Certain inputs are there which are used for replacement of parts. Now understand that when initial supply was made, this was the initial supply. This was the initial supply. Inward supply, outward supply. When initial supply was there, manufacturer had to pay output tax and it can take input tax credit. There was actual supply and it can take input tax credit. Now on this free warranty replacement, what is happening is free replacement of parts or free warranty service during the warranty period. Manufacturer is not going to pay any output tax, but it can still take input tax credit. Mainly on the inputs or input services used for that free warranty replacement or free warranty service. So here very clearly you need to understand there is no outward supply. There's an outward supply where you are not going to pay output tax, or rather you can tell that this is an outward supply where it's not technically GST is payable, but on your inward supply you can still enjoy input tax credit. Why? Whenever there's a warranty, the manufacturer actually would have calculated earlier that what would be the warranty percentage, and it would have included in the cost at the time of first sale itself. So it is already included in the cost earlier. So why it is not so? Please understand that every company will have some statistics of knowing that how much would be the approximate replacements, and they would factor in that cost at the time of sale itself. So already GST is being paid. So when initial transaction happened, when there was actually supply of goods, manufacturer paid the output tax and related ITC it took. But when this free warranty replacement or free repair service during warranty, though it is not paying any output tax because it is free, it can still take ITC because that factoring in of cost would have been there. Whatever cost was incurred now, that would have been considered it earlier, and roughly the amount would have been included in the beginning itself when the goods are actually sold. So this is that. This is a very important understanding given by this particular circular. So this is all about your issue number 1 as well as issue number 2. Now, the next point is, what if the distributor comes in between? And what if, and this circular also clarifies that if at all it is free of cost, no GST. If at all you're charging anything, pay GST. So this circular clearly tells, if it is free, no output tax. If it is actually free, no output tax. If there is an additional consideration being charged, pay output tax. So it is as simple as that. You might end up paying output tax, you might not end up paying output tax. If it is free, no output tax. If you are collecting anything, pay output tax. So there may be output tax, there may not be output tax. So I'll just correct this chart. There may be output tax, there may not be output tax. There may be on your outward supply, which is there may be output tax, there may not be output tax. It may be free, or there may be additional consideration. If it is free, no output tax. If it is additional consideration, I may end up paying output tax. For free, obviously there is no output tax. If it is free, no output tax. And if it is additional consideration, I may have ended up paying output tax. So it depends, right? So that is clarified in first and second point. The third part of this is talking about now distributor is coming in between. What if distributor is coming in between? Again, the answer is pretty simple. If the distributor is charging something, if distributor is not charging anything, GST will not be payable. If the distributor is charging something, GST will be payable. Same thing only. So when we are talking about the first two issues, this is also clarified. So even if it is a distributor, it's the same thing. But interesting thing is the real situation. There is a manufacturer, there's a distributor, and there is a customer. So initially supply was done. So initially there was supply 1, supply to. Initially, manufacturer paid output tax, distributor took input tax credit. Distributor paid output tax. If customer is eligible, he would have taken input tax credit. If he is eligible, obviously satisfying the conditions. Now, there is a sale happening initially. Now there is replacement. There is a free warranty replacement or free service. Now things are changing. If at all, free warranty. Possibility number one. Possibility number one. Manufacturer is giving it free of cost to the distributor. Distributor is in turn giving it free of cost to the customer. So manufacturer gives free warranty parts first to the recipient, then the free warranty parts are given to the customer. Understand that there's no impact on output tax and input tax credit. That free warranty parts which are given by the manufacturer to distributor, there is no output tax. Free warranty parts by distributor customer, obviously customer and distributor have not got no obligation, there is no output tax. Now whether the related ITC manufacturer can take, though manufacturer is not paying output tax, we have already discussed. Though on this free warranty replacement he is not paying any output tax, he can still enjoy input tax credit. Why? The simple reason is manufacturer would have calculated what the amount of warranty would come approximately. It would have included already in the selling price when the goods are sold first time. So that being the case, second time will not be there. This is possibility number one. This is the first possibility. Case 2. Distributor himself directly replaces the parts. Free warranty replacement. And he is charging from this from manufacturer. Obviously he cannot charge from the customer because for him it is free. He is charging it from the manufacturer. Then output tax will be paid by the distributor. Output tax will be paid by the distributor. So this output tax will be paid by the distributor. And please understand that manufacturer can take input tax credit. This is case 2. This is case 2. Third option. Distributor is giving free warranty replacement of parts. Free warranty replacement of, which I am writing as free warranty parts. So free warranty replacement of parts. Free replacement of parts during warranty period. You can better call it as, instead of calling it as free warranty parts, the better term could be free replacement of parts during the warranty period. Now this time, this free warranty parts given by the distributor is out of the stock of manufacturer, not his own stock. He is having a separate track, is out of the stock of manufacturer. He is not going to pay any output tax because he is not going to collect anything from the customer or the manufacturer. But for this purposes, later on, this manufacturer will give credit note to the distributor, whereby manufacturer will reverse the output tax. Whatever tax he has paid, he'll reverse the output tax, and this distributor has to reverse the input tax today. Because it is credit note, whatever amount is payable by the distributor to manufacturer, that amount will be reduced. That amount will be reduced. So in that context, manufacturer will reverse output tax and distributor will reverse input tax. Rather, all these permutation combinations were there in normal cases itself. Now what is happening? What is happening here? In the first scenario, this free replacement of parts. Manufacturer is giving free warranty replacement of parts, sending the free warranty replacement parts. Then after receiving it, the free warranty replacement parts will be given to the customer. So first distributor will get it from the manufacturer and give it. So there will be no output tax to be paid by the manufacturer, no output tax to be paid by the distributor. And even ITC for the manufacturer, even for the free replacement of parts, will remain intact. Second scenario, distributor from his own stock. Distributor from his own stock will give free replacement parts and charge it from the manufacturer. So distributor now will pay output tax, and this charging is not from the customer, it is from the manufacturer. Manufacturer will take input tax credit. Third option, distributor has some old stock of manufacturer, so distributor will give free replacement parts out of the old stock of the manufacturer, and he will not collect anything from anyone. No collection. He will neither collect from the customer nor collect from the manufacturer, no output tax. But distributor will not incur anything from his pocket. So manufacturer, what he does, distributor tells the manufacturer that I cannot suffer any losses. So manufacturer gives a credit note, telling that no problem, for me you have replaced the free parts, now I'll give a credit note because you have replaced from the stock which was that of mine. So I have to bear that cost, I'm giving you a credit note. So rather than charging it from manufacturer, now manufacturer is giving a credit note. So when credit note is given, obviously manufacturer will reverse output tax and distributor has to reverse input tax today. So in all these three cases, one thing is common. Final incurrence of cost is by manufacturer. Distributor acts only as facilitator. And depending on what is happening, things are changing. So that is given in issue number 3 and issue number 4. All the three cases have been given. And if any additional consideration is charged, whosoever for anything being done, if at all there is any additional consideration by the distributor to the manufacturer or by the manufacturer to the customer, GST would be payable. So that is given there. So that is issue 3, issue 4 and issue 5 also, it's very clear. And the last point is, what about extended warranty charges? So this is a standalone point, extended warranty charges. So if at all extended warranty charges is paid at the time of original supply itself, when the supply is happening, you are paying initial warranty charges as well as extended warranty charges. Or other option is you are paying after original supply has happened, after original supply is over. If extended warranty charges is paid at the time of original supply itself, means in summary there will be selling price, add initial warranty charges, add extended warranty charges, etc, etc. Then this entire transaction is only one transaction. Then this entire transaction is part of composite supply, where the principal supply is that of sale of goods. Whatever is the tax on that goods will be there. So principal supply will be the supply of goods. It will be part of this entire composite supply. But if extended warranty charges is after original supply, which means now there will be only extended warranty charges. Say after 9 months of supply. Supply happened 9 months back. After 9 months, extended warranty charges is being charged. Then it is an independent supply. Independent supply. And separate rate will be there, and it is independent supply of services. Because on the invoice now there will be only extended warranty charges. Unlike the previous case where there will be selling price plus initial warranty charges, extended warranty charges, etc. etc. If at all it is given along with original supply, clearly it is part of the entire composite supply, and the principal supply is supply of goods, and tax treatment will be entirely based on that supply of main goods. But if it is given after original supply, say for example after 9 months you're going and telling that I want extended warranty charge, extended warranty also, and you're being asked to pay extended warranty charges to anyone, not necessarily the manufacturer, it may be manufacturer, distributor, or any third party. Then it is a total independent supply, separate supply, no connection with the original supply, separate invoice. It will be supply of services, rate will be that of warranty. So that is clarified in this issue number 6. So that is all about this lengthy circular. Now friends, talking about the amendment in documents, there's only one amendment, very basic amendment. Now the e-invoicing limit is reduced from 10 crores to 5 crores in terms of your rule 48 sub rule 4 with effect from 1st of August 2023. So e-invoice is required if your aggregate turnover in any of the preceding financial year, right from 17-18 onwards. So for example, when you're talking about your e-invoice limit for financial year 23-24, be it 17-18, 18-19, 19-20, 20-21, 21-22, 22-23, any of the 6 preceding financial year, if your aggregate turnover is more than 5 crores, your e-invoice is required with effect from 1st of August 2023. That is the first point. And second point, again, a circular regarding e-invoice. There were certain doubts. What if the supply is made to government departments who are registered in GST only for the purpose of TDS under section 51, which means you're talking about you are making supply to government and they are not properly registered in GST. They are having only GST TDS number. They don't have proper GST IN number. They have GST TDS number. Now understand that e-invoice is basically required for B2B supplies. Now the question is, these government departments who are registered for the purpose of only GST TDS number, are they considered as registered person? And the circular clearly points out that even they are considered as registered persons, because when you see the registration list, and it basically comes under compulsory registration section 24 when you're talking about TDS registration, they are also registered, though they don't have normal GST number, they have GST TDS number, but in the fact is they are also registered person, and therefore when you are supplying to government department who are having only GST TDS number, that also will attract e-invoice. For that also you have to generate e-invoice. So e-invoicing will be mandatory. Obviously the turnover is crossing that 5 crores limit that we have discussed earlier. So these are the amendments when you talk about your document chapter. Yes friends, now let us discuss about your amendments in registration chapter. Certain important amendments are there here. Now the first amendment is there in your section 23, where section 23 subsection 2 talks about notwithstanding anything contained in subsection of section 22(1), that is turnover based registration, and section 24, which is compulsory registration. Now it has been clearly mentioned that when it comes to section 22 and 24, 24 will override section 22. So 24 is more powerful than 22. And when it comes to 23 and 24, specifically when it comes to notified cases of 23 and 24, it is evidently clear that 23 will prevail over 24. So if at all you want to talk about the powers of the section, it is section 23 which talks about no registration. Then it is section 24 which talks about compulsory registration. Then it is section 22 which talks about turnover based registration. So here you're talking about no registration, turnover based registration. Sorry, here 24 is all about your compulsory registration, and it is turnover based registration. So section 24 prevails over section 22. Now it is evidently clearly mentioned that section 23 subsection 2 notified cases of section 23 will prevail over section 24. And to give you an example, say for example that is a hospital which is engaged in exclusively making exempt supplies. So in terms of your section 23, it doesn't require any registration. But assume that there is one of the inward supply which attracts RCM. Now it is evidently very clear that normally if it is the question is not clear, you might end up feeling that now whether I have to take compulsory registration for that hospital because one of the expenses is advocate services which attracts RCM, or I should see only outward supplies because entirely outward supply is exempt supply. So the fight is between section 24 compulsory registration if you see inward supply RCM and section 23 no registration because the entire outward supply is exempt supply. Now it is evidently made clear that section 23 will prevail over section 24. That hospital need not take registration even if there is one of the inward supply which is attracting RCM, because 24 is not going to prevail over 23. It is 23 which is going to prevail over section 24. That is the crux of this amendment. Now talking about the other amendments, one more notified case has been added in section 23 subsection 2 by terms of notification 34/2023 CT. There's a list of notified cases in terms of section 23 where you do not take registration. In that they have added one more case. Now what is that particular case? It is all about supplying goods through ECO. If at all you're talking about supply of goods via ECO, where the ECO is liable to collect TCS under section 52. Prima facie, if you see when you're supplying goods via ECO where TCS is going to be applicable, 24 tells it is compulsory registration. But now they have given a relaxation under section 23, notified cases, notification number 34/2023. It tells that if your aggregate turnover is up to the threshold limit, which is not liable for registration in terms of section 22, which means your aggregate turnover is up to 40 lakhs or 20 lakhs or 10 lakhs depending on the state you are. But the important point here is that aggregate turnover normally you check of current year, but here for some reasons they have given aggregate turnover you should check both for preceding financial year and current financial year. In all other notified cases of section 23, they focus only on turnover based concept of current year, but here suddenly they talk about if you're supplying goods via ECO where TCS is applicable, prima facie 24 tells compulsory registration, but now there's a relaxation where you can go for turnover based registration, but that turnover you have to check both for previous year and current year. So here the point that they have added preceding financial year is a very special point which is not there in any other notified cases in section 23, and they give some list of important conditions, and the conditions are very basic conditions. If at all you are taking this benefit, you should make sure that you are not having any interstate outward supply of goods. You should make only intrastate. Even if it is through ECO, it should be only intrastate. You should not make supply through ECO in more than one state, and when you're making such supplies through ECO, you should get an enrollment number. So condition number 3, 4, 5 something, but get an enrollment number, which indirectly means that first you should have a PAN number, and on the portal you have to give your PAN number, address and the state. So first you should have a PAN number on your portal. Please give your PAN number, address and retail address and state subject to validation. Then you will be getting an enrollment number on successful validation, and you have to also make sure that you are having this enrollment number only in one state. So they tell that you should not be having interstate supply of goods. Second, they tell that you should not be supplying through ECO more than one state. You should have that only in one state. Then they talk about enrollment number. So all these points are actually basically about enrollment number. All the other points are basically about enrollment number. For the enrollment number, you should have a PAN. You should give your PAN address and state on the portal. After validation, you'll get an enrollment number. And they also tell that you should not have more than one enrollment number in that state. So you can work only in one state, that too only with one enrollment number. And ECO should not allow you supplying the goods without enrollment number, which means you can start doing your business through Eco only when you get your enrollment number. And final also, once you cross the limit of 40 lakhs, 20 lakhs, 10 lakhs, and you take registration in terms of section 25, automatically your enrollment number will become invalid. So basically they talk about only three things. One, first is it is all about your turnover based registration, but surprisingly here they talk about turnover of previous year you have to check, also in current year. Then they tell you should not be making interstate supply of goods. You should not be dealing in more than one state through Eco. So you should make sure that you're supplying through Eco only in one state. So now they suddenly tell that you should be working on only in one state, not having interstate supply of goods. All the other points are talking about enrollment number. How to get enrollment number? Have a PAN, give that PAN address and state on the portal. After validation, you will get enrollment number. In one state, only you can work, and that too in one state you can have only one enrollment number. And after you cross the limit of 40, 20, 10 lakhs in current year, and when you get registered under section 25, your enrollment number will not be valid. So basically that particular points are given. Now, when you talk about the other amendments which have come out in your registration chapter, the next amendment has come out in your Rule 8, Sub-Rule 4B, which talks about biometric based Aadhaar authentication. Biometric based Aadhaar authentication. They talk about a scenario, even if you are going for registration by opting for Aadhaar authentication, in certain states you have to go with biometric state Aadhaar authentication, which means that even though you're applying for registration where you are authenticating your Aadhaar, but if you're a risky category SSC, you will be having you should go through the process of biometric Aadhaar authentication just the way you got your Aadhaar card in the beginning. You should go at a notified center, and that in that notified center again you should do biometric verification. Your photograph will be taken, eye retina scan will be done, thumb impression will be again taken, your original proof should again be shown. The same process when you took the new Aadhaar. So this is for risky category SSCs where you have your Aadhaar is linked, but that is doubtful category. So the system tells that this Aadhaar may not be proper. Therefore, you have to go through again biometric Aadhaar authentication, and that is only applicable when you are covered by risky category. If the portal shows that this SSC might be potential risky SSC. Now, this Aadhaar based biometric based Aadhaar authentication is there only in certain states. Initially, it was applicable only in Gujarat. Now they are telling that this biometric Aadhaar authentication will have in two states. We'll have it in Gujarat and will also start in Puducherry. So it's this biometric based Aadhaar authentication was started in Gujarat as a pilot project. Now they have started in Puducherry. Slowly they'll expand the application of biometric based Aadhaar authentication. That is all about Rule 8, Sub-Rule 4B. Now they have made an amendment even in your Rule 9, Sub-Rule 1, where they talk about physical verification in your place of business. What they have said that normally previously if you see the wordings, physical verification is required if at all you are not opting for Aadhaar authentication, or you're opting but it is not successful, or you're opting, it is successful but you are covered by risky category, then physical verification of business premises will be there, place of business will be there before the registration is granted. In three cases. What are the three cases? You don't opt for Aadhaar authentication, you opt but it is a failure, you opt, it is successful but you are covered by risky category, and that risky category is applicable only in the state of Gujarat as well as Puducherry. In that case, whenever physical verification was undertaken before GST number was granted, that is GST-IN, GST identification number was given, initially they said that it would be in the presence of the said applicant. Now they have said that there is no need of that applicant. They will come for physical verification. That applicant may not be there, even someone else can be there in instead of that particular applicant. So in the presence of said person is being removed. Now, another important amendment in your registration part is there where they talk about Rule 10A, giving the bank account details. Now please understand that in Rule 10A, they are talking about what exact scenario. They are telling that in case you get your GST number without giving your bank account details because your current account has not been opened yet, which is allowed. Normally, when you apply for registration, they expect you to give your bank account number. But if you don't have your current account number, don't worry. You apply all the other documents, get your GST number, go and open a bank account, again come and update your bank account details on the GST portal. Before the amendment, they focus that you have to update that within a particular time, within 45 days from the date of grant of registration, or from the date you file your main return under section 39, whichever is earlier. If you don't update within that date, the registration given can be suo motu cancelled by the proper officer. So you have got your GST number on a trust that you will be updating bank account within particular time, and if you don't update within that particular time, again the GST number which is given can be suo motu cancelled by the proper officer. Now what is the amendment that they have done is they have changed the time limit. The time limit is now changed to 30 days from the date of grant of registration or due date of outward supplies written under section 37, which is your GSTR1 or IFF, whichever is earlier. Within that time you have to update the bank account. Within that time open the bank account and update the bank account details on the common portal. Which means if you have got your registration on say 15th of August, see it is date of grant of registration. Right. Now they are expecting that within 30 days of date of grant of registration or due date of GSTR 1 or IFF, invoice for issuing facility, whichever is earlier. Now 30 days of date of grant of registration is 30 days from 15th of August, which would end here. August will have 31 days. So 14th of September or due date of GSTR1. August month GSTR1. Assume that you don't have IFF and assume that you have GSTR1. Right? Assume that you have not gone for quarterly QRMP scheme, you have gone for MRMP scheme. So it would be your due date of, I'm only going with GSTR1. For August it is 11th September, whichever is earlier. So you have to update the bank account details within 11th of September. If not, the registration number which is given to you is liable for cancellation. So what is the time limit? 30 days from the date of grant of registration or due date of your GSTR1 or IFF. In this case, we have assumed that this associate has gone for MRMP scheme. IFF is there only in QRMP scheme, whichever is earlier. You have to, within that time, the moment you get your GST number, go run to bank, open the bank account, current account, come back to portal and update it. If not done within this time, the registration number which is given is liable for suo motu cancellation by proper officer. Now, one more thing that they have done in your registration chapter, they have added one more reason for mandatory suspension by officer in terms of Rule 21(2)(a). See, in the case of suspension, there are three categories. Suspension when cancellation is initiated by SSC, suspension when cancellation is initiated by officer, and suspension by officer in certain mandatory cases. Now that mandatory cases initially was only one particular point. Now what was that one particular point? This particular point was on comparison of when you are checking the portal, right? Either your outward supplies in GSTR1 is more than GSTR3B, or your input tax credit is more in GSTR3B compared to GSTR2B, or you have not filed your returns. There are significant differences or anomalies leading to cancellation. That significant differences or anomalies are generally your output tax is more in 1 than 3B, your input tax credit is more in 3B than GSTR2B, or you have not filed your returns when officer sees the return. These three cases were there. Now they have added the fact that if at all you have not updated the bank account details within the new time limit given under Rule 10(a), then your registration is liable for mandatory suspension. The registration which is given is liable for mandatory suspension. So in addition to it, they have added a fourth point. You have not updated your bank account details within the time limit given under Rule 10(a). Right. So first point number A contains three subcategories. What are the three subcategories? When the portal is being seen, there are significant differences or anomalies in your output tax 1 versus 3B, or input tax credit 3B versus 2B, or non-filing of return. Now they have also added a point number B, telling that you have not updated your bank account details within the time given in Rule 10A. Then there will be mandatory suspension of your return, and you have to explain the reason for such differences within 30 days. Otherwise, cancellation will proceed. Already cancellation is started. Mandatory suspension cancellation will start on the same date. Otherwise, finally, it will result in cancellation. They will give you 30 days time. Normally, when normal cancellation is initiated by the proper officer, you get a notice for which you have to reply within 7 working days. Here, you'll get an intimation. Here, you're going to get an intimation. So, for this particular intimation, you need to reply within 30 days. So that's the difference. Normally for cancellation, you get a notice and you reply within 7 working days. Here, for all these cases, you are going to get an intimation. And these differences, anomalies, or non-compliances, you have to explain within 30 days of intimation. So that is the amendment. The amendment areas, they have added in the list of mandatory suspension, non-updating of bank account details. Also, when they have added this, they have also amended third provision, so Rule 21A sub Rule 4, where they tell that if at all mandatory suspension is started because of non-updating of bank account details, the registration is suspended because of what? Because of non-updating of bank account details within the time limit of Rule 10A, and the registration is not yet cancelled, which means the process is going on. Suspension has happened, but cancellation is not yet done. And in the meanwhile, you have updated your bank account details. Then suspension is deemed to be revoked. So it is very, very clearly telling that if at all we started your mandatory suspension because of non-updating of bank account details, which is a new addition in mandatory suspension. The process is going on. It is not yet cancelled. Your registration is not yet cancelled. The process is going on. In the meanwhile, you update your bank account details. Then the suspension which happened is deemed to be revoked. Automatically, there will be revocation of suspension. So that is automatic revocation of suspension. There are 2 cases of automatic revocation of suspension. Mandatory suspension started because of non-filing of returns. You have filed all your returns, automatically suspension is revoked. Mandatory suspension, now it can be done because of non-updating bank account details within Rule 10A time period. Now it is updated. Suspension has started, but cancellation is not yet. Now it is updated. Your suspension is automatically revoked. Now, finally, when you're talking about your suspension, rather, not your suspension, so these amendments are in your suspension. Finally, when you're talking about revocation of cancellation in terms of section 30, read along with Rule 23 sub Rule 1, there are certain important amendments. Now, if I tell the summary of amendments, they have changed the time limit. They have removed the time limit from the act. They are telling that now the time limit will be discussed in the rules. And in the rules, they have changed the time limit. Earlier, the time limit for application for revocation of suspension was 30 days and plus extension was first extension 30 days, second extension 30 days. Now the time limit itself has been increased to 90 days. So earlier it was 30 days, then plus initial time limit was 30 days. Basic time limit was 30 days. Then further extension was another 30 days by additional commissioner, joint commissioner. Then for another 30 days by commissioner. Now that was all given in act. Now they have brought everything in rules. Now they are telling that this time limit of 30 days plus 30 days plus 30 days, we will change the time limit. Now it is not discussed in act, it is discussed in rule. We'll change it to 90 days. So revocation can be applied within 90 days of order of cancellation, and there can be extension if there is a sufficient cause for the reasons recorded in writing, where commissioner can extend it or any other authorized officer can extend it not below the rank of additional commissioner, joint commissioner, which means 90 days is a basic time limit and extension can be there either by the commissioner or any authorized officer not below the rank of additional commissioner, joint commissioner for a further period not exceeding 180 days. So if you see the amendment, here it was 30 days, 30 days, 30 days. Additional commissioner, joint commissioner, commissioner. and all these things were mainly given in act and something were given in rules. Now everything is given in rules. So they have delegated this entire time limit discussion only and only in rules. And they have changed the time limit. Time limit is 90 days plus maximum 180 days by either commissioner or an authorized officer not below the rank of additional commissioner, joint commissioner. So time limit has changed. Basic time limit itself for application for revocation of cancellation is changed to now 90 days. The entire thing is discussed only and only in rules, not in act. Act has delegated the entire thing to rules. An extension 180 days either by commissioner or authorized officer not below the rank of additional commissioner, joint commissioner. So that is there in your section 30 read along with rule 23. Also they have amended your rule 25, which is all about your physical verification of business premises. Earlier there was some confusion with respect to two things: physical verification, when it has to be done, and if it has to be done, whether it is before the grant of registration or after the grant of registration. So earlier things were there but not so clear. Now what have they done? They have made things very clear. Categorically they have made things very clear. So first they have said that physical verification before grant of registration, this was actually already there but not so very clear. There was some confusion in the wordings. Now they have said that physical verification before grant of registration will be there either if Aadhaar authentication is not opted, or it is opted but it is failed, or when you are talking about risky categories, which means Aadhaar authentication is opted but successful, but it is a risky category, which is there in Gujarat and Puducherry. Now they have made sure that your rule 25 is in line with rule 9, and it is very clear that physical verification need not have the main person in charge need not be there at the time of physical verification, and even time limits have been made very clear. A physical verification now, mandatory physical verification before grant of registration is required in 3 cases. Aadhaar authentication is not opted but failure, opted successful but risky category, which is now there in Gujarat and Puducherry. So they talk about the first type of physical verification, which is before grant of registration. Physical verification before grant of registration, which means mandatory physical verification. Mandatory physical verification. Physical verification before your grant of registration, before registration is granted, is nothing but mandatory physical verification, which is applicable in 3 cases. 1, Aadhaar authentication is not opted, or Aadhaar authentication is opted but it is failure, or Aadhaar authentication is opted plus it is successful but it is a risky category when you talk about Gujarat and the state of Puducherry. Now in such cases, the time limit for the officer to complete the work, assessee will make an application within 30 days from the date he is liable, and officer will have 30 days time to either accept and give the registration or give show cause notice. So proper officer basically has got 30 days time. Now first thing, it is a mandatory physical verification. Second thing, proper officer will have 30 days time for doing his work, either to grant registration or to give show cause notice. In such a scenario, they have made it categorically clear that in such a case, the officer who is doing physical verification has to give the verification report along with the documents and photographs in a particular form REG 30 at least 5 working days before the last date, which means when this 30 days is going to get over, before that before the time limit of 30 days is getting over, minimum 5 working days before the last date, that is before that 30 days is going to get over, officer should complete his physical verification. So please understand. In 3 cases, there's mandatory physical verification. You don't opt for it. You opt, but it is not successful. You opt, it is successful, but risky category in Gujarat and Puducherry. When you're doing that, officer will have 30 days time either to grant registration or give show cause notice for second innings. Now, either to grant registration if it's satisfied or give show cause notice. He is having 30 days time from the date of Aadhaar authentication being successful. If Aadhaar authentication is opted, successful but risky category, or if it is Aadhaar authentication is opted but it is a failure, within 15 days of submitting registration form, from that time you add 30 days, or if it is not at all opted, from the date of filing the registration form, which is 30 days time. It is actually 30 days time officer is having. Starting point will be different in each of the cases, but 30 days time. Once the main work is over, 30 days time officer will have to grant or to give show cause notice. Now he has to come in within this time, he has to complete physical verification and take a decision. Now he has to do that physical verification. He has to submit a verification report along with documents and photographs at least 5 days before this 30 days is getting over. So in case of mandatory physical verification, which is there in 3 cases, officer will have 30 days time either for grant of registration or to give show cause notice. Now what are they expecting from the officer is, within this 30 days officer has to either grant or give show cause notice. Now what is their expectation? So 0 and 30 days. Now they are telling that at least 5 days, before, minimum before 5 days, minimum before 5 days is 30 days is getting over, you have to submit your verification report along with documents and photographs. Then this is the first thing that you have to do. In the last part, you either grant the registration or give show cause notice. So basically within this 30 days time, you have to do two things. One, complete the verification. Minimum before that 30 days is getting over, whatever is the last date, minimum 5 days before that, complete the physical verification, give the verification report along with documents and photographs. Then either grant registration if it's everything is satisfied or give show cause notice. This is the scenario. And in the other case where physical verification is after grant of registration, which means in other cases, the verification report along with documents and photographs should be uploaded in GST REG 30 within 15 days of verification. So please understand, in other cases, it is optional physical verification. It is not mandatory. It is optional physical verification. So it is not mandatory. Other than these 3 cases, it is actually optional physical verification. So when you talk about your optional physical verification in other cases, please understand there is only one work which needs to be done. You're only talking about one work which has to be done. And what is that work? You can decide at any point of time that what you are required to do. Whenever you do physical verification, so by whatever time you do physical verification, within 15 days, within your time limit of 15 days. First, it is not mandated, it is optional. Within time limit of 15 days, make sure that you submit the verification report along with documents and photographs. So now this mandatory physical verification is required before grant of registration in 3 cases, and this is after grant of registration. If it is after grant of registration, he can do at any point of time. You start physical verification. You go and start physical verification. Within 15 days, when you decide that you are going to come for physical verification, the moment you do physical verification within 15 days, update the verification, upload the verification report along with documents and photographs. So once you have done the physical verification within 15 days, upload the verification report along with documents and photographs. So that's all about this amendment. So they have given a clarity with respect to physical verification in Rule 25. Categorize them into two cases: mandatory physical verification in 3 cases, which is before grant of registration. And in that scenario, you have to, officer is having 30 days time either to give the registration or give show cause notice, and 5 days, minimum 5 days before that the time limit of 30 days is getting over, first he has to give physical verification report along with documents and photographs, and in the last portion he has to do this action: give registration, grant registration, or give show cause notice. The other is a case of optional physical verification in other cases, which is after grant of registration. The moment you do physical verification, within 15 days, upload the verification report along with your documents and photographs. So that is everything about your amendments in registration chapter. Yes friends, now let us discuss about the amendments in your payment chapter. There's a new rule brought out called as Rule 88D, which talks about excess ITC in terms of your GSTR 3B versus 2B. So there is an excess ITC that you have claimed in GSTR 3B compared to what is available in GSTR 2B. This is very similar to what is already discussed in your Rule 88C, where it is all about your GSTR 1 versus your GSTR 3B. The only difference is in Rule 88C, the focus is on your outward supplies, and this new Rule 88D, the focus is on inward supplies. So very similar to Rule 88C, they have brought out Rule 88D. What if your input tax credit claimed in GSTR 3B is more than what is available in GSTR 2B by such amount and such percentage as may be prescribed? So they do have a tolerance limit, so they will decide on the tolerance limit. If it is exceeding that tolerance limit, then what will happen? In that case, you will be getting an intimation in part A of GST DRC 01C. You will get an intimation on the common portal, and that will highlight the differences. In simple language, you will get an intimation. There's a form in which you will get that intimation. That is GST DRC 01C. Part A will be intimation. Now, that intimation will ask you to do two things: either pay that amount through DRC 03 or explain the reasons for that difference. Either pay or explain us the difference. In simple language, if your ITC is more in 3B than in GSTR 2B, you'll get an intimation. You have two options: pay or explain. And that has to be done within a period of 7 days. Now, this is the action initiated by the officer. This registered person who is getting that intimation has got two options. First option, pay that amount with interest, fully or partly, and after paying that amount, you have to again revert back to that intimation that I have paid that amount fully or partly. Part B of same form, GST DRC 01C, pay that amount and give reply to intimation that I have paid the amount with interest, or give reply again why I am not paying that amount in same part B of form GST DRC 01C. So officer will give part A GST DRC 01C, and registered person will reply in part B GST DRC 01C. Officer will give that there's a difference in ITC between 3B and 2B. You have taken excess ITC. Assessee either has an option to pay and reply in part B, or explain the reason, again reply in part B. Now, if that amount is not at all paid and no proper explanation is offered, but also if it is offered but it is not acceptable, so which means you have not taken action or your action is not acceptable, which means either you are not paid or you have not replied or you have replied but it is not satisfactory. Then officer will proceed to take action by giving notice under section 73-74. This is very similar to what is there in your rule 88C. The only difference is in rule 88C it talks about direct recovery. There is no concept of notice given in section 73-74, then giving order, then talking about recovery. So that is direct recovery. After this intimation, directly recovery, no notice, order and all. But in rule 88D, which is new rule which talks about your ITC difference, no direct recovery. After this step, they will go to section 73-74 notice, then it is recovery. So here, when you talk about your rule 88C and your rule 88D, rule 88C talks about your outward supply output tax 1 versus 3B, GSTR 1 versus GSTR 3B. Here it is inward supply input tax credit 3B versus 2B. The other differences in rule 88C, there is no concept of show cause notice, demand order and all. Directly there will be recovery. Whereas in 88D, there will be first show cause notice and demand order, which is under section 73-74. Then if at all you get an order and you don't take any action, you don't pay, don't go for appeals, then there will be recovery under section 79. So there's a key difference in the way it functions. Right, this is all and all about your output tax differences, and this is all and all about your input tax credit differences. So that is an amendment which is brought out. Now the next point is basically clarification with respect to your wrong availment and utilization of credit for the purpose of interest, which means we are talking about interpreting two provisions together. Rule 88B, which is wrong availment of credit, read along with section 50 subsection 3, which is all about interest. Right, so the question is, if at all there's wrong availment of IGST credit and you reverse it, but still when you're wrong availing that credit, there's a balance input tax credit in CGST and SGST. So balance credit is there. If you see IGST head, there's no credit. But if you see CGST, SGST head, there is a credit. Should interest be paid? Say for example, you've wrongly availed the credit of IGST ITC to the extent of 1 lakh while filing April month's GSTR 3B. You realized it. You rather have utilized it also, but you reversed the wrongly availed IGST input tax credit to the extent of this 1 lakh rupees while filing your December month's GSTR 3B. The point here is, in this point of time, your IGST credit is wrongly availed and wrongly utilized. Your IGST credit is 0. But you have balance credit in CGST, say 75,000, and say SGST, say 75,000 during this point of time. So minimum balance, minimum. Obviously CGST credit, SGST credit is more than 75,000 each during all points of time, but minimum it was, the lowest point was 75,000. Now, technically speaking, interest is applicable when you've wrongly availed and utilized the credit. So if you see IGST credit, you've wrongly availed that 1 lakh credit and utilized it also. The reason is, when you talk about credit utilization, first IGST credit will be fully utilized for IGST output, then for CGST output, SGST output in any ratio. So, in spite of the fact that you don't want to touch IGST credit for CGST output and SGST output, you have to use it because of the utilization formula. And because of the utilization formula, you have minimum balance of CGST credit and SGST credit 75,000 each during this entire span of time, right from your April till December. Which means, technically speaking, IGST credit is wrongly availed and utilized. If you see only IGST head, IGST credit is wrongly availed and utilized. Is wrongly availed and wrongly utilized. Interest should come. But if you see overall credit, IGST credit was wrongly availed but not wrongly utilized. Because utilization of IGST credit was by force. I did not want to use IGST credit. IGST credit was used for IGST output, then for CGST output, CGST, SGST output, any ratio, any proportion. So only after I use IGST credit, I can touch CGST credit, SGST credit. So my CGST credit, SGST credit, which is pending, is because of that formula. Otherwise, I may not have touched that IGST credit. Now, if I see overall credit balance, that 1 lakh rupees is wrongly availed but not wrongly utilized, therefore interest will not come. So this circular has clarified that we will go with this entire overall concept, especially when it is pertaining to IGST credit. Reason is, for your IGST credit, the utilization formula is such that you have to use IGST credit for IGST output. If there is any balance, use IGST credit balance available for CGST output, SGST output in any ratio, any proportion. And only when your IGST credit becomes zero, you can touch CGST credit, SGST credit. Which means there's a high possibility that wrongly availed IGST credit has to be utilized fully. And if you've wrongly taken that credit, utilization would have been done. But when you're talking about IGST credit, this circular logically has said that no. This wrong availment and utilization concept we will see on total basis, especially if it pertains to IGST credit, and not only seeing IGST portion. So if you see total portion, wrong availment of credit was in April month, and that was reversed in December month. You availed it but you reversed it. Wrong, and the amount was 1 lakh. And till December, my credit balance was more than 1,50,000. So no interest will come. No interest will come. I will see in total basis. And it may happen that my credit balance in CGST credit, SGST credit might have gone down to 0 rupees somewhere in November month. So interest will start, but interest will start only from November month filing of 3B, not from April month 3B. So that difference is clearly, that circular is very, very clear. Even if interest comes, it will be when the total credit becomes zero utilized. Not, I'm going to see only IGST credit balance. So this is a beautiful analysis of this circular, very logical circular. With respect to IGST credit, wrong availment, wrong utilization, don't only see IGST credit portion, see the total portion, because the utilization formula is such that you have to make IGST credit balance zero, then only touch CGST credit, SGST credit. But the same thing cannot be said for compensation cess. Now, if I've wrongly availed and utilized CGST credit, SGST credit or IGST credit, but still I have a great balance in compensation cess, whether interest will start? Yes. Now your interest will start. My balance in compensation cess is of no use. My any balance in compensation cess is of no use, because compensation cess credit can be used only for compensation cess. So if I have wrongly taken CGST credit, SGST credit, IGST credit and used it, interest will start. Even if there is crore of rupees in compensation cess, it will not change an answer, because compensation cess credit is restricted only to compensation cess output. Therefore, here interest will start. Utilization of compensation cess is only against compensation cess. So if you have wrongly taken IGST or CGST or SGST credit and utilized it, there your interest will start. My compensation cess credit balance will not be taken into account. I will not be taking into account my compensation cess credit balance. There it is normal thing. I'll ignore compensations. Even if there is hundreds of crores or 10 of crores or crore rupees balance in compensation cess credit, I'll ignore it. I'm not going to see it. The sad part of the circular is it has spoken about IGST credit, wrong availment and utilization, and CGST credit, SGST credit, IGST credit, wrong credit and wrong availment and utilization with compensations as credit balance being there. But it has not spoken about few scenarios where issues will come. So I've given that as author's note. What if CGST credit is wrongly availed and utilized? So how I'm going to see? So it has not spoken about situations which may arise later. Say for example, you're talking about wrong availment of CGST credit and wrong availment of SGST credit and utilize. In that scenario, what will happen is not at all discussed. So ideally, it should have also been discussed, but it has not been touched upon. So we are not, obviously questions will not be asked from this area, but you have to understand that this circular does not cover all the possible scenarios. It covers basically the base scenario where IGST credit is wrongly availed and utilized. And compensation cess is by default understandable, so we'll not touch that. It does not talk about CGST credit and SGST credit. So that is all about this particular circular. Yes, now talking about the amendments in written filing chapter. Basic amendments are there in written filing chapter, and the main amendment being there's one common point which has been amended in many sections, be it section 37 for your GSTR1 or IFF, or section 39 for your GSTR3B, GSTR4, 5A, 6, 7, or be it section 44 for your GSTR9 along with 9C and 9A, or be it section 52 for GSTR8 and GSTR9B. In all these cases, there's one amendment that you cannot file your return after 3 years from the due date of such returns. So there's only one such return which you can file even after 3 years from the due date of return, which is technically GSTR 10. So basically all your returns, be it GSTR 1, 3B, 4, 5, 6, 7, 8, 9, read along with 9C. When you cannot file, obviously 9C cannot be filed. 9B. After 3 years, after 3 years of their due date, you cannot file your return. Now you may wonder what is pending in this list. What is not there in this list? Invoice furnishing facility is not there in this list because it cannot be filed after due date. CMP 08 is not there in this list because it is basically a quarterly payment form for composition scheme dealer. So you have IFF not in this list. You have CMP 08 because it is for payment form. You have GSTR 10 not in this list, which means final return you can file even after 3 years of your due date, you can file that. So you have IFF, CMP 08, GSTR 10, you have even GSTR 11 UIN, because basically UIN return is to be filed only at the time of applying for refund of tax on inward supplies. You have ITC 04. In all these cases, this point of non-filing of returns, which is after 3 days of after 3 years of due date, even then you can file. So IF basically after due date you cannot file. CMP 08 payment form, it doesn't make any difference. 10 you can file even after due date, 3 years of your due date. 11, basically there's no due date for GSTR 11 because it is filed at the time of refund application. ITC 04 you can file even after 3 years of due date. So that is the first amendment which is there in many such sections. Now you do have amendments for your GSTR 1 IFF, where you're talking about your Rule 59 6E and Rule 59 6F. They have been added now. Now Rule 59 6E is related to your new rule which has been added, which is Rule 88D, which talks about difference between ITC when you compare your GSTR 2B and 3B, which means ITC in GSTR 3B is more than 2B. And till you give a reply or till you make the payment, your IFF or GSTR 1 will be blocked. Now understand these points. Basically, you cannot file your GSTR1 or IFF if at all you have got a notice under Rule 88C. Now it is also connected to Rule 88D and Rule 10A. If you get a notice, Rule 88C point was already there. If you get a intimation, basically not a notice, intimation for your outward supplies in GSTR1 being more than 3B. Now they have added your input tax credit in 3B is more than ITC in 2B, or you have not updated your bank account details within time limit given in Rule 10A. Non-updation of bank account details. So please understand there were restrictions in filing of your GSTR1 because of other reasons not connected to non-filing of GSTR1 and 3B. So these other reasons included, there was only one other reason, that 88C was there. If your output tax is more in GSTR1 compared to 3B, you'll get an intimation and you have to either reply to the intimation or pay the difference. If you're not doing anything, your GSTR1 and IFF is blocked. Non-updation of bank account details within the time limit given in Rule 10A. Now, along with this particular point, 88C, which was already there, they have added 88D and Rule 10A, that here you'll get an intimation, by the way. Here you'll get intimation. Here you'll get intimation. Now, they are basically telling that if you get an intimation under your Rule 88C, because your output tax is more in GSTR1 compared to 3B, or now 88D, your input tax credit is more in 3B compared to 2B, or you have not updated your bank account details within the time limit given in Rule 10A, then you cannot file your GSTR1 or IFF. If you cannot file your GSTR1 IFF, obviously, though it is not mentioned here, obviously it is an connected point that you cannot even file your GSTR3B. Now you can file it. You can file it either if you have given a reply or made the payment. For Rule 88C, even same true for you have given a reply to the intimation or paid that difference for Rule 88D, or you have updated your bank account details. If you do that, till you do that, you cannot file your GSTR1 or IFF. Once you do that, once you reply or pay the difference, pay the amount in the intimation in 88C or 88D, or once you update your bank account in terms bank account, though even it is after the due date of updating bank account in Rule 10A, but you update the bank account later, then you can file your GSTR1 or IFF. And when you can file your GSTR1 or IFF, obviously you can also file your GSTR3B. See, basically the restriction is only given with respect to GSTR1. 3B is an connected point. So if you get an intimation 88C, now they have added 88D, also not updating in the bank account within Rule 10A, then you cannot file your GSTR1 or IFF. But if you get an intimation, but you reply or pay the difference as per 88C, or reply for intimation of 88D or pay that amount, or update the bank account details though it is late, then you can file your GSTR1 or IFF. So that is the amendment which is brought out in your Rule 59.6C and Rule 59.6F. Now understand that in Rule 64 they have corrected the terminology. Rule 64, which is a written filing form for your person supplying OIDRS services, online information database and access and data services, from a place outside India. Initially the language here was person who's supplying OIDRS from a place outside India to unregistered person, a person other than registered person, which means unregistered person in India. Now they have changed it to non-taxable online recipient, because the meaning of non-taxable online recipient itself is now a person who is not registered. It is in sync. Basically, OIDRS services from outside India to non-taxable online recipient was the point. But when you see the written filing point, they would have mentioned person supplying OIDRS from outside India to unregistered person in India should file 5A. Now they have removed that anomaly. They have removed the term to a person who is not registered. They have written to non-taxable online recipient. And when you see the updated definition of non-taxable online recipient means a person who is not registered. So now it is all in sync. So that's only a correction. You cannot expect any questions from here. Also, there's an amendment in your rule 67. The previous point was all about your 64 GSTR 5. Now it is rule 67 TCS written GSTR 8. TCS written by ECO. Now please understand that a person who's supplying goods through ECO, where TCS is applicable, even that person can be unregistered person. Now ECO will pay TCS and the opposite person will get that in his cash ledger. ECO will pay by cash ledger, opposite person will get by cash ledger. But please understand the fact that now such supplier who's supplying through ECO may be unregistered, and ECO will also file in his GSTR 8 about that unregistered person who's not having registration number but having only enrollment number, because he's supplying goods through ECO. He's supplying goods through ECO, but TCS is applicable, but still that supplier of goods can be unregistered person but having only enrollment number in terms of section 23 right along with notification number 34/2023. So that is a possibility that you are supplier of goods, you are supplying through ECO, TCS is applicable, but still you are unregistered. As ECO, you have to file that details also in GSTR 8. So those details will also be filed by ECO in GSTR 8, but the opposite person will not get it because the opposite person is unregistered. So they have mentioned the fact that the details of TCS under section 52 furnished by ECO will be made electronically available to each of the registered person. Because if the opposite person, if the supplier is unregistered, ECO will not collect TCS, and if ECO is not going to collect TCS, he is not going to get in his cash ledger. So they have just made a correction. Now a supplier who is supplying goods through ECO, that is, and where TCS is applicable, there is a possibility that he can be unregistered. Now when he is unregistered, ECO will file the details in GSTR 8 even though he is unregistered, but ECO will not collect TCS. Because the supplier is unregistered, ECO will not collect TCS. But the details will be furnished by ECO in GSTR 8, and as the opposite person is unregistered person, he will not get the corresponding details. So it is corrected that when ECO is giving all the details in GSTR 8, that details will be electronically made available to the opposite party who should be the registered supplier. So that is only a correction point which is given in rule 67. Now talking about certain late fees aspect, please understand that all the points that we are discussing are basically amendments. But if you see late fee points, we are discussing late fees not because of amendment, because of the fact that there was certain incorrect late fees point in your main material SRK as well as QR infographics. We are trying to update it. So it is not because of amendment, it is because of correction. Now understand that if you are filing your GSTR 1 or GSTR 3B or CMP, or GSTR 4, CMP 08, there's no late fees, there's interest for late payment. Now the late fees is the same. Now understand that if at all you are a supplier, in a particular month you are having no supplies, nil outward supplies, no tax, nil return. In that case, late fees would be rupees 10 per day of delay or 250, whichever is lower. This is CGST late fees, and copy paste amount will be SGST late fees. What is the late fees? If your return is a nil return, be it GSTR 1 or GSTR 3B or GSTR 4, then it is rupees 10 per day of delay or 250, whichever is lower. This is CGST late fees, and copy paste will be the same amount will be SGST late fees. This is for nil GSTR 1, 3B and GSTR 4. If your return is a normal return other than nil return, then you have to ask what is your aggregate turnover in preceding financial year. If it is up to 1.5 crores, your aggregate turnover in preceding financial year is up to 1.5 crores. Please understand that in composition scheme, obviously your aggregate turnover in preceding financial year clearly will be only up to 1.5 crores. Otherwise, you cannot even enter composition scheme. Either it is up to 1.5 crores or 75 lakhs or 50 lakhs. So it is implied in composition scheme. There is only one possibility. Then the late fees is CGST late fees rupees 25 per day of delay or 1000 rupees, whichever is lower. Late fees is 25 per day of delay or 1000 rupees, whichever is lower. 25 per day of delay or 1000 rupees, whichever is lower. Which means if it is a normal return and if your previous year aggregate turnover is up to 1.5 crores, then late fees is rupees 25 per day of delay or 1000 rupees, whichever is lower. This is CGST late fees. The same amount will be there for your SGST late fees. But if I tell your return is a normal return other than nil return and your previous year aggregate turnover is more than 1.5 crores but up to 5 crores. This situation will be there only for 1 and 3B because it cannot be there in GSTR 4. Because if your previous year aggregate turnover is more than 1.5 crores, then you are not even eligible for composition scheme. So this situation will not be there for, it will be there only in GSTR 1 and GSTR 3B. This situation will not be there for GSTR 4. In that case, late fees is CGST late fees is rupees 25 per day of delay or 2500, whichever is lower. 25 per day of delay or 2500, which is lower. This is CGST late fees, copy paste SGST late fees. And if at all your return is other than nil return and if your aggregate turnover in preceding financial year is more than 5 crores, in that case, whether it is GSTR 1 or 3B, your CGST late fees is rupees 25 per day of delay or 5000, whichever is lower, or 5000, whichever is lower. This is CGST late fees, copy paste for SGST. Please understand that whether it is your GSTR 1 or 3B or 4, you have to ask a question whether it is nil return or your normal return. If it is nil return, then there's a separate answer. Normal return, then there's a separate answer. In normal return, there are three possibilities. Your aggregate turnover in preceding financial year up to 1.5 crores, more than 1.5 crores, but up to 5 crores. More than 1.5 crores, but up to 5 crores. And final situation is more than 1.5 crores, but up to 5 crores, and final situations more than 5 crores. If it is nil return, please understand the fact that you need not even check any situation. In any case, your late fees will be the same. So in any case, late fees is rupees 10 per day of delay or rupees 250, whichever is lower. If it is normal return, then you have three answers. If your aggregate turnover in previous financial is up to 1.5 crores, then it is rupees 25 per day of delay or rupees 1000, whichever is lower. If your aggregate turnover in preceding financial is more than 1.5 crores but up to 5 crores, it is again rupees 25 per delay or rupees 2500, whichever is lower. And if your aggregate turnover in preceding financial is more than 5 crores, then it is rupees 25 per day of delay or rupees 5000, whichever is lower. This is for GSTR 1, 3B as well as 4. It depends on the fact whether your return is a nil return or a normal return. In nil return, the answer is the same. Under any case, the answer is the same. In normal return, it is different. And this is even true for composition scheme dealer. The only difference is, for him, you will not have a situation where the previous year aggregate turnover is more than 1.5 crores in normal return. Then when you talk about your GSTR 7, that is your TDS return, GSTR 7. In that case, late fees is rupees 25 per day or 1000, whichever is lower. Please understand that here your return can be your nil return or your normal return. Government who's filing, government or government companies, undertakings who are filing GSTR 7, the late fees for them is lesser, rupees 25 per day of delay or 1000, whichever is lower. This is CGST late fees, copy paste SGST late fees, any type of return. And when you are talking about your annual return, the late fees depends on the aggregate turnover of that particular financial year, because annual return is filed after the end of the year. It is not aggregate turnover of previous year, it is aggregate turnover of that particular financial year. For annual return GSTR 9, if your aggregate turnover is up to 5 crores in that financial year, then the late fees is 25 per day of delay or 0.02% of state turnover. Whichever is lower, copy paste. This is CGST late fees, copy paste SGST late fees. If your aggregate turnover in that financial year is more than 5 crores but up to 20 crores in that financial year, not previous financial year, in that financial year, then it is not 25 per day now, you are bigger. 5 to 20 crores, 50 per day of delay or 0.02% of state turnover. Whenever it is calculation, you go with state turnover. When it is concept, whether you are big or small, you go with aggregate turnover. So here, to see whether you are big or small, you go with aggregate turnover. For calculating, you go with turnover in a state or union territory. If your aggregate turnover is more than 20 crores in that financial year, not previous financial year, in that financial year, then the late fees is, it's not 25, it's not 50, it is rupees 50 per day of rupees, it's not 25 per day of delay, it's not 50 per day of delay, it is rupees 100 per day of delay or 0.02 is not that now. For the first two cases it is 0.02, but here it is 0.25% of state turnover, whichever is lower. So if it is up to 5 crores, 25 per day of delay or 0.02% of state turnover. 5 to 20 crores in that financial year aggregate turnover, then it is 50 per day of delay or 0.02% of state turnover, which is lower. If it is more than 20 crores, any turnover, 50 crores, 100 crores, 200 crores in that financial year, then it is rupees 100 per day, neither 25 per day nor 50 per day. Now it is suddenly rupees 100 per day of delay or 0.25%. Now it's not 0.02, it's 0.25% of state turnover, which is lower. In all other return filing cases, other than 1, 3B, 4, other than GSTR 7, other than 9, in all other return filing cases, what are the other return filing cases? 5, 5A, 6, 8, 9B. 9B will come here, annual statement. 10. In all these return filing cases, CGST late fees. Now in all these cases, late fees is rupees 100 per day of delay or rupees 5,000, whichever is lower. This is CGST late fees. All the late fees that we are discussing is CGST late fees. Copy paste will be your SGST late fees. So that is everything about the amendments in return filing chapter, even the correction which is there in the late fees concept. Now, there are certain amendments when you talk about ECO, TDS and TCS, and the main amendments deal with these points related to supply of goods through ECO, where TCS is applicable both by a person whose composition taxable person and both another by a person where we are talking about supply of goods through eco where TCS is applicable by unregistered person but having enrollment number. So here you're talking about scenarios where you're talking about person who's supplying goods through eco, where TCS is applicable. What if that person is your composition taxable person? Now it is very clearly it is interconnected with your composition scheme, because now supply of goods through eco by a composition taxable person where TCS is applicable is allowed. So this is a corresponding amendment, but it is categorically said that eco should take care that such supplier who is under composition scheme should not be making interstate supply of goods. Eco in such case will collect TCS and eco will file that details in GSTR 8. So that is given by your notification 36/2023 CT section 148 along with notification 36/2023 CT. So it is linked with your composition scheme that now composition scheme dealer are allowed to make supply of goods through eco even if TCS is applicable. Eco has to make sure that this particular composition taxable person is not making interstate supply of goods. Eco will collect TCS in such cases and eco will file in GSTR 8. Now the same way it is given for unregistered person who is having enrollment number. So the first part is your eco connected with your composition scheme, and the second part is eco connected with your registration chapter, where it is said that a supplier who is having aggregate turnover in preceding financial year as well as current financial year up to 40 lakhs, 20 lakhs and lakhs need not take registration, but he can still supply through eco where TCS under section 52 is applicable. So they have spoken about this in section 148 read along with notification 37/2023. What they are telling is you can have a supplier, this is actually connected with section 23 read along with notification 34/2023, where it is said that you can have a supplier who's supplying goods through eco, where TCS is applicable, but he may not be registered, he should be having an enrollment number. So please understand both this notification 36/2023 and 37/2023 are talking about eco, what eco should do. Whereas we have discussed about composition scheme dealer, what he should do in composition scheme section 10 amendment, and we have discussed about the supplier who's not taking registration but having enrollment number in section 23. Here we are discussing about what this eco needs to do. This eco who's allowing a supplier of goods supplying goods through eco where TCS is applicable without taking registration but having only an enrollment number should ensure that this supplier is making such supply of goods only after getting enrollment number. This supplier is not making any interstate supply of goods. Eco will not be collecting any TCS, but obviously it will be filing in GSTR 8, but it will not be collecting any TCS. The difference is, in the previous case, if the supplier is registered under composition scheme, that will be TCS and that details will be filed in GSTR 8. Here, eco will not collect TCS, but the details will be furnished in GSTR 8. Now, what is the common point? Here they are putting responsibility on the eco. In the previous point, what is the common point in both the cases? In both the cases, whether the supplier is a composition scheme dealer or supplier is unregistered, in both the cases, eco should make sure that it is not allowing interstate supply of goods by such person, be it your composition scheme dealer or be it unregistered person having enrollment number. That's the common point. These people should not make interstate supply of goods. Another common point, eco will file these details in GSTR 8. What is the difference? The difference is, if the supplier is a composition scheme dealer, ECO will be collecting TCS. If the supplier is unregistered person having enrollment number, ECO will not be collecting TCS. So that is the difference. Now there's a circular clarifying, what if there are multiple electronic commerce operators involved in a transaction, who is going to collect TCS? Supposing there is a buyer who's placing order on one online platform, that is buyer side ECO. That online platform talks to the another online platform, which is seller side ECO, and that gives finally the order to seller, and then the supplier will make such supply. So if at all you are the buyer, you are making an order on one online platform, that is one website or app, that gives connection to another website or app, and that will finally give the intimation to the seller that supply has to be made. In this case, please understand the TCS provisions are applicable on the seller side ECO, because finally you are talking about TCS to be collected, TCS to be collected against the supplier. Who's the supplier? The seller is the supplier. So TCS provisions will be applicable under section 52 for the seller side ECO, because supplier is supplying through such seller side ECO and consideration is routed through such seller side ECO. So you are talking about only connection between supplier and its ECO. So buyer's ECO is not going to be affected. That is a clarification. Second, what if buyer is giving an order on buyer side ECO, which is placing an order to the seller who happens to be in ECO, which means supplier himself is dealing through online platforms. Now understand that the seller who is already also in ECO is not relevant, because for section 52 TCS to be there, it is supplied through ECO, not by ECO or to ECO. It is supplied through ECO. So this seller who's an ECO is not a relevant fact. This seller is the supplier, and he's making supply through buyer side ECO. So TCS will be applicable on the buyer side ECO. This seller himself is an ECO is not relevant whether he's an ECO or not, because he's a supplier. Now for TCS to be applicable under section 52, supply should be through ECO. Now this seller is supplying through buyer side ECO. The seller is supplying through buyer side ECO. It is also an ECO. It is also having online platform, but this supplier is supplying through buyer side ECO, and consideration is received by the supplier from this buyer side ECO. So TCS provisions will be applicable on this buyer side ECO. The fact that seller is also an ECO is not at all relevant, because for section 52 TCS to be applicable, supply should be through ECO. Yes, now let us discuss about your amendments in IGST Act. Now the first amendment which is brought in your IGST Act is for place of supply for your goods sector, where you're talking about transactions of goods not being import and export, which means domestic transaction, which is there in section 10(1) CA. So you new subsection is being added, section 10(1) CA. Basically it talks about B2C transactions. So what has happened is, now section 10(1)A, 10(1)B, 10(1)C is for B2B transaction, where supply involves movement of goods, where supply is routed through a third person, or where you're talking about supply where there's no movement of goods. So all these three things are now applicable for B2B cases. For B2C, they have brought out a new section telling that in case the transaction is by a registered person to an unregistered person, then if that registered person knows the address of the unregistered person, it is location as per the address recorded in the invoice. Which means, if for B2C transaction, if the address of the recipient is known, it is the location of the address. If at all address of the recipient is not known, then it is the location of the supplier. So if the address of the recipient is known, it is location of the recipient. Location as per the address of the recorded in the invoice of the recipient. If the address of the recipient is not known, it is the location of the supplier, where address is not there on the invoice. Now understand, they have given an explanation for this, saying that even knowing the state is treated as address. So they have given an explanation clarifying the fact that even recording the state shall be treated as recording the entire address. So you need not have the entire address of the recipient, just knowing from which state he belongs, that is more than sufficient. So they have categorized that into 2 points for B2C cases. Which means recipient is unregistered. If the recipient's address is known, then it is location of the recipient's address, and address does not mean full address, it is states alone is sufficient. If the recipient's address is not known, then it is location of the supplier. So this is a new provision for place of supply of goods which is within India, neither being import of goods nor being export of goods for B2C transactions. Now, another amendment has come out in your section 12, which is place of supply for services where both location of the supplier and location of recipient is in India for goods transportation service. So you are talking about domestic transaction of services where both location of supplier and location of recipient is in India, and the amendment has come in your goods transportation service section 12 subsection 8. Now they have removed the point that if at all that is transportation of goods to a place outside India, then the place of supply shall be destination of goods. This is no more relevant. They have removed this. So when you talk about transportation of goods sector, whether both supplier and recipient in India, whether the movement is within India or the goods are going outside India, but both supplier and recipient are in India, place of supply shall be only and only determined by way of, when they have removed this, the significance of this is your place of supply, where you are talking about your location of where you are talking about both LOS and LOR in India. It is this proviso is being removed. If this proviso is removed, then the place of supply is determined in case of two cases. If it is B2B case, if it is B2C case. If it is B2B case, location of registered recipient. If it is B2C case, location of the place where the goods are handed over for transportation. So now they have removed this proviso where it was specifically giving an exception where the goods are going from India to outside India, then the place of supply is destination of goods. That proviso is removed. So in terms of your section 12 subsection 8, when this proviso is removed, place of supply for B2B case is the location of registered recipient. For B2C case, it is the location where the goods are handed over for transportation, which means the starting point of the journey of transportation. Now, this is an amendment in section 12 subsection 8. Also understand that there is an amendment in section 13 subsection 9, which is again in goods transportation sector, where they have said in case of place of supply for transportation of goods where LOS or LOR is outside India. That means either the location of supplier is outside India or the location of recipient is outside India. There used to be place of supply for such transportation of goods where either LOS or LOR are outside in section 13 subsection 9. Now that place of supply is removed, where the answer would have been destination of such goods other than by way of mail or grid. Now it is actually totally removed. Now when it is totally removed, place of supply is determined by way of section 13 subsection 2. Here it is section 12 subsection 8. See, understand the difference. Both the amendments are in transportation of goods sector. When location of supplier as well as location of recipient is in India, both are in India, the section which governs place of supply is section 12 subsection 8. It still remains. They have removed a part of section 12 subsection 8. They have removed the special proviso. They have removed the special proviso. So that is the amendment that has been brought. So section 12 subsection 8, it is still very much intact. Now what is the change that has been brought in section 13 subsection 2, which means previously when you talk about location of supplier or location of recipient outside India for goods transportation sector, place of supply was governed by section 13 subsection 9, where it was talking about transportation of goods other than by way of mail or courier. Excluding mail or courier, it was for destination of goods. Now that is removed. When that is removed, it is governed by section 13 subsection 2. Section 13 subsection 2. And what is the answer in section 13 subsection 2? If the location of recipient is there in the records, it's ordinarily known, is not known in ordinary course of business, then place of supply is location of recipient. If location of recipient is not there in records, which means not ordinary known in the course of business, then it is location of supplier. And this particular part, which tells that if at all location of supplier or location of recipient is outside India, either supplier or recipient is outside India, then for transportation of goods sector, it is no more governed under section 13 subsection 9, that is being omitted. If the recipient, location of recipient is known in ordinary course of business, it is location of recipient. If the location of recipient is not known in the ordinary course of business, it is location of supplier. This has been clarified even by way of a circular, where it has said that when you talk about place of supply for transportation of goods service, even by way of mail or courier, where either the location of supplier is outside India or the location of recipient is outside India. So all transportation of goods services, including by way of mail courier. Now it is even including mail or courier. If at all LOS or LOR is outside India, then it will be determined by way of section 13 subsection 2 and not by way of performance by section 13 subsection 3. So it will be governed by section 13 subsection 2, the normal or the general provision. So that is the amendment there. Then these were the amendments in your place of supply. Now you have an amendment in zero rated supply, section 16(4), read along with notification number 5/2023, zero rated supply. Now it has been clearly mentioned that government, on the recommendation of GST Council and subject to conditions, safeguards and procedures, can notify class of persons who make zero rated supply on payment of IGST and claim refund of so persons, which means they have said that they can mention who are the people who can make zero rated supply on payment of IGST and claim the refund, or mention the goods or services which may be exported on payment of IGST and claim the refund, automatic refund. Which means now when you talk about zero rated supply, basically there are two options. One, pay the entire output IGST, then automatic refund of output IGST will be there. Second, go for zero rated supply under LUT or bond, then don't make any payment. Whatever is the unutilized ITC in relation to zero rated supply, you can apply for refund. That is not automatic refund, that you have to apply it. Now what they have done is, there are certain notified goods which are now not allowed for being exported or supplied to SEZ on payment of IGST, which means that for these goods only payment option is closed. They can go only for LUT or bond. And these goods are pan masala goods chapter 21, tobacco goods chapter 24, and essential oils chapter 33. Now what has happened is, normally when you talk about your zero rated supply, in normal case when you talk about your zero rated supply, in normal scenario, whenever you talk about your zero rated supply, you have two options. First option is you make zero rated supply on payment of output IGST, then there will be automatic refund linking your GST portal and customs portal. Second option is you don't make the payment of output IGST, you go for LUT or bond, which means you don't make the payment, then you will get the refund. Now there is a clear cut difference. Here you make the payment of output IGST and you get the refund of output IGST. Pay the output IGST, then get the refund of output IGST. But here what happens is, you don't pay output IGST, but you get the refund of unutilized input tax credit. So understand that basically for zero rated supply, the doors for you are open for both. You can decide either to pay your output IGST, then claim the refund of output IGST. Either first pay output IGST, then claim the refund of your output IGST. This refund is automated refund by linking your GST portal data, in which you give you by your return filing, mainly GST 1 and 3B, and your customs portal where you file your shipping bill of export. So when it is matching, automatic refund will be there. Second case is you go for letter of undertaking or bond option, where you don't pay output IGST but get the refund of unutilized input tax credit. You're not paying your output IGST, still getting the credit, and you can claim the refund of unutilized ITC in terms of your rule 89.4 or 4A or 4B. You will get the refund of that. Normally both the doors are open for you, but normally what happens is this, if at all I call it as this as option 1 and this as option 2. In normal case, generally you can either go for option 1 or option 2, but special case for notified class of persons or notified goods or services, you cannot go for option 1, you can only go for option 2. Now what is that special case? Now they have notified certain goods, pan masala, tobacco, essential oils, where you cannot go for option 1, you cannot go for payment option, you can go only for LUT or bond option. In a normal scenario, both the doors are open. Either you can go for option 1, payment option, or option 2, LUT or bond option. In this special scenario, you cannot go for option 1, you can only go for option 2. For now, notified goods. Actually, they can notify class of persons or notified goods or services. Now they have notified certain goods, which are pan masala, tobacco, and we are talking about essential oils. So they have notified certain goods, being pan masala chapter 21, tobacco chapter 24, and essential oils chapter 33. Now there are certain clarifications with respect to your IGST Act. The first clarification is very basic clarification. For export of service, that is basically condition that you should receive convertible foreign currency. Now what if you receive the export proceeds in Indian rupees, but that is there in special rupee Vostro accounts in foreign trading country, which is opened by your authorized dealer banks. Please understand that in terms of foreign trade policy 23 and RBI circular, this is allowed. See, if you see that one of the condition for export, supplier should be in India, recipient outside India, place of supply outside India. You should not be distinct persons, and you should receive convertible foreign currency or Indian rupees where it is permitted by RBI. Please understand that if at all you're getting the amount in special rupee Vostro accounts, in terms of foreign trade policy and RBI circulars, it is allowed for you to receive Indian rupees. Therefore, this will classify still as export. That is this clarification. Now the second clarification is when you're talking about your place of supply for advertising sector. Now the issue for this advertising sector is when you're talking about the hoardings or the billboards which is given for advertisement sectors by the various suppliers. Now whether this would classify as immovable property related services attracting section 12 subsection 3, where place of supply shall be location of immovable property, or this would classify as basic advertisement services and not the right to use immovable property, where your place of supply is governed by section 12 subsection 2, where it is location of a recipient. If at all it is B2B, then it is location of registered recipient. If it is B2C, then if location of a recipient is known, If at all you know the location of recipient, it is that. If it is not, if the location of recipient is not known, it is location of supplier. So when you talk about this particular scenario, please do understand that here things are pretty clear. Advertisement sector, there can be two types of services. One is a service where you are actually giving the space, right, to use space. You're just telling that, see, I am offering the space. I'm not giving anything. This is my space where you can put your billboard or hoardings. In that case, the service given by the vendor to the advertising company or the client is that of renting of space of immovable property, which is governed by section 12 subsection 3, and place of supply shall be location of immovable property. I'm just owner of that space. I'm telling that you take the space and put whatever you want. This generally happens between the owner of that space and the advertising company. So you can understand it this way. That is owner of that space and basically advertising company. Then there is client. There may be final client. Now understand that the owner of that space to advertisement company is basically selling that, take this space, you do whatever you want. You have to pay me a rent, fixed amount. Whether you put the advertisement or not, I'm not bothered. Then it is governed by section 12 subsection 3. Place of supply is location of immovable property. Obviously, it's not basically location of immovable property. Here, in general, yes. But here you are not going to categorize B2B, B2C, it is location of immovable property. When you talk about advertising company to client, then basically here the services renting of space, and this here the services advertising service, which means basically they'll design the ad, put it, and based on usage you'll be paying it. So this 1 week you will be your company's advertisement and you're going to pay it. So you'll be allotted some, the services not only giving that space but also doing that advertising services. Then it is governed by section 12 subsection 2. When it is governed by section 12 subsection 2, place of supply will be different for B2B cases and B2C cases. If it is B2B case, then it is location of registered recipient. If it is B2C case, if the location of recipient is known, then it is location of recipient. If the location of recipient is not known, then it is location of supplier. So it is, things are very clear. So you need to differentiate both. You need to understand whether you're talking about a scenario where you're talking about only renting the space. In such a scenario, it is in fact governed by section 12 subsection 3. Place of supply is location of immovable property. Or whether it is in fact advertising services where they are involved in designing the advertisement and other things, then it is section 12 subsection 2, place of supply. For B2B cases, location of registered recipient. For B2C case, if location of recipient is known, that is the place of supply. It is not known, location of the supplier. So that is actually given here. Now the next is the clarification on similar terms where you are talking about a situation where you're talking about co-location. Co-location is a data center services, co-location services. Now what is exactly co-location services? It is nothing but a data center facility in which a business or a company can rent a space for its own servers and other computing hardware along with other bundled services, which is nothing but hosting and information technology infrastructure. So what normally happens in co-location services, you can keep your data secured. I mean, it's nothing but cloud services. But understand that when you take that cloud services, the question is whether it will be categorized as renting of immovable property services where you are taking the space for keeping the company's hardware and servers, or it will be treated as hosting and information technology services where your servers and hardwares are kept. Not only that, there is security for that hardware, air conditioning, uninterrupted power supply services, fire protection services, network connectivity, backup facility, firewall services, monitoring and surveillance services, etc., etc., etc. If all the related services are given, then it will be governed by section 12 subsection 2. So again, the basic question is it section 12 subsection 3 location, your immovable property related services, or it is general category section 12 subsection 2. Now understand that it depends on the contract. Normally, when you offer co-location services, please understand that you don't just get a space. So by default, co-location services are covered under hosting and information technology services, which means it is governed by section 12 subsection 2, where if the recipient is registered, it is location of registered recipient. If not registered, location of recipient if it is known. If not known, location of supplier. So that is very similar to the previous circular. Why is it so? Why co-location services generally fits into the category of hosting and information technology infrastructure services, infrastructure provision services? Because understand that when you offer co-location services, you don't only get a space for your server or hardware, but you get all the other related services which involves network connectivity, backup, firewall, monitoring, surveillance, or you're talking about air conditioning, uninterrupted power supply, etc., etc. It is the entire bulk of services, which is nothing but information technology services, which is very essential for your server and hardware. So it is not only just giving the space for your server and the hardware, it is all the other services, that there will be proper monitoring, surveillance, there will be proper backup facility, proper firewall services, proper air conditioning, which is required for servers and your hardware's uninterrupted power supply. All these other services are packaged, as given as a package. Therefore, it will be classified as information technology services. If at all recipient is registered, then it is location of registered recipient. If not registered, if location of recipient is known, that is the answer. If it is not known, location of supplier. But in very rare cases, what happens is, the companies might tell that I am not interested in taking all the other services. I just want a space for my servers and hardware. I just want other things, including monitoring, surveillance, air conditioning services, uninterrupted power supply, firewall services, etc. Everything else will be my work, my headache. So I don't want any responsibility of upkeep, running, monitoring services, monitoring, surveillance, etc. I don't want that particular. It is my headache. I'll take care of it. You just give me a space. My server and hardware requires a big space. You just give me that space. I'll put my servers and hardware, other things, everything else, right? Starting from your proper air conditioning, power supply, monitoring, surveillance, firewall, backup, etc., etc. I'll take care of it. In that case, it is renting of immovable property governed by section 12 subsection 3. If that is a scenario, place of supply will be location of immovable property. So in general, when you talk about co-location services, it is not only getting the space for servers and hardware, and there is an entire package of information technology services. It will be classified under section 12 subsection 2. But if at all you're getting that space only for servers and hardware, and you don't want anything else of IT services, then it is categorized under section 12 subsection 3, which is immovable property related services. Place of supply will be location of immovable property. So that's all about these circulars, and this is all about the amendments which is there in your IGST Act. Now friends, let us discuss about the amendments which has come out in different places with respect to specified acts tribunal claim. Rather than discussing in different chapters, it is easier for us to discuss them together in a single chapter. So it's all about specified actionable claim. Now first understand what are the amendments with respect to specified actionable claim in your IGST Act. Section 2 of IGST Act definition, and section 5 of IGST Act, the charging section. On section 2 of IGST Act, they have amended the definition of non-taxable online recipient, section 2 clause 16, and also there's an amendment in the definition of OIDARS services, section 2 clause 17. Now in non-taxable online recipient, which is a term used for supply of OIDRS services from outside India, supplier outside India to a non-taxable online recipient. Now, non-taxable online recipient term is in sync with all the other provisions in even CGST Act. It means a person who is unregistered and receiving OIDRS services. Non-taxable online recipient means a recipient who's unregistered. And if at all a person is registered only for the purpose of TDS. Section 24(6), which means you're talking about government or government organizations who are registered only for the purpose of TDS, though they are technically registered, but only for the purpose of TDS, GST TDS, they will be treated as unregistered person. So here, they have categorically said that what is meant by non-taxable online recipient. Non-taxable online recipient means unregistered recipient. And those government or government companies or government organizations or government society which are registered only for the purpose of GST TDS, they will be treated as, though technically they are registered, but they will be treated as unregistered recipients. That is non-taxable online recipient. That's the first amendment. Second, they have amended the definition of online information database access and retrieval services, where they have removed that OIDRS services should be essentially automated, even if they are not fully automated and they involve some of human intervention, they will still be called as OIDRS services. So here they have said that an online service, even if it is not fully automated, and even if there is human intervention, it continues to be OIDRS services. That is the first amendment here. And secondly, they have said that in the example, they have said that OIDRS services will exclude. OIDRS services will include online gaming, but will exclude online money gaming, which is defined in CGST Act, Section 2, Clause 80B in CGST Act. So now OIDRS services will exclude online money gaming. Online gaming is included, which does not involve money. Online money gaming is removed. So two amendments in the definition. Recipient of OIDRS services, which is non-taxable online recipient, means unregistered person, and those government or government organizations which are registered only for TDS will also be treated as unregistered person, that is non-taxable online recipient. OIDRS service, even if there is the service is not automated and there is human intervention, it is routed through information technology. It is being routed through information technology. Even if there is human intervention, not automated, it still is online information and database access and retrieval services. Secondly, OIDRS services, in the example list you find online gaming, but OIDRS services will exclude online money gaming, because for online money gaming the entire set of principles are different. Rather, this entire discussion of specified actionable claim is only for your online money gaming. Now, in the charging section, section 5, there's a proviso which tells that when you're talking about IGST on goods which are imported into India, the duty will be customs duty. The breakup of it is basic customs duty plus social welfare surcharge plus IGST. For all the import of goods. For all the import of goods, as a proviso in section 5 of IGST Act, which talks about IGST portion of customs duty. On import of goods, there will be customs duty. The breakup of which is BCD, SWS plus IGST portion. But here they have removed the reference of, they have said that IGST on goods other than goods which are notified by the government, and the notified goods are online money gaming, which means on online money gaming, OMG, online money gaming, though it is goods, on import of online money gaming, though it is specified actionable claim, it is goods, because actionable claim is goods, it will be only IGST. So look at the difference. Normally when you import the goods, the levy is of customs duty, read along with section 5 of IGST Act, it is BCD plus SWS plus IGST. But if it is import of online money gaming, it is also goods, notified goods, online money gaming. It will not attract customs duty, it will be only and only IGST. The other difference is when you talk about import of goods, it is customs duty, breakup of BCD plus SWS plus IGST, basically governed by Customs Act and Customs Tariff Act, read along with section 5 of IGST Act, special proviso. And this will be paid by the importer. But when you talk about online money gaming, the tax will be IGST. It's not customs duty, it will be IGST. And it will be paid by not the recipient, it will be paid by supplier who's outside India. FCM. Supplier who's outside India. So technically, when you talk about normal import of goods, it is basic customs duty plus SWS plus IGST. It is just technically customs duty. And that customs duty will be paid by the importer who's the recipient. No RCM. It works like RCM, but technically it is not RCM. And when you talk about import of specified notified goods, that is your online money gaming, it is only IGST, and the supplier outside India will pay the tax under FCM. So that is the amendment. Now, in your IGST Act, there's one more amendment in section 14A of IGST Act. Section 14A of IGST Act talks about specified actionable claim by person outside India. Again, it talks about your online money gaming. It tells that a supplier of online money gaming who's there outside India supplying to a person in India will pay only IGST, which we have discussed now, no customs duty, IGST, and this person will take only one registration across India, just like OIDRS. It will take only one registration throughout India, simplified registration throughout India, and this simplified registration throughout India will be the single registration pan India. It's there for OIDRS category and OMG category. This will be taken at Bangalore, Principal Commissioner of Central Tax, Bangalore West. So this single registration will be taken at Principal Commissioner of Central Tax, Bangalore West. There's only one registration that will be taken by OMG supplier outside India. So if at all you're talking about supplier of OMG which is outside India supplying to a person in India, it will not pay customs duty, it will pay only IGST, and it will be under FCM. When you're asking a person outside India to pay the tax, he has to take a simplified registration in India. That will be taken in Bangalore West, Principal Commissioner of Central Tax, Bangalore West. If that person is having existence in India, fine. If not, a person who's representing him has to take registration and pay IGST. If that person is not even having no physical presence in India, if OMG supplier is having physical presence in India, you take registration. If no physical presence, representative will take registration in India. If no physical presence and no representative, supplier of OMG has to appoint a person and pay IGST. So if that OMG supplier outside India is having an office in India, take registration, and that too Bangalore West. If he is not there, physical presence in India, then please have your representative to take registration. If your representative is also not there, please appoint a person in India and take registration. So this is a very simple term. When you are going to take registration, either you take registration if you have physical presence, if no physical presence, your authorized representative. If not there, you please appoint a person in India, because you have to take registration. You need not take multiple registration in multiple states. You can take Pan India one registration, simple registration, and that registration will be taken in Bangalore West, Principal Commissioner of Central Tax. So this is very, very similar to your OIDRS category. But what is the differentiating factor? The differentiating factor is in case this supplier of OMG which is outside India has not complying with the provisions, is not taking proper registration, not complying with the provisions, then notwithstanding anything contained in section 69A of Information Technology Act, which means your IT Act may not block that website or app, but if he is not complying with GST law, that website or app may be blocked by India. So it is telling that supplier of OMG, we want you to get registered in India and pay GST taxes, IGST, under FCA. If you're doing it, we have said you what you have to do. You have to take single registration throughout India, that too in Bangalore West, Principal Commissioner of Central Tax, Bangalore West, and then pay IGST. If you have physical presence, that office will take registration in Bangalore West. If not, your authorized representative. If not, you have to appoint a person. But if you're not complying with it, forget about whatever is mentioned in section 69 of Information Technology Act 2000 for blocking a website or app. if you are not complying with GST law, we have the rights to block your website or app. So that is given in section 14A. Basically, till now the focus was only on OMG, online money gaming, not all actionable games, only on online money gaming. Even ahead, now we are talking about all the provisions in your CGST Act. So we are talking about section 7 of your CGST Act, supply, and section 2 of your CGST Act, definitions, and all the other provisions will be dealing with only with your CGST Act. Till now, whatever you have discussed was your IGST Act, section 2, definitions, 2 amendments in definitions, 5 charging section, and section 14A. Now it is all about CGST Act. Now section 7 of CGST Act, which talks about supply, there's an amendment that actionable claim is, your actionable claim is not supply, other than initially it was betting, gambling, lottery, but now it is other than specified actionable claim. Now what are the specified actionable claim? Your specified actionable claims are betting, gambling, lottery, casinos, horse racing, online money gaming. So they have defined specified actionable. They have defined your specified actionable claim in section 2 section 2 clause 102A. Specified actionable claim means your betting, gambling, lottery, horse racing, casinos, and online money gaming. So now all these 6 specified actionable claims will attract GST. Other actionable claims other than betting, gambling, lottery, casinos, horse racing, and online money gaming, that will not attract GST. Section 7 read along with Schedule 3. Right. Now what is online gaming? Now again the focus shifts only to online gaming and online money gaming. So main focus is only on online money gaming. Online gaming in terms of section 2 clause 80A means a game on the internet or electronic network, whatever game you're playing on internet or electronic network or an app, and includes online money gaming. Then what is online money gaming in terms of section 2 clause 80B? Online money gaming is nothing but an online gaming which involves money, which involves a person to deposit money or money's worth, including virtual digital assets. Now what is virtual digital assets? It is defined in section 2 clause 117A. It is defined in a very lengthy manner. In simple language, your virtual digital assets is nothing but cryptocurrencies. Cryptocurrency. Right. So you're talking about online gaming means the game that you play in online or electronic network, and it includes online money gaming. Online money gaming is nothing but an online gaming which involves money. That money can be money or money's worth, including virtual digital assets, which means you're not dealing with the money that we normally think of. You're dealing with cryptocurrencies. Cryptocurrencies that you play online with an expectation of winning the money or money's worth, including virtual digital assets. You put your money and in return you will get money or money's worth. You may even get cryptocurrencies, virtual digital assets in any event. That may be a game. It may not be necessarily a game. It may be a game or a scheme or a competition or any other activity. Whether or not the outcome or performance is based on skill, it may be based on your skill, intellect, or based on chance, luck, or both. Whether or not it is permissible under any law. See, they are clarifying many things. Online money gaming means an online gaming which involves money. That money can be money or money's worth or virtual digital assets. And in return, you may get the reward may be money, money's worth, or virtual digital asset. This can be in any event. That event can be a game, scheme, competition, or any other activity. And the outcome of that event can be based on skill or chance. It may be intellect, skill, or chance, or both. It may be permissible or not permissible. So they are talking about all the possibilities. Your online money gaming involves money. or money's worth, or even cryptocurrencies, virtual digital assets, where the reward will be money's worth, or virtual digital assets. It can be for any event. It may not be necessary game. It may be uh, your gaming apps. Even say for example, Team 11 or Dream 11. All these apps, right? Where the output or the performance, where the result, whether you're going to win or not, it's based on skill or chance or both. Whether it is permissible or not permissible, legal or illegal, is not at all relevant. So that is online money gaming. And in case of online money gaming, there is a proviso attached to section 2105 supplier. Normally supplier means person who's supplying the goods or services, but for online money gaming and all the specified actionable claims. So this particular point is not only for online money gaming, it is for all specified actionable claims. See, there are certain things which are there for all specified actionable claims. Betting, gambling, lottery, or you're talking about casinos, horse racing, or online money gaming. Otherwise, the entire focus is on OMG, but here the focus is on all specified actionable claim. For normally a supply means a person who's supplying the goods or services, but for specified actionable claim, it means a person who arranges the specified actionable claim. A person who is organizing or arranging directly or indirectly the supply of specified actionable claim, including a person who's owning, operating, or managing digital or electronic facility or platform, which means when these specified actionable claims are happening through online. So generally when you're talking about direct dealing in specified actionable claims, the supplier is a person who's supplying it. But if you're talking about happening through digital or electronic facility or platform, supplier is not the person who's actually supplying the goods or services. It means a person who's organizing or arranging the supply of actionable, specified actionable claim, including a person who's owning, operating, or managing a digital or electronic facility or platform. He will be treated as a supplier. He is not the real supplier, but he will be treated as a supplier because now you're dealing with that particular person through online website or app. So I may be a creator of an app which is say Dream 11. Actually, I am not supplying that specified actionable claim, but for all practical purposes, I will be treated as the supplier because those supplies of actionable claims are either supplied by him or through him. He may not be the real supplier, but it is supplied through him. The consideration, which is money or money's worth of virtual digital assets, is paid to him or through him. So the supply is by him or through him. The consideration is paid to him or through him. He'll be treated as a supplier. He may be only acting as an intermediary of specified actionable claim, but for all practical purposes, he'll be treated as the supplier. He'll be treated as a supplier. So that is given here in the definitions. Now, talking about the other amendments, when you're talking about your specified actionable claim, this amendment is not only for online money gaming, this is for all specified actionable claims. Normally, basically, the amendments that you're seeing in this entire area is only for OMG, but there are a few points which is for all specified actionable claims, like your supply definition, section 7 right along with schedule 3, like your definition of supplier, like your time of supply. Normally, time of supply for goods under regular scheme is actual date of invoice or due date of invoice. You don't consider payment, but for specified actionable claim, under section 2 clause 102A, which is basically only talking about online, section 2 clause 102A, which is talking about all the specified actionable claim. It is not only actual date of invoice if invoice is given in time, or due date of invoice if invoice is not given in time. It is actual date of invoice or receipt of payment, which was earlier, if invoice is given in time, or due date of invoice or date of receipt of payment, which was earlier, if invoice is not given in time. So normally for goods sector, payment is not relevant. If invoice is given in time, actual date of invoice. If invoice is not given in time, due date of invoice. But for specified actionable claims, betting, gambling, lottery, horse racing, or casinos or online money gaming. If invoice is given in time, actual date of invoice or date of receipt of payment. If invoice is not given in time, due date of invoice or date of receipt of payment. So payment is relevant for your specified actionable claims. It is relevant for your specified actionable claims. Now, certain other points which are only for OMG. Now, this is not for specified action claim, it is for OMG. A supplier of online money gaming. A supplier of online money gaming outside India supplying to a person in India, he has to take compulsory registration in terms of section 24(11)(a). This is only for OMG. And when you talk about registration process for OMG, they will not get registration, normal registration in terms of rule 8.1, they'll get special registration in terms of rule 14.1. So a supplier of OMG has to take compulsory registration, and when it is taking compulsory registration, it will not take in normal registration form REG01, it will take in special registration form REG10, which is equally applicable for OIDRS category, simplified registration, Pan India 1 registration at Bangalore West, Principal Commission of Central Tax. So a supplier of OIDRS from outside India to non-taxable online recipient, or a supplier of OMG from a place outside India to a person in India, they will get a special, they'll apply for registration in a special registration form called as REG10, which is for Pan India 1 registration at Bangalore West. Right. Special registration form. Not only the special registration form, but these persons will also file special returns. So I'm talking about your return filing by these people, OIDRS outside India and OMG outside India. They'll file a special return called as GSTR 5A. So this is not only for a person who's supplying OIDRS services from outside India to non-taxable online recipient or to a registered person, supplier of OIDRS outside India, or a person supplying online money gaming from a place outside India to a place in India. Supplier is outside India, recipient is in India. For OMG, recipient can be anyone. For OIDRS, recipient is either non-taxable online recipient, FCM, or recipient is registered person, are same. In both the cases, they'll file a special form called as GSTR 5A. GSTR 5A. And both these special people, OIDRS from outside India, this was in terms of rule 64, both these special persons, OIDRS from outside India to non-taxable online recipient, or OMG from outside India to any person in India, and they are paying tax under FCM, because they are all going to pay tax under FCM, but the suppliers are outside India. They can pay tax through a special mechanism, international money transfer, through SWIFT. That is Society for Worldwide Interbank Financial Telecommunication. So they can make the payment through SWIFT. Society for Worldwide Society for Worldwide Interbank Financial Telecommunication. So supplier of OIDRS outside India and OMG outside India, they can make the payment in electronic cash ledger through Society for Worldwide Interbank Financial Telecommunication SWIFT facility. So that is also that. Now talking about the other amendments for your OIDRS and OMG. See, for OIDRS, OMG, special registration. Rule 8.1 read along with Rule 14.1. Special return. Rule 64. Special payment. Rule 87. Special documentation. Special documentation. Proviso to Rule 46. F. Tax invoice. When these people are giving tax invoice, supplier of OMG outside India or supplier of OIDRS outside India, or even when you're talking about supply by a person by ECO or through ECO. Here there are three people: OMG, OIDRS services, eco. That is the first difference. By or through eco. Second difference, these people, normally when you're talking about OMG supplier outside India and OIDRS supplier outside India, but these people, whether they are in India or whether they are outside India. So when the supply is of online money gaming or OIDRS services or supplies by eco or through eco, in that case, they need not mention the name and address of the recipient with PIN code. All they can mention is only the state of the recipient, and that will be treated as the address on record. So recipient details, name, address, PIN code is not required. They can just give the recipient state. Name of the recipient not required, entire address with PIN code not required, only the state is sufficient. But interesting point is, this is not only for OMG supplier outside India or OIDRS supplier outside India. It is for OMG supplier in India or outside India. OIDRS supplier in India or outside India. Supply by eco or through eco in India or outside India. So this is the significance of this particular. So this OIDRS supplier outside India, OMG supplier outside India, they have got a lot of special provisions. Simplified registration, Pan India 1 registration, Rule 8.1 read along with Rule 14.1. Simplified return filing, Rule 64. Simplified payment, Rule 87. This is for OIDRS supplier outside India, OMG supplier outside India. And simplified documentation, this is not only for OIDRS, OMG, but also for eco. This is not only for these suppliers outside India, it is also for in India. Only the state is sufficient. Now, the other amendment which is there for your OIDRS and OMG, specifically it's only OMG. Now, they have given a special valuation provision for online gaming, including online money gaming, and special valuation for casinos. You already have valuation for your betting, gambling, horse racing. You already have valuation for your lottery. So what are the specified actionable claims? This amendment is applicable actually for all the specified actionable claim. You already have a valuation under Rule 31A for lottery, for betting, gambling and horse racing. Now you have Rule 31B and Rule 31C, new rules. Rule 31B is for online gaming, including online money gaming. And 31C is for casinos. If you connect all these points, it is nothing but specified actionable claim. Now the focus is Rule 31B and 31C, the new rules. The value for the purpose of online gaming, including online money gaming, which involves money worth or virtual digital assets, is the total amount paid or payable or deposited with the supplier. Value is nothing but the total amount which is paid or payable or deposited. Either paid or payable or deposited with the supplier. That paid or payable or deposited with the supplier can be money or money's worth or virtual digital assets. And understand the fact that whatever you have paid is the value, and whatever will be returned or refunded because you have not used that amount paid or deposited shall not be deductible. Supposing I am putting, this is for what? This is for online money gaming. Supposing I have deposited 1 lakh rupees for playing in Dream 11. That 1 lakh rupees will be treated as value. Supposing I don't play worth 1 lakh rupees, I play only worth 80,000 rupees, 20,000 is refunded back. Still the amount will be 1 lakh rupees. The amount that is returned or refunded because I have not used that amount for online money gaming will not be deductible. So if I have deposited 1 lakh rupees in Dream 11 app, 1 lakh rupees will be treated as the value. If I have played only for 80,000 rupees, I have lost or I have won, forget about it. And I have taken back 20,000 rupees. That 20,000 rupees will not be deductible. Answer is still 1 lakh rupees. And for casinos, similar thing. When you're talking about actionable claims in casinos, it is amount paid or payable. This amount paid or payable can be for purchase of chips or tokens or whatever name you called, or for participating in an event. See, in casinos, either you'll purchase the chips or tokens, or you'll participate in any event where chips or tokens is not required. This is amount paid or payable again. Simple language, it is amount paid or payable. And again, supposing I have taken chips for about say 1 lakh rupees. I have entered casino, I have taken chips or tokens for 1 lakh rupees, or I participated in event for 1 lakh rupees. Basically, assume that I have taken chips or tokens for 1 lakh rupees, but I have played only for 80,000 rupees. Balance 20,000 is returned or refunded because I have not used that tokens or chips. I have not used that tokens or chips, will not be deducted from the value. See, in casinos, I may take tokens or chips, or I may participate in an event. If I am participating in an event for 1 lakh rupees, 1 lakh rupees is the value. But if I have taken the tokens of 1 lakh rupees, but I use only 80,000 rupees, 20,000 rupees I don't use. But still the value will be 1 lakh rupees, 20,000 rupees cannot be deducted. The difference in both is, when you talk about online money gaming, there's only one way: deposit that amount, 1 lakh rupees. I may use for online money gaming only 80,000, but still value is 1 lakh rupees. 20,000 rupees returned or refunded will not be deductible. But when you talk about casinos, I may go with tokens or chips, or I may participate in an event. If I participate in an event by paying 1 lakh rupees, entire 1 lakh rupees is the value. But if I take tokens or chips for 1 lakh rupees but play only for 80,000 rupees, still 1 lakh rupees is the value. 20,000 that I get the return of or refund of will not be deductible from the value. And as an explanation, both for your online gaming, including online money gaming and casinos, both for your rule 31B and 31C, whatever amount is received by the player by winning an event, whether it is a game, competition, or a scheme, and which is further used for playing, will not be added to the value. So this is talking about addition to value. It will not be added in the value. If I have taken tokens or chips of 80,000, 1 lakh rupees, and out of that 1 lakh rupees, I convert that 1 lakh rupees into 10 lakh rupees. Value is still 1 lakh rupees. The extra 9 lakh tokens or chips which I have got, or extra 9 lakh rupees amount that I have got in online money gaming, is not going to be added to the value. That will not be subject to GST. In simple language, take it online money gaming and say casinos chips. If I have deposited 1 lakh rupees for online money gaming, answer is 1 lakh rupees. I would have played only for 80,000 rupees, 20,000 rupees I am getting refund or return, answer is still 1 lakh rupees. I would have made that 1 lakh rupees into 10 lakh rupees by winning, answer is still 1 lakh rupees. The same is true with casinos. I have taken tokens of chips of say 1 lakh rupees, or participated in an event for say 1 lakh rupees. I have won that game or scheme or competition and made that 1 lakh rupees into 10 lakh rupees. Answer, the value still remains 1 lakh rupees. Or I have used only tokens of 80,000 rupees. I get the refund of 20,000 rupees. Answer still 1 lakh rupees. In all the cases, the answer still remains as 1 lakh rupees. Neither there is any deduction for the return or refund, nor there is any addition for the winning amount. So no deduction for the return or refund, no addition for winning that amount. So that is all about your valuation. So this completes everything about your amendment in your specified actionable claim. Now please understand, if you see the amendments here, there are only few amendments which deals with specified actionable claims. So the amendments which deals with only all the types of specified actionable claim is your section 7 read along with schedule 3. It talks about all the specified actionable claims. Rule 31B, rule 31C. It talks about all the specified actionable claim. Time of supply. It focuses on all the specified actionable claims. All the other amendments, all other cases, in all other cases, the focus is only on online money gaming. If you remove this valuation provision or time of supply provision or your supply provision, including definition of supply, the focus including the definition of supply, supplier definition, not supply, supplier definition section 2, that the focus is on all the specified action claim. If you forget about that, everywhere else the focus was on only online money gaming. So the main amendment has come out in different places only with respect to online money gaming. In only limited places, the definition of supplier or definition of supply or valuation 31B, 31C or time of supply, they talk about all the specified actionable games: betting, gambling, lottery, casinos, horse racing, online money gaming. But in all the other places, the focus is only on online money gaming. That's everything about specified actionable claims. Yes, now let us discuss about the amendments in your audit and assessment. Basically, there's an amendment in section 62 where you're talking about your audit assessment of non-filers of returns, which you may call it as best judgment assessment against your registered person. So, where you're talking about your best judgment assessment. Assessment against your registered person. What is being changed here? Now understand that in section 62 subsection 2, where it is initially said that against the person for whom best judgment is initiated, if at all that person files his, for non-filing of returns is initiated, if that particular person files his return within 60 days, initially it was 30 days of best judgment assessment order, now it is within 60 days of best judgment assessment order, then that best judgment assessment order shall be deemed to have been withdrawn. But understand that interest liability and late fees liability shall continue. So initially, best judgment assessment which is initiated against a person who has not filed the returns, best judgment assessment order is also passed, but that person has filed all his returns within 30 days. Now that 30 days time limit is being changed to 60 days. Now they are talking about if that person against whom best judgment assessment order is passed for non-filing the returns and that person files his returns within 60 days. So 30 days is changed to 60 days. Then there will be automatic withdrawal of the best judgment assessment order. So that is the first amendment. Now the second amendment is they go to another extent of where that particular person has not filed his returns within 60 days of the best judgment assessment order, but he has filed his return in the next 60 days with an additional late fees of rupees 100 per day of delay, which means this is CGST late fees for the period beyond the initial 60 days, then that best judgment assessment order shall be deemed to have been withdrawn. Obviously, but the interest liability and late fees liability under section 50 and section 41 shall continue. Please understand, initially if you have filed your returns within 30 days of best judgment assessment order, that best judgment assessment order is treated as withdrawn. Now they have changed this to 60 days plus 60 days of best judgment assessment order. So the time limit of 30 days is changed to 60 days and there is an extension which is given for another 60 days. But when you're talking about this extension, you have to pay additional late fees of rupees 100 per day of delay. This is CGST late fees and this is not normal late fees, this is additional CGST late fees, copy paste SGST late fees, so you have to pay additional late fees. Now if that is being done, then this best judgment assessment order is deemed to have been withdrawn. Obviously in both the cases the interest liability and the late fees liability shall continue. So what is the main amendment that has been brought us? They are now categorically telling that you can withdraw your best judgment assessment order against a registered person if that is initiated for non-filing of return. If you file your returns within 60 days of the best judgment assessment order, if you miss that deadline, you have an extension of another 60 days. But for that another 60 days, you have to pay an additional CGST late fees of rupees 100 per day of delay. Copy paste will be SGST late fees. Now if you do that, your best judgment assessment order is deemed to be withdrawn, automatic withdrawal. This withdrawal is not by any request and all, it is automatic withdrawal, but they are very clearly telling that interest liability and late fees liability in section 50 subsection 1 and section 47 shall continue. So that is the amendment in section 62. Now let's talk about the amendment in your demand and recovery chapter, basic amendments. First, there is an amendment in your rule 142 which is talking about notice and order of demand. This amendment would not be coming in exam because it is only a correction based amendment where if at all you get an order under section 73(8) or section 74(8) and you make the payment within 30 days of that particular order, or you get a notice under section 129 and within 14 days of detention or seizure you are making that payment. So once you make that payment, you're getting section 73, 74 notice and order, or you're getting section 129 notice which is for seizure of goods and conveyance, and you make the payment. Right. Once you make the payment, you have to intimate the officer in DRC03 voluntary challan, and officer shall acknowledge that he is aware that you have made the payment and you have given an intimation in DRC03. Acknowledge that in DRC05. That acknowledgement is not called as an order. That acknowledgement is also an intimation. So you are making the payment because of section 73, 74 notice and order, or section 129 notice. After making that payment, you are giving an intimation in DRC03. Officer will give back the intimation in DRC05. That replying back to assessee is not an order, it is only an intimation. That's only a word change. Now, there's a new rule which is brought out in form of rule 142B. This rule 142B is in line with your 88C. Now, what is this particular point all about? This point is telling that if at all there is your outward supply which is more in 1 than 3B, then you get an intimation under rule 88C. So you get rule 88C intimation. For that intimation, either you have to reply to that intimation, or you pay the difference within 7 days. Either reply or pay intimation. And there will be certain corresponding things happening. So if you get this intimation, your filing of GSTR1 or IFFS blocked. When that is blocked, 3B is blocked, etc. etc. Now, you reply or pay. If at all you don't reply, or reply but it is not satisfactory, or you don't pay, you reply but it is not satisfactory if you don't pay. If that things happens, now they have brought rule 142B to tell that if you have replied satisfactory, the chapter is closed. If you have paid satisfactory, the chapter is closed. If you have not replied but not satisfactory, not paid, then what will happen is officer will give an intimation in DRC 01D. So finally, if you have not replied, or replied but not satisfactory, or you have not paid, then you will get an intimation of recovery. Intimation for your recovery. Your recovery will start. That intimation for recovery is there in DRC 01D. And when you get that intimation, after 7 days of intimation, so you will get that intimation in what? DRC 01D. You have to pay that amount. Now it is very clear that you have to pay that amount with interest. And within 7 days of that particular intimation, it will be converted into liability. And this intimation shall be treated as notice for recovery. And then your recovery will start. Under rule 143, 144, 145, 146, 147, 155, 56, 57, 160. Different forms of recovery. Recovery will start. Your recovery will start. So what is being said is your outward supply is more in 1 compared to 3B. First, you get an intimation under rule 88C. You have an option to reply or to pay within 7 days. If you have replied, satisfactory, close. If you have paid, satisfactory, close. But if you have not replied or replied but not satisfactory or not paid, then they will give you another intimation which is nothing but recovery notice, which is nothing but that shall be treated as recovery notice. This intimation is nothing but notice for recovery. That intimation is telling that now we are starting our recovery proceedings, and you have to pay again. When they are starting recovery, they will give you another chance. You please, now your liability is freezed. It is now all put in your liability, electronic liability ledger part 2. It's all put there in your liability. It's all freeze. Now you're not getting an option. Your liability is freeze. You are posted in your electronic liability ledger. Pay the tax with interest. Will give you, after giving this intimation for recovery, which is nothing but notice for recovery, will give you 7 days time to pay all these tax and interest, if you're not paying, that is already added to your electronic liability ledger part 2, will start recovering by stringent measures. So that is the new rule, rule 142b. Now, what is the amendment in the next point, which is rule 159, provisional attachment? The next point is mere correction. There's no amendment, so you cannot expect any questions from this for amendment. Provisional attachment, when it is done when the proceedings are pending, provisional attachment cannot be more than for a period of 1 year. That 1 year was clearly given in the act, but rules and form were not clear. Now, even in rules and forms, they have said that provisional attachment will be valid only for a maximum period of 1 year. Either you withdraw that provisional attachment by issuing DRC 23 or maximum 1 year. So they have confirmed this point that provisional attachment is valid for a maximum period of 1 year. Within 1 year, you please complete your proceedings and take action, and automatically withdraw the provisional attachment. Officer is having an option. If not, maximum time limit for provisional attachment cannot be more than 1 year. So this was already given in the act. Now they have made it very clear in the rules and forms rather. So there's no such basic amendment there. Now talking about your amendments in in refund chapter, you'll find most of the amendments in refund chapter are only correction based amendments, which means in effect there is no basic amendment. In section 54 subsection 6, refund of tax, as a passing reference they had used the term ITC. I mean, you're talking about provisional refund of tax would be 90% of the total amount, excluding the amount of ITC provisionally accepted. Now understand that there's no concept of provisional ITC, as it is not practically that. They have removed the reference of provisional ITC in section 54 subsection 6. So they were talking about something about provisional refund. Provisional refund is 90% in certain cases, and that 90% will be other than provisional ITC. Now, as there is no concept of provisional ITC, the reference to provisional ITC is being removed. That's the only thing. It's only a correction part. And likewise, when you talk about refund, another amendment which has come in third proviso to rule 89.1. The first thing was section 54.6. Now it is third proviso to rule 89.1. When you talk about casual taxable person and non-resident taxable person, once they have filed all their returns, including the last return, any excess amount which is there in the electronic cash ledger as advance tax, you can get the refund. Initially, they've used the term you can get the refund in the last return. Now they have corrected it by telling that you cannot get the refund in the last return. You can get the refund after filing the last return. Rather than telling that you can get the CTP and NNP, when you are filing your last return, you can get the refund in that return. They have corrected it. They have said that if you have excess advance tax in electronic cash ledger, even after filing all your returns, you can get the refund of that, but not while filing the last return. They have corrected the word. Rather than telling that you can get the refund in the last return, they have corrected the term that after filing of last return, which is only a correction thing. And likewise, they have also corrected a term in rule 89 sub rule 2 and K, sub rule 2K. So rule 89 sub rule 2K, they have corrected the term. If at all you have paid excess tax, you can get that refund of excess payment of tax. Not only that excess payment of tax, you can get the refund. Also, if you have paid excess tax with excess interest, you will get the refund of excess payment of tax and the interest. Or if you have paid some excess amount, it may not be tax and interest, even that excess payment of amount, you will get the refund. So they have said that if you have paid something wrong, excess payment of tax, you will get the refund. Excess payment of interest, you will get the refund. Excess payment of any other amount, you will get the refund. So they have just corrected that terminology. So if you see the initial amendments which is there in your section 56 sub rule 4, or be it rule 89 1 third proviso, or be it rule 89 sub rule 2K, it's all corrections. There's no major amendment, it's all correction. Now there is an important amendment which has come out in your section 56, interest on delayed refunds, read along with rule 94 to interest on refunds. Now what is this particular amendment all about? This amendment talks about when government will give you interest on refund. So they have first cut the term that interest on delayed refund will be there for the period of delay beyond 60 days. So rather than putting from the day immediately after the expiry of 60 days, they have corrected the terminology as from the period of delay beyond 60 days from the date of receipt of such application till the date of refund. Now you might wonder what is the difference from the day immediately after expiry of 60 days is changed to for the period of delay beyond 60 days. Now if you only see section 56, it will not make any sense because both are the same. So when you talk about interest will start from the day immediately after expiry of 60 days and interest will start for a period of delay beyond 60 days, both means one and the same. But wait, this has to be read along with your rule 92, rule 94 sub rule 2. Now what are they telling? Why they have changed this terminology? Why they are not using anymore from the day immediately after the expiry of 60 days? So they don't want to have that 60 days freezed. It's not telling that from the day immediately after expiry of 60 days. They have to tell in a different way. They are talking about for a period of delay beyond 60 days. So after completion of 60 days. In effect, both means one and the same. But if you see rule 94 to sub rule 2, you will understand the reason for that amendment. In calculating that 60 days, following period shall not be included. That is the reason they are not using the word date immediately after expiry of 60 days. Now they are telling that for a period of delay beyond 60 days will be doing, you will be having interest. But when you are calculating 60 days, following period will not be included. What period will not be included? The time beyond 15 days which is taken by the assessee. If you get a notice in RFD 08, you have to reply to that notice or give additional documents or reply. Either reply in RFD 09 or give additional documents or reply. If you get a notice, you have to reply within 15 days. If you reply within 15 days, no issues. If you reply after 15 days, which means if you are taking time of say 17 days. So while calculating 60 days, you will not count that 2 days. You will not count that 2 days. Supposing you have got a notice and you have replied in 17 days. So that 2 days will be extra. So now interest will start in 60 days, after 60 days plus 2 days. After 60 days plus 2 days. 60 days is the basic time limit. But in calculating that 60 days, you will not count that 2 days. So interest will start after 62 days. Likewise, there's one more point here. If at all your applicant and you're not given the correct bank account details on the portal. So now you're trying to upload it, giving the correct bank account details where the amount has to be credited. Please understand that the period taken either by the applicant for giving the correct bank account details to which the refund is to be credited or validating the details of bank account, which means they are asking you, you have already given the bank account details, they are asking you to validate the bank account details. That amount that period shall not be counted. So either it is applicant is taking time to give the correct bank account details or to validate the bank account details where the refund sanction could not be credited, which means refund has been sanctioned but it is not credited. Now you are validating the bank account. That period will not be included. If at all assessee has taken say 5 days time either to give the correct bank account details or to validate the bank account details because the refund sanctioned is not being credited. Department has sanctioned the refund, it is not credited. Now you are taking the time to give the correct bank account details or validating the bank account details. So it is your time. So if taken 5 days, now interest will not start after 60 days. Interest will start after 60 days plus 5 days. So understand, in both these cases, refund is being delayed not because of the officer but because of the action of the assessee. You have got a notice in GST RFD 08. You are taking time to reply in GST RFD 09 or you are taking time to give additional documents and reply. Understand, 15 days is accepted. For you to reply or give details, additional documents and reply, 15 days is given. If you're taking say 17 days or 18 days, that extra 2 days and 3 days will not be counted in 60 days, which means interest will start after 60 days plus that extra 2-3 days. Or refund has been sanctioned, but it is not credited to your bank account. Now you're giving the correct bank account details, or you're validating the bank account details, you're linking your bank account details with GST portal. That is your mistake. You did not properly give your bank account details. If you're taking that 5 days time for giving the correct bank account details or validating your bank account details, then interest will start after 60 days plus 5 days. So only after 65 days calculation of interest will start. So that is this entire understanding. Now, the next amendment which is there in your first and second proviso to Rule 96, refund of IGST on export, they have removed an unnecessary point which was talking about 1 and 3B, where you're talking about a scenario where you have filed, the date of furnishing of GSTR 1 is over. It is, you are given that export details or zero rated supply details in GSTR 1, but after filing GSTR 3B. So they are talking about a situation which cannot happen now. They are telling that you have filed your GSTR 3B first, then you are giving the details in table 6 of GSTR 1. Please understand that that presently cannot happen. Now without filing GSTR 1, you cannot file GSTR 3B. So these above two provisos which were talking about a situation where first you have filed 3B, then you are giving the export details in table 6 of GSTR 1, etc., etc. It's not at all relevant. You cannot have this situation. The current return filing form strategy will not allow you to file 3B before 1. So this situation can never arise. Because this situation envisages that you have filed 3B, then you are filing GSTR 1. It's again a correction amendment, no impact on your as there's actually no impact in terms of this amendment. They have just corrected that particular mistake. Now, there are certain clarifications with respect to your refund. The first of the clarification is how you are going to calculate adjusted total refund. Your adjusted total turnover will be calculated in the same manner as you're talking about your export turnover. So whatever is there in the numerator, the same thing will be there in the denominator. So they have clarified this. Again, this was already clarified earlier. For your export turnover, which you're taking the numerator, whether it is be it for goods or be it for services, the same thing they have clarified that whatever value of goods exported out of India you include in the numerator will be added in the denominator. So this is only a clarification that your export turnover of goods will be the same in numerator, because for numerator they have given certain conditions that your export turnover cannot be certain things. For example, your export turnover cannot be more than 1.5 times of like domestic goods being supplied. So that is 1 point. And there is some restriction on your export turnover as well. So your export turnover calculation, which you take it for your numerator, which basically you take it for your numerator, will be same thing that you take it for your denominator. So that has been clarified here. So whatever export turnover of goods you take for numerator, same thing will be added in the denominator. Then the next clarification is actually a clarification which talks about basically zero rating, that is export of goods and export of services again. In a scenario where the goods are actually exported, initially you tried exporting the goods, it did not happen, you did not take the benefit of IGST refund, a payment of IGST refund, or you did not take the benefit of refund of unutilized credit, either payment option or LUT option. Or you exported the services, you did not realize the payment within the time limit, now you're getting the export benefit. So first they are telling that you tried exporting the goods, but you could not export the goods, therefore you are not giving the benefit, you are not given the benefit of exports, that is refund of IGST that is paid, or refund of ITC if at all you have gone under LUT or bond, or you have exported the services but your proceeds is not realized. Foreign export proceeds is not realized, because for export of services there's a condition that you have to receive the convertible foreign currency. For export of goods, there's a condition that the goods should actually physically go out. So you tried exporting the goods, but physically they did not go out. You are not getting the export benefits. You tried exporting the services exported, but you did not realize the foreign currency. After some time, actually the goods are going outside, actually you receive the foreign currency, even though it is after the time limit as given in Rule 96A. Now, it is clarified that actually there is export of goods and actually there is export of services. Why actually there is export of goods? You tried exporting it earlier, it did not physically go out, but now it is going out. You'll get export benefits. You tried exporting the services, you did not get convertible foreign currency, now you're getting convertible foreign currency. So actually now there is export of services. So you will be getting the benefits of zero rating. What are the benefits of zero rating? If you have paid output IGST, now you will get the refund of output IGST. If you have paid output IGST, now you are going to get the refund of output IGST. If at all you have paid output IGST, you will get the refund of output IGST. But if you paid output IGST with interest, you will not get the refund of interest. If you paid output IGST but export did not materialized and you paid output IGST with interest, you will not get the refund of interest, but the refund of output IGST that you have paid but it was not export earlier, now it is export, you will get the refund of output IGST. If you have not paid output IGST, you have exported under LUT or bond, now you will get the refund of unutilized ITC. So now you will get the export or zero rated supply benefits. See, the point is very clear, the circuit is very clear. You tried exporting the goods, physically it did not move out earlier, but now it is moving out. Finally it is export. You tried exporting the services, initially you did not get foreign currency within the time frame of RBI, but now you are getting that amount though it is late. This circular tells that you will get zero rated supplies benefit. If you have paid output IGST, if you have gone for payment option, if you have paid output IGST with interest, interest is a cost. You cannot do anything, but you will get the refund of output IGST. If you have not paid output IGST, you have gone for LUT or bond, so you are not now required to pay output IGST. That is credit which is there with you. Can you go for the refund of unutilized credit now? Yes, now you can go for the refund of unutilized credit, because for zero rated supply, either this or that. Now you can enjoy these benefits. So that is the effect of this particular circular. Now moving on to the amendments in your appeals and revision chapter. The first set of amendments is there in your Rule 108, which talks about appeal to appellate authority by the assessee, and Rule 109, which talks about application to appellate authority. Application to your appellate authority, which is basically by the department. Now understand that in both these rules, 108.1 and 109.1, the amendment is the same. What it is trying to tell, this amendment in both the places, normally when you file appeals, you have to file it only electronically. So when you file an appeals, you are required to file only electronically. Earlier exception was only one, as notified by the commissioner, but now you are allowed to file appeals to appellate authority or application to appellate authority manually. That manual appeals in APL 01 or manual application in APL 03 can be filed only under two circumstances. One, it is notified by the commissioner. Two, the appeals or the application cannot be filed electronically because the order or the decision against which you are going in appeals, that is not on the portal. That also came manually. You got an order or decision manually, therefore your appeal is manual or application is manual. So only in two cases, your appeals in APL 01 by SC or application in APL 03 by department, manual is possible if it is notified by the commissioner, or you cannot file your appeal or application manually because the decision or the order against which you are going to file an appeal or application, that is also manual. So decision order is manual, therefore your appeal or application is manual. So that is the amendment here. Now the second set of amendments, which is basically there in section 109 appellate tribunal, and the effect or the impact is there in section 117, 118, 119, etc., etc. So basically it is there in section 109, but the impact of the same is there in 17, 117, 118, 119, which is appeal to your High Court and Supreme Court, where they are talking about a situation. They are removing the terminology. State bench or area bench will now be called as only state benches. National bench or regional bench will now be called only as principal bench. So the main amendment that has happened in the main section, which is section 109, and in the other sections which are having an impact, that these are other sections where only the terms have changed, 117, 118, 119. They have amended it. What is the main amendment that you see? Now no more a bench will be called as national bench or regional bench. It will be always called as principal bench. No more a bench will be called as state bench or area bench. It will be always called as state benches. So it is principal bench or state bench. And not only that, in section 109 they have very categorically said, if at all against the order passed by the appellate authority or the revisional authority, you can file an appeals where in appellate tribunal known as GST appellate tribunal. So that is a basic thing which was already there. Now they have categorized that GST appellate tribunal into principal bench and state benches. Now principal bench, they have categorically said that it will be there in New Delhi, and that will have a president, a judicial member, technical member of center and technical member of state. So principal bench will be only one, which is going to be there at New Delhi, having a president, judicial member, technical member, state and technical member, center. And there will be state benches when only the state is making a request. The government will be forming state benches. It may have one state bench or multiple state benches. Say for example, in a state, say like Tamil Nadu, they are planning to have 3 state benches. Now that state benches will, each of the state bench will contain 2 judicial members. Principal bench contains president, judicial member, technical member state, technical member center. But here it will be 2 judicial members, 1 technical member center and 1 technical member state. Any order of appellate authority or revision authority can be taken up by principal bench and the state bench. Basically, they are telling that whenever there is an appeal against appellate authority order or revision authority order, you can go either to principal bench or state bench. But if any one of the issue deals with place of supply, then it will be heard only and only by principal bench. So when you are filing an appeals against the order of appellate authority or revision authority, the matter can be heard by principal bench or state bench. That's, I think basically this is the same. But if at all the matter deals, any one of the issue in the matter deals with place of supply, state bench cannot intervene. It will always go only and only to principal bench. Please understand that place of supply issues will always go to P, place of supply, principal bench. Other issues, generally state benches, but principal bench can also take up the matter. Now, understand that the president can make sure that it is transferring a case by special order or general order from one bench to another bench. It can transfer the case from one bench to another, from principal bench to state bench, or one state bench to another state bench. And the senior most judicial member, because state bench will have 2 judicial members, 1 technical member center, 1 technical member state. So senior most judicial member within all the state benches. A state can have multiple state benches, and each state bench will have 2 judicial member, 1 technical member state, 1 technical member center. The senior most judicial member will be taken as vice president, and he will exercise all the powers of a president, but for all other purposes he will be treated as a member. And understand that if at all a matter is petty matter, if a matter involves an amount less than 50 lakhs, less than equal to 50 lakhs, and does not involve question of law, which means the tax amount or ITC amount or fine or fee or penalty, the matter is a petty matter, amount is involving less than or equal to 50 lakhs and does not involve any question of law, which means it is only a question of fact. So here you are talking about a question of fact plus amount is less than or equal to 50 lakhs, then If at all president wants, he can make sure that all the conditions he can put, and he can make sure that a single member bench can hear up the matter. Only a single member bench, one member can hear up the matter. In all other cases, there will be one judicial member and one technical member hearing the matter. The matter involves a question of fact, only a question of fact, no question of law. No question of law. And amount is less than or equal to 50 lakhs. If president wants, he can make sure that only a single member bench is hearing up the case. In all other cases, one judicial member and one technical member. And if the members are differing in their opinion, all those members can refer the matter to the president, and the president will refer such case to other members. Now, once it is referred to other members, whatever all the members decide, including the other members hearing it, all the members, initial members who heard the case and the new members who heard the case, majority will prevail. So initially 2 members heard the matter, now they are referring to third member, majority will decide the matter. Now, who will be that other member? If the appeal originally is heard by the members of state bench, another member of the state bench within the state will hear. The next member to hear is another member of the state bench. But if no such other member within the state are there, then you will refer the matter to another member of state bench in another state. So if members of state benches are hearing the matter, and if there is a tie, then you refer to another member of the same, another member of state bench in the same state. If it is not available, refer to another member of state bench in another state. If the appeal is originally heard by members of principal bench, you refer the matter to another member of principal bench. If that another member is not there, all the members are already involved, then you refer the matter to members of any state bench. So if appeal is heard by the member of state bench and there is a tie, refer the matter to another member of state bench in the same state. If not available, refer to another member of state bench in another state. If appeal is heard by members of the principal bench, and if there is a tie, refer the matter to another member of the principal bench. If that is not available, refer the matter to any member of any state bench. And finally, majority will win. And the government, in consultation with the president, for administrative efficiency, transfers members from one bench to another. It's not transfer of case. The earlier point was transfer of case from one bench to another bench that president himself can do. So this is transfer of case from one bench to another bench, principal himself can do. This is transfer of members. This will be done by the government in consultation with the president. But when a technical member of a state is being transferred, technical member of a state bench, technical member state bench is being transferred, technical member state, not center, technical member state of a state bench is being transferred, he shall be transferred only to another state bench only in the same state in which he was originally appointed in consultation with state government. So basically the point is, a member can be transferred, a case can be transferred from one bench to another bench by president. A member can be transferred from one place to another place by government in consultation with president for administrative efficiency. But if at all you are talking about a particular member, who is that member? Technical member state. He can be transferred, technical member state of state bench. Again I repeat, not of principal bench, technical member state, that too of state bench. Technical member state and that too of state bench, he can be transferred to another state bench in the same state only, that too in consultation with that particular state government. And finally they clarify that no act or proceedings of appellate tribunal shall be treated as invalid merely because of some vacancy or defect in whatever we have discussed, that a matter should be heard by supposing a matter which has to be heard by a judicial member and a technical member is heard by only a single member bench, still it will be remain valid. It is all for internal purposes. So that is the last point here. So these are all the amendments which has come in your appeals and revision, mainly with respect to appellate tribunal. Now talking about the other amendments which are there in miscellaneous provisions chapter, you have section 158A being introduced, read along with notification number 33/2023, and read along with Rule 163. All of them talk about the same matter, which is nothing but consent-based sharing of information furnished by a taxable person. We're talking about consent-based sharing of information which is furnished by a taxable person, which means common portal is going to share your private information, your information to another entity, requesting entity. That requesting entity can be income tax department. Consent-based sharing of information. Now, supposing, just let us understand a matter that my information which I filed in GST portal is required by income tax department or some other requesting entity. Can GST portal share that information? That is the point. This is basically addressed by a new provision, which is rule section 158A, read along with notification 33/2023, and in the rule it is given in rule 163. What this new section 158A and rule 163 talks about. Now understand that consent based sharing of information by a taxable person is allowed from common portal to a requesting system. That requesting system is any other department. It can be registrar, where your land is being registered. It can be a collector. It can be income tax department. It can be any other department. That requesting system. Now understand that if at all that details pertains with registration or return, any details which I have given at the time of registration or my return, supplier's consent will be required. If at all that details pertains with e-invoice or e-way bill or GSTR1 or IFF, e-invoice, e-way bill, GSTR1 or IFF, both supplier consent will be required and recipient's consent required. If at all I have given any details at the time of registration or my return filing, and that information is to be shared by GST portal to another entity requesting system, only supplier's consent is required. If that detail that pertains with e-invoice, e-way bill and GSTR1 IFF, where both supplier details and recipient details will be there, the consent of supplier and the recipient is required. If at all any other details is to be shared, not dealing with registration, return filing, not dealing with e-way bill, e-invoice and GSTR1 IFF, then supplier's consent is always required. Recipient consent is required if at all it has his information. So basically, first they're framing a point that whose consent will be required by GST common portal. If it pertains to your registration and return filing, only supplier's consent. If it pertains to e-way bill, e-invoice or a particular return which is GSTR1 IFF, both supplier's consent and recipient consent is required before common portal shares that information to requesting system. If it is any other details apart from registration, return, e-way bill, e-invoice and a particular return GSTR1 IFF, then supplier's consent is always required. And if the information that is being shared also contains recipient details, recipient's consent is also required. Now central government has in fact notified account aggregator as the requesting system, which the details of which will be shared by the common portal based on consent. So who is going to share that information? Now as of now, that requesting system is called as account aggregator. Whose account aggregator? Non-financial banking company which undertakes the business of account aggregator. So account aggregator as of now is NB, a non-financial banking company which will do the work of account aggregator in terms of direction issued by Reserve Bank of India. So this non-financial banking company as of now will be acting as the requesting system which will collect the information from GST portal. It will do the work of this collection of information, accounts aggregator, details collection aggregator, and it will work in accordance with the instruction issued by RBI. So this requesting system as of now is accounts aggregator, which is nothing but non-financial banking company. Now the rule tells how this actually will work. The rule tells the procedure. First, this requesting system, which is accounts aggregator, which is nothing but non-financial banking company, will get the consent from the registered person, basically the supplier. The requesting system, which is the accounts aggregator AA, which is nothing but non-financial banking company, first will get the consent from the registered supplier. Now, registered supplier has to get the consent from all the recipients if recipient's consent is required. And once registered supplier gives the consent, it will be assumed that all the recipients have given the consent. See, recipient's consent is not required at the time of registration details, return filing details, or other details which does not involve recipients. Recipient's consent is required if his details are also being disclosed. So what this requesting system will do, will get the consent, will deal only with the supplier, and the supplier has to get the consent from the recipient if their details are also being shared. And once the supplier has given the consent to requesting system, which is accounts aggregator, it is assumed that he has taken the consent, all the recipients have given the consent. Now this requesting system will forward the consent of the supplier to the common portal, and it will tell that I want the details of the this particular tax period, this particular recipient, etc. etc. It will give, first it will take the consent from the supplier, and supplier in turn will take the consent from all the recipients. If supplier has given the consent to the requesting system, that is accounts aggregator, it is assumed that all the recipients dealing with that supplier has given the consent, and then this requesting system will forward that, see, the supplier and his corresponding recipients have given the consent to the common portal, and it will ask for the details of this particular tax period and other details. It will mention which details it requires. Finally, the common portal will share that information to the requesting system. So requesting system, which is your accounts aggregator, non-financial banking company, will deal with the supplier, and supplier will in turn deal with the recipient. After getting the consent, requesting system, that is accounts aggregator, which is non-financial banking company, will tell that I want this particular details with common portal, and the common portal then will share the information. It will deal with the supplier will give consent, and the supplier will take the consent from the recipient. So these are the basic steps. Requesting system will get the consent from the supplier will get the consent from all the recipients. If supplier has given the consent, it is implied that all the recipients have given the consent. Then requesting system will make a request to common portal that, see, I've got the consent, now give all these particular details. Common portal will share all those particular details. So that is all about your consent based sharing of information by the common portal to the requesting system, which is as of now accounts aggregator. Yes friends, now let us discuss about the amendments in offences and penalties. And moreover, amendment in the offences and penalties is very important and expected to come in this attempt, because major changes have come there. Now the first amendment is a very basic amendment. They have introduced a new section called as section 122 subsection capital 1b, where they are talking about penalty against ECO for supply through it, which is not in terms of the law. Now, what is this basically? This is basically an amendment where now supplier of goods can supply through ECO even if he's not registered but having enrollment number or under composition scheme. But in such cases, there are certain conditions that ECO they need to take care. If they're not doing it, then they'll not get the benefit of exemption from registration. They'll not get the benefit of composition scheme. And if ECO is supporting them, there's a penalty on ECO. An electronic commerce operator who allows supplies of goods or services through it by an unregistered person other than those exempted from registration. So normally there can be supply of goods or services through ECO by unregistered person, but that unregistered person should be exempted from registration. If that unregistered person is not exempted from registration under section 23, but still supplying through ECO, then ECO will be paying a penalty. Secondly, where that ECO is allowing interstate supply of goods or services through ECO where he is not eligible. Basically, interstate supply of services is allowed, but interstate supply of goods is not allowed. So where such supplier cannot make interstate supply of goods, I am focusing only on goods here, but he is still making interstate supply of goods through ECO, ECO will be paying a penalty. Obviously, there will be an action against him in terms of not giving the benefit of exemption from registration, not giving the benefit of composition scheme, but ECO is equally responsible. Where ECO fails to give the correct details in his GSTR 8, which is for outward supply of goods affected through it, where that such supplier is exempted from registration. So here, if you see point number 1, they focus on both goods and services. 2 also goods and services. 3 focuses only on goods. Point number 1 tells that there is an unregistered person who's making supply of goods or services through ECO. If he is exempted from registration, no problem. But if he is not exempted from registration, but still he is unregistered and making supply of goods or services through ECO, ECO will pay a penalty. Point number 2 tells that where you are having interstate supply of goods or services, focus is more on goods, but they mention both goods and services. And that person is making supply through ECO, where he is not allowed to make such supply. So such supplier who is making interstate supply of goods or services through ECO, but he is not allowed. Mainly he is not allowed in case of interstate supply of goods, but still doing it, there will be a penalty on ECO. Thirdly, where ECO, so in the first 2 cases, something is done by the supplier, but ECO is paying a penalty. In the third case, ECO is not doing some work properly, where ECO is not filing in his GSTR 8 the details of supply of goods which are affected by a supplier through it. That supplier should be exempted from registration. So that details is not furnished in GSTR 8. In such a case, this particular ECO will be liable to pay a penalty of 10,000 or tax involved, assuming that if the supplier was registered and if he was not under composition scheme. So the penalty amount is 10,000 or tax involved, assuming that supplier is registered under regular scheme, that tax amount involved, whichever is higher. So penalty amount is 10,000 CGST penalty, copy paste SGST penalty, or tax involved, assuming that the supplier would have been registered and would have been under regular scheme. He may be under, assume that he is registered. He may be in a composition scheme. Assume that if he is under regular scheme, what would have been tax involved, whichever is higher. This is CGST penalty. So that's everything about your section 122 subsection 1 capital B, penalty on ECO for 3 things done. 2 things are done by the supplier, but ECO is paying penalty, and third thing is done by ECO, not properly done by ECO, therefore ECO is paying penalty. So that is all about section 122 capital 1B. Now we are talking about amendment in section 132, where you are talking about certain offences. Section 132(1) and section 132(2), that is the amendment which is involved. Now also do understand the fact that corresponding amendment has come in compounding of offences for that particular, avoiding the imprisonment, section 138(1) and section 138(2), compounding of offences. So main amendment is section 132 and corresponding amendment is also there in compounding of offences, section 138(1) and 2, read along with rule 162(3) and 162(3)(a). Now let us try to understand what is the amendment given. Now firstly, they have decriminalized certain offences, which means imprisonment will not be there. See, if you see the total list, when you talk about your section 132(1), you have a list of cases where there'll be certain imprisonment. So 132(1) has got list of cases. So 132(1) has got A, B, C, D, E, F, G is now removed, H, I, J, K is now removed, and L. Now 132(1)A talks about supplying but without invoice. Supplying it but without invoice. B talks about invoice but without supply, which means you're talking about fake invoices. Very serious. 132(1)C talks about taking input tax credit based on fake invoice or without any invoice. 132D talks about collecting surplus amount and not paying it within 3 months of due date. You collected an amount which is not tax, keeping with yourself. You are cheating the customers and collecting something called as tax, but technically it is not taxed. keeping the amount for more than 3 months from the due date. 132(1)(e) talks about evasion of tax or fraudulently taking refund which is not covered in A to B. 132(1)(f) talks about fake accounts, falsification of accounts. Now, G, which was dealing with obstructing or preventing an officer from discharge of his duties. Previously, it had imprisonment. Now it has been decriminalized. So there is no imprisonment. So G is not there. H, which talks about having in possession or dealing with goods where there are reasons to believe it is liable for confiscation. So you are dealing with some goods, having possession of goods or dealing with, whether supplying it or receiving it or transporting it or concealing it or depositing it, something where you have reasons to believe that it is liable for confiscation. I talks about receiving services or dealing with services which you have reasons to believe it is in contravention to provision of the act or rules. So obviously there cannot be any confiscation for services. It is contraventions to the provision of act or rules. So here when you talk about H, it is talking about goods and which you have reasons to believe is liable for confiscation. Here for services which you have reasons to believe that there is some contravention of provisions of act or rules. J and K, which deals with tampering with or destroying any material evidence or documents. Previously it was having imprisonment. Now when you are destroying the evidence or tampering with the evidence, there's no imprisonment. That is now decriminalized. And K, which talks about failure to give some information which is required to be given but you have not given, or you have given so false information. Not giving information or giving false information. Previously this was having imprisonment. Now there is no imprisonment. So that is the amendment. So 3 offenses which were having imprisonment, now they are not having imprisonment. Now also do understand the fact that when you're talking about all these cases, please understand the fact that there is a last point. So what is removed? G is removed. Obstructing the officer. J, tampering the evidence. K, false information or no, not giving information is removed. And L talks about attempting to commit that offense or abetting the commission of offense, which means you are not done that offense but you are trying to do that offense, or you are supporting someone who is doing that offense, abetting the commission of that particular offense. Now please understand that in all these cases you need to understand the difference. Now if at all it is first time offense, if it is first time offense and if it is repeated offense, if it is first time offense, then when you talk about 132(1)(f), falsification of accounts, first time offense, it will have a maximum imprisonment of 6 months. And in other cases, for you're talking about first time offense, then you need to bifurcate it. The amount involved is more than 5 crores. In all other cases, the amount involved is more than 5 crores, then it is 5 years plus fine. And when you talk about if the amount involved is more than 2 crores but up to 5 crores, 5 minus 2 is 3, so 3 years plus fine. And only in a case where you are talking about fake invoicing, only when you're talking about fake invoicing, when you're talking about your 132 1B fake invoicing. Fake invoicing. If the amount involved is fake invoicing, if the amount involved is 1 crore to 2 crores, 2 minus 1, it is 1 year plus fine. Please understand it. Out of all these offenses, first only talk about falsification of accounts, fake records. This will have a straightforward answer, 6 months. Amount is not going to be involved. In all other cases, there will be amount involved. In all other cases where the amount involved, in all other cases including 132 1B, if the amount involved is more than 5 crores. In all other cases, when I tell in all other cases, A, B, C, D, E, H, I, L, amount involved is more than 5 crores. 5 minus 0, 5 years plus fine. Amount involved is more than 2 crores but up to 5 crores. 5 minus 3. 5 minus 3, it is 3 years plus fine. But where you are talking about only fake invoice. Only and only fake invoice. So it is only talking about 132 1B fake invoice, and the amount involved is 1 crore to 2 crore. So this is the second amendment. So here this fake invoicing, previously it was for any offense, now it is only for fake invoicing where the amount is more than 1 crore but up to 2 crores, it is 1 year with fine. So that is the second amendment where you are talking about only and only fake invoicing. So 1 crore to 2 crores, if it is any other offense, no imprisonment, it is only fake invoicing. 1 to 2, so 2 minus 1, 1 year plus fine. But if it is repeated offense, everything that we have discussed is for first time offense. If it is repeated offense, any case, it is 5 years plus fine. So if at all it happens to be a repeated offense, first time offense, we have discussed 3 scenarios. Repeated offense, any case, 5 years plus fine. And in all these cases where the imprisonment is 5, 3 or 1 years, for adequate reasons, the imprisonment can be reduced but not less than 6 months. So minimum 6 months will be there. If at all there are adequate reasons, if at all there are genuine adequate reasons, there can be imprisonment which can be reduced from 5 years or 3 years or 1 year, but not lesser than 6 months. Not lesser than 6 months. So this is the entire understanding when you talk about the amendment here. Now also do understand the fact that what are the offenses which are cognizable offenses and non-bailable offenses, and other offenses which are non-cognizable and bailable. Only and only when you are talking about section, this is all about the other things. Only and only when you are talking about section 132(1) A, B, C, D. 132(1) A, B, C, D. And the amount involved is more than 5 crores. Only and only it is cognizable and non-bailable offense. So you are talking about a situation where it is 132(1) A, B, C, D plus the amount involved is more than 5 crores. The amount involved is more than 5 crores. That is the first category. Not any category, just not more than 5 crores. In that case, it is cognizable and non-bailable. All other offenses are non-cognizable, which means it has to be with arrest warrant, and bailable. Cognizable and non-bailable means, cognizable means there is no need of arrest warrant. Non-bailable means bailable only by magistrate. All other offences, it is not covered in 132(1) A, B, C, D, and the amount, or if it is covered in 132(1) A, B, C, D, but the amount involved is less than 5 crores, less than or equal to 5 crores, then it is your non-cognizable, which means arrest can be possible only with the arrest warrant, and bailable, which means the officer who is arresting it himself can give a bail. So only and only in a scenario where we are talking about, this is not the amendment, but we are trying to understand it, only and only in a scenario where you are talking about section 132(1) A, B, C and D, plus amount involved is more than 5 crores. That is 132(1)(1), which means amount involved is more than 5 crores. Only in that case it is cognizable and non-bailable. Without arrest warrant, arrest is possible. Bail can be given only by magistrate. Any other case, that is non-cognizable and bailable. Non-cognizable means arrest is possible only with arrest warrant. Bailable means bail can be given even by the officer who is arresting it. So this is not an amendment, but this is how you have to understand this entire scenario. And whenever there is prosecution, whenever there is going to be arrest, whether it is cognizable, non-bailable or non-cognizable, bailable, whenever there is arrest or any prosecution, that is imprisonment, please understand that it is possible only with the previous sanction of commissioner. So commissioner should approve it, that yes, you can proceed with prosecution, imprisonment. So that is everything about your 132 section. We have not only discussed the amendment in section 132, we have actually discussed everything about your section 132. Right, now what is there in the amendment in section 138? Now understand that previously compounding offences, the offences where you can compound it. What is meant by compounding of offences? It means you are trying to avoid prosecution. It means you are trying to avoid imprisonment, and you can pay a compounding amount and escape imprisonment. The entire objective of section 138 is pay an amount which is called as compounding amount and escape prosecution or imprisonment. Now understand that before the amendment, compounding was allowed in a particular case, not allowed in a particular case. After the amendment, it is different. After the amendment, compounding is not allowed. Compounding is not allowed. You cannot go for compounding, which means you have to face prosecution or imprisonment for sure. It is not allowed. A person who has been allowed compounding once, any person who has allowed for going for compounding once in respect of any offense under section 132(1), which means you have already done compounding once, second time compounding is not allowed. Second, a person who is accused of committing an offense under section 132(1)(b), which is fake invoice. For fake invoice, compounding is not allowed. Third, a person who is already convicted, which means it's not accused, he has been already convicted. Final judgment is coming, he has been convicted of any offense under this act by court. Conviction is already given. Conviction means already it is declared that he is guilty of any offense under this act or any other notified persons or offenses. So last point is a general point. So compounding of offenses is not allowed in what all cases? First point is very simple point. You can go only for one time compounding. Second time compounding is not allowed. Second topic talks about fake invoices. If at all you have even accused, it is not proved, it is not convicted, accused of fake invoicing, compounding is not possible. Third point, if you are convicted of any offense under this act, final conviction is that, compounding is not allowed. You cannot go for compounding of offenses. In all other cases, you can go for compounding. So that is the amendment which is brought in section 138(1). And the second amendment which is there in section 138(2), it is the compounding fees has been decreased. The compounding fees which can be there is now reduced. Earlier it was 10,000 or 50% of tax involved, whichever was higher. Now it is maximum. The minimum amount of compounding is 25% of tax invoiced, and the maximum amount, earlier the minimum amount was 10,000 or 50% of tax involved. Now the minimum amount is only 25% of tax involved. The maximum amount earlier was triple 30,000 or 150% of tax involved. Now it is 100% of tax involved. So your compounding fees can be up to 25% of tax involved till 100% of tax involved. So it is now in this range, 25% of tax involved to 100% of tax involved. That is another amendment given in compounding, where they have reduced the amount of compounding. First, they have changed in which all cases compounding cannot be done. Other cases compounding can be done. Any other case, if it is not covered here, if it is not these three cases, any other case, these three cases you cannot go for compounding. Any other case you can go for compounding of offense, which means you can avoid prosecution or imprisonment and pay a compounding amount. What is the range of compounding amount? 25% of tax involved to 100% of tax involved, which means earlier it was higher, 10,000 or 50% of tax involved, whichever is higher, and this is a minimum amount, maximum amount, 30,000 or 150% of tax involved, whichever is higher. So minimum and maximum are higher. Now it is 25% of tax involved, fixed amount, till 100% of tax involved. This is the range. In between that you can have compounding of offense. Not only that, they have taken away the power from the proper officer to decide whether compounding can be done or not. So earlier, when compounding was to be applied, when you apply for compounding of offenses, commissioner, after taking into account the contents of the application in a form called as CPD02, on being satisfied that the applicant has cooperated in the proceedings and made full and true disclosure. Now they have removed that has cooperated in the proceedings. So this cooperated in the proceedings is not required. So applicant has made an application in CPD 02. He has made full and true disclosure. That is sufficient so that officer can allow him to go for compounding of offenses, mentioning the compounding amount and immunity from prosecution, telling that yes, you need not go for prosecution, or reject the application. If it's not satisfied, if full and true disclosure is not made, rejecting the application within 90 days. So understand that earlier there was a scope where commissioner had an option to see whether to accept or reject based on whether the assessee has cooperated in the proceedings. Now that scope is removed, which means commissioner does not have any power to accept or reject compounding application. All it is required is if assessee has made true and full disclosure, commissioner shall allow compounding of offense and give immunity from prosecution and give that. So that is only required. Applicant has made true and full disclosure. If that is there, compounding of offense is there. Whether he has cooperated, not cooperated. So discretionary power is taken. Because cooperated or not cooperated is subjective. This is actually subjective. Commissioner can always tell that no, he has not cooperated. Now the subjective point is removed. And made full and true disclosure is objective. It is very clear on records whether he has made full and true disclosure. So now it is only objectively seen. If you have made full and true disclosure, go for compounding. Commissioner will allow you compounding, immunity from prosecution, no imprisonment, and pay a compounding amount. Not only that, all these amendments have come in that the conceptual amendment came in section 138. The procedural amendment, this is procedural amendment, is there in rule 162.3 and also 162.3a. They have given what is the amount of compounding amount. Now please understand that compounding is allowed only for first time offense. It is not allowed for repeated offense. It should be only first time offense. It should only be a case where you're talking about first time offense. And in first time offense, you're talking about which scenario? Where it is punishable under section 132(11) means the amount involved is more than 5 crores, or the amount involved is more than 2 crores but up to 5 crores. Compounding of offense, you're escaping 5 years imprisonment, or you're escaping 3 years imprisonment. So first thing you need to understand that compounding is allowed only for first time offense. In the first category, the amount involved can be, the amount involved can be more than 5 crores or even 2 crores to 5 crores. Why 1 crore to 2 crores is not there? 1 crore to 2 crore imprisonment is there only in case of fake invoicing. And please understand that when you talk about fake invoicing, when you talk about section 132 1B, where you talk about fake invoicing, you are not even allowed to go for compounding of offense. So compounding of offense is not allowed. When you talk about fake invoicing, you cannot go for compounding of offense. Therefore, that 1 crore to 2 crore, which is only for fake invoicing, is not given here. Right. Now, offense which is mentioned in for fake invoicing, I can put it in a simple way. When you talk about section 132 1B, which is all about fake invoicing, you cannot go for compounding of offense. Compounding of offense cannot be done because we have seen, if you have already second time committing an offense, if you have committed that, if at all you have already gone for compounding, second time compounding is not allowed. One time only you can go for compounding. Fake invoicing, compounding is not allowed. Convicted of any offense, compounding is not allowed. So fake invoicing, compounding is not allowed. So that 1 crore to 2 crores is not there, because that 1 crore to 2 crore imprisonment is only there for fake invoicing. Now, what are the offense which is there? If an offense is committed first time under section 132 1A, which is supply without invoice, or 132 1C, fake invoicing is not covered here. 1C, which means you're talking about taking ITC based on fake invoicing or without invoice. 132 1D, which means you have collected surplus amount not paid within 3 months of due date. 132 1E, evading tax or fraudulently applying for refund, not covered in 132 1A, 1B, 1C, 1D. 132 1F, fake accounts. 132 1H, you are having possession or dealing with goods which you have reasons to believe they are liable for confiscation. 132 1I, you are receiving the services or dealing with services which you have reasons to believe it has contravened the provisions. And finally 132 H is over, I is over. 132 1L, where you are attempting to commit that offense or you are abetting, which means you are supporting someone who has committed that offense. Now, in the first 4 cases, that is 132 1A, 1C, 1D, 1E, if you are covered by, if the amount involved is more than 5 crores, then compounding amount to escape an imprisonment is 50% of tax evaded minimum, maximum is 75%. In that range, compounding offense can be given 50% to 75% of tax evaded. 50% of tax evaded or input tax credit wrongly availed or amount of refund wrongly taken. So 55% of tax evasion or ITC availed or refund. So 50% to 75%. 50% of tax or ITC or refund involved to 75% of tax or ITC or refund involved. If you are covered in 132 1-2 category, which means the amount involved is 2 crores to 5 crores, then it is 40% of tax involved, ITC involved or refund involved to 60%. So here 50 to 75, 40 to 60. If at all it is a case covered in 132 1F, fake accounts, 1H, goods liable for confiscation, 1I, services liable for contravention, then it is 25% of tax evaded. 25%. Whether it is more than, whether the amount involved is more than 5 crores or 2 crores to 5 crores, it is 25% of tax evaded. If at all you are talking about attempting to commit that offense or abetting the commission of that offense, which means you are attempting to do that offense or you are helping someone in committing that offense, again it is 25% of the tax evaded or tax invaded, ITC wrongly availed or refund wrongly taken, which means in all other cases apart from 132 1A, 1C, 1D and 1E, where if the amount involved is more than 5 crores, 50% to 75%, 2 crores to 5 crores, 40% to 60%. In all other cases, 132, 1F, 1H, 1I and 1L. Whether the amount involved is more than 5 crores or 2 crores to 5 crores, it is 25% of tax involved or ITC involved or refund involved in all other cases. So that is all about this particular point. Right. And if at all you have committed multiple offenses, if you have committed multiple offenses where you are covered in more than one category, you will not be paying compounding amounts, adding both, you will be paying compounding amount, that amount for that offenses which is higher. So if you committed offense under 132, 1A and 132, 1F, you will be paying 50% to 75% compounding fees, and assuming the amount involved is more than 5 crores, so you will be going at a 50 to 75% compounding fees and not 25%. So if you have committed multiple offense, you are not going to pay two compounding offense, you are going to pay only one compounding amount. Select that compounding amount which is higher. So if you look at things are very simple. If at all you have committed an offense under section 132, 1A, C, D, E. Others, section 132, 1F, 1H, 1I, also section 132, 1L. Abetting or committing or abetting the commission of an offense, helping someone or attempting to commit, you are trying to do something. Now, only in this case where the amount involved is more than 5 crores, amount involved is more than 2 crores but up to 5 crores. Here the compounding amount is 50% to 75% of tax or ITC or refund, here 40 to 60. In all other cases, 25% of tax involved, ITC involved or refund involved. And if it is multiple offenses, it is not adding both the compounding amount, it is selecting whichever is higher. So that is everything about compounding of offenses. Now, after the amendment, what they have done is, the discretion which was given to the officer with respect to compounding fees is decreased, and only in certain cases there is a range. In other cases, there is no range. In 132, 1A, 1C, 1D, 1E, there is a range. Officer has a discretion, but a limited discretion. In 132, 1F, H, I and L, there is no discretion. It's straight away 25% of tax involved or ITC involved or refund involved. So that is everything about your compounding of offenses. When you pay that compounding amount, what is the advantage of compounding amount under section 138 read along with rule 162? Advantages: you are escaping imprisonment and paying an amount and escaping imprisonment. So that is the advantage of compounding of offense. Yes friends, when you talk about your amendment in customs law, very minimum amendments. One is in your levy chapter, levy of customs, where there is an exemption notification for re-importation of goods. So which is your section 20 read along with notification number 40 bar 2017, 45, section notification number 45 bar 2017. They have just amended the term where you're talking about exemption at the time of re-importation, and there was a reference to foreign trade policy. They have just said that now that foreign trade policy terms is changed, that new schemes of foreign trade policy 2023 is being inserted because the old scheme is not at all relevant. So wherever the reference was that to the old foreign trade policy in that exemption notification, they have replaced it to the new scheme of new foreign trade policy 2023. That's the first amendment. And the second amendment is there in your import procedure, basically dealing with payment part. There are certain special people who can go for deferred payment of import duty rules. Basically, you're talking about authorized economic operators, AEO. Authorized economic operators can basically, and the public sector undertakings. Authorized economic operators and public sector undertakings can go for deferred payment of import duty, which means once in fortnightly basis, they'll be making the payment for all the import done during that fortnight. Once in 15 days, they'll be making the payment of import duty, and there is a particular due date. For whom? Authorized economic operators and your public sector undertakings. Now what it has been amended is, in rule 4 there is an amendment telling that central government, if at all it considers necessary in exceptional cases, may allow payment on a different due date. So normally in deferred payment rules there's a fixed due date every fortnightly, 1st to 15th April, 16th of April, 15th to 30th of April, 1st of May. But for the March, 1st to 15th March, 16th of March, 16th to 31st of March, 31st of March. But central government can make it a different due date. So there's a power to government to give a different due date under exceptional circumstances for certain people. First amendment. Second, an eligible importer is permitted to go for deferred payment if at all he is making the payment for all the different bill of entries within the deferred payment given under rule 4. So this amendment is given in rule 6. Rule 6, which talks about if at all in certain cases deferred payment is not allowed, but if at all you have paid the duty within the due date in rule 4, deferred payment is allowed. Right. So first of all, they tell that in certain cases you are not allowed to go for deferred payment rules. Then they give a proviso telling that no, you can go for deferred payment if at all you have paid the duty for a bill of entry within the due date, or if you have paid the differential duty on the same bill of entry along with interest, because it is a case of reassessment. Officer has taken the case for reassessment within one day of that reassessment, excluding holidays. So in a normal case, for a bill of entry, you are paid within the due date. In reassessment case, you are paid within 1 day of reassessment. So in a normal case, you are allowed for deferred payment if you pay within due date of rule 4. In reassessment case, you are allowed for deferred payment. You are allowed for deferred payment if you pay within 1 day of reassessment. In normal case, you are allowed for deferred payment duty if you pay the duty within the due dates given under rule 4. In reassessment case, you can go for your deferred payment for other bill of entries, but for a particular bill of entry which was taken for reassessment, make sure that particular bill of entry you make the payment within 1 day of reassessment. If that is being done in all the other bill of entries, you can go for deferred payment rules. So that is the amendment in rule 4 and rule 6 of deferred payment of import duty rules 2016. And one more amendment is there in section 51A, read along with notification 69/2023. Normally you have to make the payment by electronic cash ledger, but certain cases it is exempted, which means you have to make the payment through a particular route. First deposit in electronic cash ledger, then set off the payment. But in certain cases that routing through electronic cash ledger is not required. What are those cases? If at all you are importing or exporting the goods in customs station where you don't have automated system, so no need to pay through cash ledger, directly pay it. Or if at all you are talking about import or export in international courier terminals, no need to pay the duty through cash ledger, directly you can make the payment. Or if you're talking about your baggage, no need to route the payment through electronic cash ledger, directly you can make the payment. Or when you're talking about deposits, you're talking about normal deposits, not the payment of your customs duty, including cess or integrated tax or GST compensation cess or interest penalty fines and all. Which means in all these cases, when you're making the payment of customs duty or any social welfare surcharge or cess or IGST or compensation cess or interest or late fees or penalty, in all these cases payment through electronic cash ledger is mandatory. In cases where you are talking about no automated systems, being in customs automated system is not in place, or international courier terminals, or baggage, or deposits, which means you're not depositing for payment, you're normally doing deposit, extra payment through electronic cash ledger is not mandatory. So there are 4 cases where payment through electronic cash ledger is not mandatory. Customs automated system is not in place, or it is international courier terminal, or it is accompanied baggage, or you're talking about deposits, normal deposits, not for paying the taxes, normal deposits. Payment through routing through electronic cash ledger is not mandated Directly you can make the payment. Customs automated systems not in place. International courier terminals, baggage and deposits. But if you are paying the dues, customs duty including cess or social welfare surcharge, including IGST, including compensation cess, including interest, penalty, late fees, etc. In all such cases where it is tax payment, where it is tax, that is customs duty, social welfare such as IGST, compensation cess or interest, penalty, fees, in all such cases you have to route the payment through electronic cash ledger. So that is section 51A read along with notification 69/2023 customs.